Hope you're all doing good. It's me, CA Sandesh, and I'm doing good as well. So exam season is around the corner. So I hope all your preparation is going at full swing. So I thought I'll help your exam preparation by doing a marathon on FM. Okay. So yes, in this session we'll be covering financial management ka marathon or last day revision. Okay. We will be doing this marathon with the help of our chart book. So those of you who have taken regular class from me, I'm sure you're comfortable with the term chart book. Yes. So others who are new, so we cover the concept for all the subjects that I handle. We prepare something known as the chart book. This is how a colored chart book will look like. If you want to purchase these books, whether existing students or the new students, you can visit our website, that is learn.arivupro.com. Once you pop into our website, you will be able to see, 1 minute, it's loading. Yeah, you will be able to see this homepage. Select the course that you want to buy the chart book for. Let's say you want to buy chart book for CA Intermediate. So select CA Intermediate and select books. Once you select the book, select the subjects that you want to buy it for. Let's say financial management. And type of book, we have two types of books. One is our class, regular class notes. Another one is the colored chart book. Select the colored chart book and the price will pop in. So add it to your cart and give the right phone number and address. The books will be delivered to your address. Okay. So at the same way, if you want to buy our classes, so let's say you want to buy CA Intermediate ka FM classes, you can select CA Intermediate and select online classes. You'll be able to get all the subjects, whichever subject that you want to buy your classes for. So you can add the product to the cart and you'll get the access immediately. Okay. All right. Coming back to our topic, that is FM marathon. So let's, I'll give you maybe a little bit of idea as to how we'll be doing this marathon. Okay. One, this marathon is not a substitute class, guys. So it's not a substitute for your regular batch. Okay. Because in marathon, we'll be trying to cover all the concepts or all the important concepts and question in as short time as possible. Okay. So this particular session will be helpful for only those guys who have already studied the subject once. It's not necessary you should have taken the class, FM class from me itself. You might have taken it from any other faculty or you could have done your self-study. But at least once the preparation should have been done. If that is done, then the revision or the session that we're going to do now will be a lot more helpful to you. As I already told you, we'll be covering the concepts with the help of our colored chart book. And in this session, we'll not only be doing the concepts, we'll also be applying those concepts, meaning we'll take up certain examination questions to know how the FM concepts that we learn are being applied in examination. Okay. So those are the few things. And one more thing is we will try to cover, since the intention of this session is to help on your last day revision, the pace of the class will be little bit higher or little faster than what we apply for our regular batch, because we want to cover as much as possible in the shortest possible time as feasible or possible. Okay. So yeah, so those are some of the things. So let's dive into the topic without delay then. The first session that we'll be taking, or the first topic that we'll be targeting, is ratio analysis. Now, ratio analysis means you can express the ratio in percentages or in times, etc., etc. But for you to calculate ratio, there must be some numerator and there must be some denominator. So numerator upon or numerator divided by denominator will give you a component that we refer to as a ratio. That could be, that final result could be in percentage or it could be in number of times or whatever. Is that okay? But random numbers should not be in numerator and denominator. Whatever numbers you put in numerator and denominator, no, there must be some connection between them. Okay. All right. That's what we'll be doing. That's the reason the name is a ratio analysis. So there must be some connection between that numerator as well as denominator. The first set of ratio that we'll be doing is liquidity ratios. First liquidity ratio is current ratio. Current ratio is given by current assets divided by current liabilities. This particular ratio is trying to analyze whether the company has enough current assets to pay off current liabilities. Okay. The ideal current ratio is 2:1, they say, meaning for 1 rupee of current liability, you should have 2 rupee of current assets. Ideal, not necessary in every case. That's what is, the industry norm is 2:1. Then quick ratio. Quick ratio is nothing but quick assets divided by current liability. And how do you get that quick assets? It is nothing but current assets minus stock And if you have any prepaid expense, you can reduce that as well. That divided by current liability will give you quick ratio, or this is also known as acid test ratio. Okay. All right. So this ratio is trying to analyze whether the company has enough quick assets from which they can pay off current liabilities. That is what this particular quick ratio is trying to assess. Okay. So these are your liquidity ratios. So basically there could be more also, more liquidity ratio. I have put in those ratios that are often being tested in examination. Okay. So that's the reason we'll be covering them in the today's session. Okay. All right. So liquidity ratio basically means whether the company has enough cash to settle their liabilities. Now, COVID is a perfect example. When COVID-19 hit or when that lockdown was in place, many organizations shut down, small organizations. Why? They did not have enough liquidity ratios, or they were not cash rich. Only those organizations which were cash rich, they survived. Many of the business, in fact, had to be shut down. Okay, that's what liquidity ratios tries to measure basically. Okay, how liquid are you? What is your liquidity position? Okay. All right, that's one. The next one is capital structure ratio. Capital structure ratio tries to analyze how have you raised your finance. Okay, because the finance you could raise in the form of equity shares or preference shares or debentures, or you could have taken a bank loan. Okay, so we are trying to analyze how have you formed your capital or how have you taken the finance. First capital structure ratio is debt to equity ratio. Debt to equity ratio is given by the formula total outside liability or total debt divided by total equity. Total equity here refers to shareholders funds or shareholders equity we say, or we can also call it as net worth. Shareholders equity is nothing but equity share capital plus reserves and surplus. This we call it as shareholders equity, or you can also call it as net worth or NW, we can refer it. Basically, so let's say you calculate, let's say the total debt was the 10 lakh rupees and equity share capital plus reserves and surplus put together is 5 lakh. So you did debt to equity ratio calculation and total debt is 10, total equity is 5. That means the final number you're getting is 2. What this means is for 1 rupee of equity, meaning if company takes 1 rupee of equity, okay, then for that they have 2 rupee of debt. For each rupee of equity, they have taken 2 rupees worth of debt. And this particular ratio analyzes, so many of them watch out for this ratio because debt is a risky business. Yes. If you take a loan from bank or if you issue debentures, every month or every year or every 6 months, the company has to pay the interest. Yes or no? You have to make periodic payments. Yes. So whether you make profit or you make loss, whether the company makes profit or whether the company makes loss, they have to pay interest on the debentures or interest on bank loan. They cannot escape from that. So debt is a risky affair. So this particular ratio is often used in the industry. Okay. Ideally, we say debt equity ratio should be in the ratio of 2:1. Meaning, if you have issued 1 rupee worth of equity, then the maximum debt you should raise is 2. All right. Not beyond that. Some of them watch out for this ratio. Accordingly give you the loan. So that is what this is trying to measure. The relationship between debt and equity. How much money have you raised through debt? How much money have you raised through equity? That is what this is trying to capture. All right. Next is proprietary ratio. Proprietary ratio is given by the formula proprietary funds divided by total assets. And what do we mean by proprietary funds? Proprietary funds means owners' funds. Owners are whom? Equity shareholders and preference shareholders. So proprietary funds is given by equity share capital plus reserves and surplus plus preference share capital. If you add all of this, you're going to get proprietary funds. Proprietary funds divided by total assets will give you proprietary ratio. So what does proprietary ratio mean? Proprietary ratio means how much of owners' funds have been utilized to buy the assets of the organization. How much money from the owners have been utilized to buy the assets of the organization. To buy the assets, anyway, you need money. Okay. You could have taken that money either from the owners or through a bank loan. So this particular ratio analyzes how much owners' money have been used to buy off the assets. That's what is the implication or the analysis of this particular ratio. Okay. Next is coverage ratios. Okay. First coverage ratio is interest coverage ratio. It's given by the formula EBIT, as in earnings before interest and tax divided by interest. EBIT divided by interest will give you interest coverage ratio. So what does this mean? Let's say EBIT is of a particular company is 10 lakh rupees. Interest, let's say, on their debentures or on the bank loan, meaning the total interest that the company has to pay, let's assume it to be 1 lakh. So if you calculate EBIT, that is 10 lakh divided by interest, that is 1 lakh, you're going to get the number to be 10. What this particular ratio is trying to calculate is how much profit is available with the company so that they can pay the interest. Here, check how the company has a profit of 10 lakh, but the interest is only 1 lakh. That means using the company's profit, 10 times interest can be paid. 10 times interest can be, the company has the capability or capacity to pay interest for 10 years. That is what this interest coverage ratio is trying to calculate. Meaning whether the company has enough profits to pay the interest. And bank people and debenture holders will closely watch out for this ratio. Why? Because they want this coverage ratio to be as high as possible. If this number, if it is as high as possible, then they will full chillax. Because they know if this number is high, what does it mean? If let's say this number is 15 times, then the company has a profit to pay the interest for 15 years or 15 times interest, that much of profit they have. So the more the company has a profit, the bank loan people and all will be chillaxing. Why? Because they know that the company will not default on their interest because company has enough profit. Okay. If this ratio is on the lower side, then they will be full buku, meaning tension. Why tension? No money means how will the company pay interest to the bank people? Yes. So they'll closely watch out for this. That's your interest coverage ratio. Basically trying to calculate whether the company has enough money or enough profits to pay off the interest. That's it. Okay. Next is preference dividend coverage ratio. Same like that. For interest coverage ratio, the formula was EBIT divided by interest. Now you tell me, for preference shareholders, is EBIT available? No. From EBIT, you have to deduct interest. You're going to get earnings before tax. From earnings before tax, if you deduct tax element, you're going to get earnings after tax. Meaning only after paying the tax to the government, whatever profit remains, from that only companies can distribute preference dividend. Hence, instead of EBIT in the numerator, we'll take it as earnings after tax in the numerator. Okay. EBIT here will become EAT, as in earnings after tax, divided by, what are you finding now? Preference dividend coverage ratio. No? So the denominator will be total preference dividend. Okay. So again, same like interest coverage ratio, this analysis also is same. Let's say earnings after tax is 5 lakh rupees. Preference dividend is 1 lakh rupees. So when you calculate this, you get it as 5 times, meaning the company has enough profits to pay the dividend 5 times. Okay. That's what this coverage ratio is trying to calculate. Similarly, if you want to calculate equity dividend coverage ratio, now you tell me, is earnings after tax available to equity shareholders? No. From earnings after tax, first you have to pay whom? Preference shareholders ka preference dividend. So from earnings after tax, you have to deduct the preference dividend. Okay. Or when you deduct this, whatever money is available, that money is available to be or is available for equity shareholders, which in our class purpose we used to call it as EASH. EASH meaning earnings available or attributable to equity shareholders, or you can also call this as net income or NI. Okay. So here instead of EAT for equity dividend coverage ratio, the numerator will be EASH, as in earnings attributable to equity shareholders divided by the total equity dividend. Okay. Again, this ratio is trying to tell you how much profit is available with the company to pay off equity dividends. So all these are coverage ratio. So higher the coverage ratio, better it is for all of them. Better it is for the providers of finance. Okay. That is what is the implication of this particular component. Okay. All right. Next is efficiency ratio. So efficiency ratio is trying to assess whether the companies is functioning efficiently. So to drive that, we have a certain few ratios. Let's dive into them one by one. First is total asset turnover ratio. Asset turnover ratio is given by the formula. The trick of remembering the turnover ratio is whenever there is a turnover ratio, sales will come in the numerator. Okay, any turnover ratio, the sales will come in the numerator. So sales divided. So asset turnover ratio is given by the formula sales divided by average total assets. Sales divided by total assets or average total assets will give you asset turnover ratio. Let's say you calculated this and you got it to be 5. Let's assume that you calculated. You did maybe let's say sales was 10 lakh, total assets was let's say 2 lakh. When you did this, you got the final number to be 5. What this particular component means is, if you invest 1 rupee in asset, if you invest 1 rupee, meaning if the company invests 1 rupee in the form of asset, then from this asset, they will be able to generate 5 rupee worth of sale. Because see, any company, if they want to generate the revenue, means they have to use their asset. Like for us, for the academy, we will get the revenue only by conducting the classes. But to conduct the classes, we require various assets like laptops, iPad, camera, mic, TV, etc., etc. So using those assets only, the company is able to generate the revenue. So that is what this particular asset turnover ratio is trying to assess. If the company invests 1 rupee asset, or if they buy asset worth 1 rupee, how much revenue can that asset generate? Okay, so if this number is 5, then for 1 rupee investment in asset, the company is able to generate a revenue of 5 rupees. That's all is the asset turnover ratio all about. Okay. If you want, instead of total asset turnover ratio, you could also make the formula to be fixed asset turnover ratio. So fixed asset turnover ratio ka formula, you tell me, let's see. What is fixed asset turnover ratio ka formula? The numerator will be turnover or sales divided by fixed assets. So sales upon fixed assets will be your fixed asset turnover ratio. If you get, let's say, that number to be 7, then what does it mean? If the company invests 1 rupee in the form of fixed asset, or if the company invests 1 rupee for fixed asset, then that fixed asset is able to generate the revenue of 7 rupees for this particular company. That's what fixed asset turnover ratio ka implication or analysis is all about. Hope everything is going good for everyone. All right. Again, the intention is, I hope the pace is fine for everybody, because again, all this are being done on the last day. So we have to be little quicker than our normal classes. Hope you're able to understand that. Okay. All right. Next is inventory turnover ratio. Inventory turnover ratio is given by the formula COGS, as in cost of goods sold divided by average inventory. So you told for inventory turnover ratio, sales will come in numerator. Yes. If COGS is not available, then you can substitute with COGS. If COGS is not available, meaning as on COGS means cost of goods sold. If that is not available, then you can substitute with sales. Okay, so why not use sales only, sir? See, sir, inventory is measured. Some of you are account students as well. So you might have studied AS2 as an accounting standard 2. Inventory is always measured at what? Selling price or cost price? Cost price, yes or no? Hence, instead of COGS, the better related number is COGS, cost of the goods sold, not sales. Only if COGS is missing, okay, then take care of sales. Is that okay? First priority, always give it to COGS. Divided by average inventory will give you inventory turnover ratio. Okay, let's say this number is 10. What this means is, how many times in a year the company is able to sell their inventories. If this number is 10, that means in a year, company is able to sell their inventory 10 times. So higher this number or higher the inventory turnover ratio, better it is for the company. Because they are selling more and more goods. Means if the inventory is being sold more and more number of times, then obviously the revenue and the profit of that company will be on the higher side. Hence, inventory turnover ratio has to be a little bit on the, or it has to be on the high, or higher the inventory turnover ratio, better it is. Okay. All right. Next is debtor turnover ratio. Debtor's turnover ratio, you tell me the formula. Debtor, you will take cost now or you will take sales? Sales is the better suited approach. Yes or no? So that means what? The numerator will be sales divided by average debtors. But you think debtors, will it come because of total sales? No. Debtors will only come when you have a credit sale. Yes or no? Only if you have the credit sale, then the company will have debtors because they have to collect the money from them. Yes. If it is cash sale, company has already collected the money. So debtors will not even come into picture. So hence the numerator will not be total sales over here. The numerator will be credit sales. Instead of total sales, here it will be credit sales divided by average debtors. Okay. And one more thing you need to be a little careful in this ratio is, though the name says debtors turnover ratio, no? Okay. Here average debtors means it is, or instead of average debtor, you can substitute with average accounts receivable. Okay, instead of average debtor, you can use the term, though the formula in our study material says this only, but for your thinking process, always take it as, instead of average debtors, take it as average accounts receivable. So what is the difference? Debtor itself is account receivable, no? No. Normally accounts receivable and debtors are same, okay, or one and the same. But actually, what account receivable means? It is a debtors plus bill receivable. Debtors plus bill receivable put together, we refer it to as accounts receivable. Is that okay? So that means when you do this formula, right, or when you apply this, what you're going to get is the not debtors turnover ratio. Effectively, you're going to get accounts receivable turnover ratio. Some problems may they have tested this. Meaning, what happens is some problems may they will give you bill receivable as 5,000 or 10,000. In that case, you have to combine and accordingly take it. Is that okay? So you need to be a little careful. Those, if bill receivable is not there, then average, accounts receivable and debtors component will be same. Otherwise, yes, this is how you need to split it up. Okay. Basically, okay. So what is this formula used for? First of all, what does debtors turnover ratio mean is, let's say this is 4. You calculated this particular component, credit sales divided by average debtor, you got it to be 4. Then what it means is, in a year, 4 times you are able to collect the money from debtors. I'll repeat that. What this debtors turnover ratio means is, suppose you get that to be 4. Then what it means is, in a year, 4 times you are able to collect the money from debtors. So using this debtors turnover ratio, you can get to know debtors collection period. Debtors collection period, or this is also known as a debtors velocity. Sometimes in our question, instead of saying debtors collection period, they also use the term debtors velocity. One and the same. Okay. Debtors collection period means what? How many days credit have we given to our debtors? How many days credit we have given? Let's say a credit period. Normally, when you make a credit sale, you will give some time period to our debtors to pay, right? That we call it as debtors collection period, or also known as debtors velocity. So debtors velocity, how can you get? If the debtors turnover ratio is 4 times, then you tell me, sir, if you are able to collect from debtors only 4 times in a year, that means you have given how many months credit to them? 3 months, no? Because only if you give 3 months credit, so you add it 4 times, no? 3 plus 3 plus 3 plus 3, if you add, you're going to get 12. And there are how many months in a year? 12 months. That means using this, easily you can find out the debtors collection period. Or if you don't want this, you can represent in formula. So debtors collection period is given with the formula 12 divided by debtors turnover ratio. 12 months. If they've expressed the data in months, you can do 12 months divided by debtors turnover ratio. If you want to get it in days, instead of 12 months, you can substitute that with 365 days. So 365 days divided by debtors turnover ratio will give you debtors collection period. If you want it in weeks, you can also substitute this number with 52. So as in 52 weeks. Anything that you want, you can represent and accordingly get it. Okay, fair enough. So that's the intention of debtors turnover ratio and debtors collection period. This is very important, especially these ratios, right, are very much tested in almost every ratio problem that comes in the examination. So these are quite important. Is that fine? All right. Similarly, you can also construct your own. If you understand this, you can also collect creditors turnover ratio. Creditors turnover ratio, can you tell me the formula? How do you calculate? Will it be sales? No. Is sales and creditors is there any connection between sales and creditors? No. So instead of sales, what will you take here? Purchases. Total purchase or only credit purchase? Creditors will come into picture only if there is credit purchase, right? So write credit purchases. So numerator will be credit purchases divided by average creditors, or you can also write it as average accounts payable. Okay. What is accounts payable? Sir, accounts payable is nothing but creditors plus bills payable is your average accounts payable. Okay. If bills payable is not given in the problem, then accounts payable and creditors will be one and the same. You can interchange it. Only if they have given bills payable in the problem, then just check out. Is that okay? then you need to be a little careful when you're working out the ratio problems. That is one area. I think we have done in our regular batch, we have done 1 or 2 problems that had this particular adjustment. Okay. All right. Since it's a revision session, I can't take you through all the problems now. So I can only give you certain hints or certain adjustments which come in the problems. Okay. All right. This is your creditors turnover ratio. So that means, let's say this is 3. If you get this to be 3, then what it means? In a year, the company is paying to the creditors 3 times. If you get this number, what it means is how many times in a year company is paying their creditors. Using creditors turnover ratio, companies can find out creditors payment period or creditors credit period. Normally creditors also will give you some payment or credit period. That you can find. How can you find out? Same thing. 12 divided by creditors turnover ratio. How much is creditors turnover ratio? 3. That means this will be 4 months. Why 4 months? Because I've taken this 12 months in the numerator. So the final number you're going to get will be expressed in months. If you want to express it in days, instead of 12, you can take it as 365, or also you can take it as 52 weeks and accordingly work it out as well. So these are basically some ratios using which you can find out, or rather these two are used to find out creditors. These two ratios relating to debtors are used to find out debtors. In ratio problems, it is more like fill in the blanks Wacc question. All these some ratios they will give you. You need to find out how much is debtors, how much is creditor, how much is inventory, etc. etc. So taking these help will be finding out those missing components. That's how ratio questions gets asked in the examination. Okay, so far fine for everyone. All right, then move on to the next one, that is profitability ratios. First profitability ratio, all of you have done it since your bachpan or your golden days. GP ratio, that is given by the formula GP divided by sales into 100. So that means this is trying to say what percentage, if let's say GP percentage is let's say 40%, then it means of your sale, 40% of your sales represents profit element or gross profit. Gross profit to calculate, gross profit generally in your 11th standard and all you have done. Gross profit you will get when you prepare trading account. And trading account considers only direct expenditures. So using direct expenditures and direct income, you will get a profit that is known as gross profit. Okay. All right. Next is the net profit. Net profit is given by the formula net profit upon sales into 100. Net profit is the final profit. Okay. After considering all the expenses, whether direct or indirect, operating or non-operating, doesn't matter. After considering all the expenses, all the income, what is the final profit made by the company? That to be referred to as net profit. Okay. All right. So in between gross profit and net profit, you also have something known as operating profit. Operating profit is nothing but we call it as operating profit ratio is given by the formula operating profit divided by sales into 100. That operating profit only we call it as EBIT, as in earnings before interest and tax. We refer it to as operating profit. So operating profit ratio is given by the formula EBIT upon sales into 100. So why is this necessary? Why don't we work only with GP and NP? See, GP considers only direct expenditure, direct income. Okay. So this only considers direct expenditure, direct income. Net profit considers total expenditure and total income. Operating expenditure or operating profit ratio considers only operating expenses and operating income. So what is the difference? Sometimes the business will also have certain non-operating expenditures. Like if you want to take an example, investment income. Let's say company had some surplus money. They didn't want some money for their business. So what they did is they purchased some investment. From that investment, they're going to earn some investment income. Yes, that is not like if the coaching center, ArivuPro Academy is now a coaching center, right? So our main business is to provide coaching. That means all our revenue or sales should come due to the coaching business. Yes or no? Suppose ArivuPro Academy we had some surplus money and we purchased some investment. We invested in, let's say, State Bank of India ka fixed deposit. That means we're going to earn some interest income, correct? Is that interest income related to my business, related to my coaching business? No, right? But those income and expenditure will be considered for net profit calculation. So if you want to know how much is the income or how much is the profit percentage that you are able to generate from your core business or main business, that you will get it with the help of operating ratio. Hence, we take EBIT upon sales into 100. So this particular ratio will only give you the profit or loss relating to your main operations or core operations. That's all. Okay. Yes, guys. All right. So operating cost. So to conduct the business, you will have some direct expenditure as well as some indirect expenditure. So COGS plus operating expense. If you do operating expenses means your selling and distribution or administrative and selling and distribution expenses. Okay. Like, see, to conduct the coaching, we require teachers. So the fees paid to the teachers, fees paid to the employees, all those are direct expenditures. Correct. But same coaching, no, our coaching academy means we have to get our books audited by a chartered accountant. So that means we have to pay some fees to our auditor. Yes, though we are auditors, we can't audit our own books, right? We have to get somebody else. Somebody else should check our books. That another auditor. So fees paid to chartered accountants, or fees paid to company secretary, fees paid to lawyers, etc., etc. Or accountant ka salary. All this will be part of your administrative and selling and distribution overheads, we call them. That only we refer to as operating expenditure. Okay. All right. These are this thing. And next one is return on assets. Return on asset is given by the formula. There are two ways to calculate this. One, you can take profit after tax divided by average total assets. Or see, you can do average when 2 years data is available. If they give you 2 years data, then there is a possibility for you to find out average. If they give you only 1 year data, then you can substitute average with total assets. Meaning instead of average asset, you can simply take total assets. Is that okay? All right, this works in almost every of the ratio problem. Check the data and accordingly see what you have to take. Whether should you have to take the total number or average number. Like that. Okay. So return on asset is given with the formula profit after tax divided by average total assets or total assets. Or there is another formula for it, that is EBIT into 1 minus tax rate divided by average total assets into 100. If you do only this, you're going to get a full number. If you want to express it in percentage, multiply it by 100. Normally, returns are all expressed in percentage. So multiply it by 100 for all the numbers. Okay. So this is your return on assets. EBIT into 1 minus tax rate divided by average total assets. Once you multiply 1 minus tax rate, no, it is after tax basically. Once you do 1 minus T, you're going to get earnings after tax, because EBIT means what? Earnings before interest and tax. So we want to know earnings after tax. Hence we do 1 minus tax rate. Okay. So that's your formula to get that. So basically this particular ratio is trying to assess. See, company has invested in some assets. Let's say we have purchased assets worth 10 lakh rupees. Okay, we purchased the assets. We purchased all our laptop, camera, blah, 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 to conduct our classes. So the total cost of that asset is 10 lakh rupees. Okay, so we are using that those particular assets to run our coaching business. Let's say we earned a return of 1 lakh rupees. That means you tell me how much is the return percentage I'm able to generate. Using 10 lakh worth of asset, I'm able to generate a return of, see, this is a return and this 10 lakh is the assets. With the 10 lakh worth of asset, I'm able to generate a return as in profit of 1 lakh rupees. So what is the return percentage? Return percentage is given with formula return divided by total assets into 100. So 1 lakh divided by 10 lakh into 100, that is 10%. That is what this particular ratio is trying to assess. How much your return you are able to generate from the assets. Higher this return, the better it is, because higher this number, higher this return on asset, more efficiently the company is utilizing their asset. That's what it indicates. Okay. All right. That is one. Next is ROEs, not your Valentine's Day rose. Here ROEs means return on capital employed. Return on capital employed, or ROEs as we call it in our class, is given with the formula EBIT divided by capital employed into 100. Okay. EBIT upon capital employed into 100 will give you ROEs. Capital employed means all your long-term source of finance, meaning from what and all source has the company taken the money. See, one source of finance could be your equity share capital and reserves and surplus. Yes. Another one could be your preference share capital. Other one could be your long-term debts. Yes or no? Meaning the company would have issued some debentures or they could have taken some long-term loan. All this we call it as capital employed, meaning the source of finance. Okay. So what this rows is trying to calculate is, okay, you have taken the finance. Let's say we took a finance of, let's say 10 crore rupees. The company from various sources, from equity shares, preference shares, loan, debentures, they've taken the money from all the source worth 10 crore rupees. That only we call it as capital employed. After the company raises money, what they'll do? Will they keep it idle? Or will they keep it idle? No. They will use that money to run the business. Yes or no? They will use that business or use that money for the sake of business. So when you run a business, eventually you'll get some profit or loss. That only we call it as EBIT. Let's say using this 10 crore rupees, the company is able to generate an earnings of or a return of 1 crore rupees. Using this 10 crore rupees, the company is able to generate a return of 1 crore rupees. So what is the percentage? Can you tell me? What is the percentage return? That is nothing but 1 crore divided by 10 crore into 100, which is 10%. That only we call it as ROEs, return on capital employed. Meaning using capital, the company is able to generate a return of 10%. Again, higher these returns, the better it is, because the company is using the funds more efficiently, is the implication that, or the conclusion that you will be able to draw. Okay. So this is the ROEs or on a pre-tax basis. You can also calculate ROEs on a post-tax basis, meaning after-tax basis. So hence, what will be the number? If you want to get after-tax number, you simply have to do 1 minus tax rate ka multiplication. So what, instead of EBIT being numerator, your numerator will be EBIT into 1 minus tax rate. EBIT into 1 minus tax rate divided by capital employed into 100 will give you the return on capital employed post-tax, after tax. That's all. Okay. So which one to follow in examination? If they don't mention what kind of ROEs you need to calculate, whether it's pre-tax or post-tax, one safe option is to calculate both and show it off. Or any one you show and write a note saying in examination, I have calculated return on capital employed on a pre-tax basis, or I have done it on a post-tax basis. Like that, you can give a note and you should be given the marks. Sometimes they will only mention calculate on post-tax basis. In that case, you have to calculate it on post-tax basis only, compulsorily, no choice. Okay. All right. Return on equity. Return on equity is trying to ascertain how much return the company is able to generate by using equity shareholders funds. By using equity shareholders funds, how much return the company is able to generate. Hence, what will be the formula? We know that the denominator is equity. Equity here stands for equity share capital plus reserves and surplus. Okay, that's what we mean by equity. You can either call it as equity, or you can call it as shareholders funds, or shareholders equity, or net worth. All these are same names, meaning the same components, different names but same thing. Okay, so return on equity is given with the formula. You can't write EBIT, because is EBIT available for equity shareholders? No, because from EBIT first you have to pay interest, then you have to pay tax, then you have to pay preference dividend. After all this, what earnings remains, that only is available to equity shareholders. Yes. So if denominator is relating to equity shareholders, the numerator also should be relating to equity shareholders. That's what I said. Between ratio means there should be a connection between numerator and denominator. Any random numbers you can't write. Hence, what return is available to equity shareholders? EBT, EAT? No. Each as in earnings available to equity shareholders. Hence, the formula is each divided by net worth, or you can simply write each divided by equity share capital plus reserves and surplus into 100. Okay, so that gives you a return on equity. Net worth I've called out here. It is nothing but equity share capital plus reserves and surplus. Okay. Next is dividend payout ratio. So I've called out all this only. There are many ratios in our book, but I've called out these many because these are something which are getting many times repeated in the examination. Okay, these are the examiner's hot favorite ratio. Hence, we are covering this. All right. Next, dividend payout ratio. Dividend payout ratio means out of the earnings, how much dividend the company is distributing. I'll repeat that. Dividend payout ratio means out of the earnings, how much dividend the company is, or how much dividend the company is distributing. Let's say earnings per share, EPS is 10 rupees. The company is giving a dividend, EPS as in earnings per share, DPS as in dividend per share. Let's say dividend per share is 4 rupees. So out of 10 rupees earnings, entire 10 is the company distributing to equity shareholders? No. They are giving how much to equity shareholders? Only 4. That means, can you tell me what is the dividend payout ratio? How much is dividend? Can you express this in percentage? That only is nothing but dividend payout ratio. Dividend payout ratio is given with the formula DPS divided by EPS into 100. Do that, 4 divided by 10 into 100, which is nothing but 40%. Meaning, how much our company earns, no, this particular company, how much ever they earn, 40% of their earning, they distribute to equity shareholders as dividend. Meaning, 60% they will retain. So 60% becomes retained earnings, 40% becomes your dividend. That's all is your dividend payout ratio. Are we okay? And one more thing probably you need to remember about dividend is, dividend could be asked in multiple ways. Sometimes in the problem you may say dividend declared. Sir, dividend declared means you should apply it on face value. Like if they say dividend declared is 20%. Let's say equity share capital ka face value is a 10 lakh. Then you will calculate, okay? Then the dividend amount will be 10 lakh ka 20%, which will be 2 lakh rupees, like this, okay? If they ask you dividend declared percentage, which normally they don't, but just in case for clarity, if they ask you dividend, not dividend payout ratio, if they ask you dividend declared percentage, then dividend declared will always be on the face value. So here the formula will be dividend divided by face value into 100. Check. Dividend is 2 lakh, face value is 10 lakh into 100. If you do, you're going to get 20%, like this. If they use the term dividend declared, then it is on the face value. If they use the term dividend payout, then the component is on earnings or earnings per share, like this. Okay. All right. There could be one more way than which they can ask as well. That is a dividend yield. Anyway, which will come here next only. Dividend yield. Okay. If they use the term dividend yield, then the formula will be DPS divided by MPS into 100. Yield is always on the market price. So these are the same, the terminology is same, dividend. But what dividend they use is very important. If they use the term dividend payout ratio, it is applied on EPS. If they use the term dividend declared, then it is applied on face value. If they use the term dividend yield, then that yield represents on the market price. Meaning, let's say market price of the share is 10 rupees. Market price of a particular company. If you want to buy, let's say, one company ka share, that company ka share is trading in the market at 10 rupees. Let's say that company is giving a dividend of 2 rupees on one share. Assumption. That particular company is giving a dividend at the rate of 2 rupees on one share. So can you tell me what is the dividend percentage they are declaring? Dividend percentage they are declaring. That only we call it as a dividend yield. Dividend yield. That is given with the formula DPS divided by MPS into 100. DPS divided by MPS into 100. Okay. DPS is 2 rupees, MPS is 10 rupees into 100. If you do, you're going to get to be 20%. Like that. Okay. Same components, but different terminologies. I hope you got the funda there. Okay. So I have written all this. Okay. Dividend yield just now which I discussed is also given here itself. So as we were saying, the dividend. So whenever they give you dividend in the problem, always check the word what they've used. If they use the word dividend payout ratio, then apply it on EPS. If they use the term dividend declared, then apply it on face value. If they use the word dividend yield, then apply it on MPS. Check and accordingly do the problem. This is the various ways in which they can test on the dividend adjustment in the examination. Then last one is the PE ratio. PE ratio is given by the formula. The name itself is saying price earning ratio. PE. Price here stands for the market price. So that is given by the formula MPS divided by EPS. So market price per share divided by EPS is equal to price earning per share. Let's say you get this number to be 10. What it means is, okay, if you get this number to be 10, what it means is for 1 rupee earning of the company, for 1 rupee earnings of the company, the investors are willing to pay 10 rupees. For 1 rupee earnings of the company, the investors are willing to pay 10 rupees, meaning they're willing to pay the premium and buy this company ka share. Why? Currently, the earnings of the company may be 10, but in future, it will grow, right? So hence, they are ready to pay the premium and buy off the share. That is the significance of PE multiple, price earning multiple or PE ratio. Okay. So then we have a small section of limitations of ratio. There are certain limitations of ratio because one ratio is impacted by inflation. During inflationary environment, if your cost increases, then the ratios of this year and the ratio versus of the previous year may not be comparable. Okay, because it is depend on the data. If data is garbage mean, the result is also garbage. That's what they say, no? Garbage in, garbage out. So it is seriously affected by the inflation. It is affected by the seasonal nature of business. Like during winter, okay, so if you are an ice cream dealer, the sales during the winter will be less, but during summer season the sales will shoot up. So ratios will not capture all that stuff because you are taking whole year data without considering the season into picture. So that is one of the limitations of ratios, and can be manipulated due to year-end adjustments. Like you can make some provisions for doubtful debts, you can make provision for inventory. Like this, you can make some accounting adjustments or year-end adjustments, and accordingly get the desired output in the form of ratios. That could be one of the disadvantages. And you cannot generalize, meaning one ratio, if you get it to be like inventory turnover ratio, you got it to be 10. Just by looking at that one number, you can't say whether it is a good company or a bad company. Okay, just by ratios, you cannot analyze that. You have to use various information, meaning along with various information, ratio could be add-on for analysis. Just using ratio, you cannot draw to any particular conclusion. That's some of the limitations associated with ratios. Let's do a thing. Okay, let's not just leave it at the concept level. Let's also apply the ratios or how they ask the ratios in the examination. Let's learn that. This question was asked in July 2021 paper. Let's see what they have asked. Masco Limited has furnished the following ratios and information relating to year ended 31st March 2021. They've given sales 75 lakh. Return on net worth, we already know. Return on net worth is given with the formula profit after tax divided by net worth into 100. Or like that's what is the return on net worth, right? Return divided by net worth into 100 will give you return on net worth. That's all. Okay. That they've given it to be 25%. Fair enough. Then they've given income tax rate to be 50%. Share capital and reserves is in the ratio of 6:4. So between share capital and reserves, they are in the ratio of 6:4. All right. So here how they've corrected is, if you know profit after tax, using that you can find out net worth. And net worth only is nothing but what, sir? Just now we learned net worth is nothing but your equity share capital plus reserves and surplus. If you know net worth, okay, you can calculate equity share capital and reserves and surplus also. Why? Because these two put together only is net worth. And they're saying between equity share capital and reserves and surplus, they are in the ratio of 6:4. Okay. Current ratio is 2.5. So we know current ratio is nothing but current assets divided by current liability. That they're saying is 2.5. Net profit to sale after income tax. Okay. So net profit after tax is to sale is 6.5%. So they're trying to say net profit is 6.5% of sales. You know sales already. So with the help of this, you can find out net profit after tax because they've used the term after tax over here. Inventory turnover ratio, they're saying based on the COGS. As I told, right? Inventory turnover ratio ka formula is COGS divided by average inventory. You can use average inventory provided they've given you data for 2 years. Here, if you just check, have they given data for 2 years or only 1 year? 1 year. Then instead of saying COGS divided by average inventory, here you can write inventory turnover ratio is nothing but COGS divided by closing stock. Okay. Because we assume that if data is not given, then opening stock, closing stock, average stock, all are same. That's the assumption. We go ahead and do this particular or these sort of problems. Okay, so that they've given it to be 12. We'll see why they've given that. COGS they have given, interest on debentures they have given, receivables they have given. Just now I told receivable means debtors and bill receivable put together. Debtors plus bill receivable is your debtor. Total receivable is 2 lakh. In that debtor, they're saying is 1,25,000. That means bill receivable is 2 lakh minus 125, which is 75,000 is your bill receivable. Payables, they have given it to be 2.5. Bank overdraft is 1,50,000. So these two are your current liability. Correct? These two put together are your current liability because bank overdraft is a short-term loan. So total current liability is how much? 2.5 plus 1.5, which is 4 lakh. They gave you current ratio in the problem. Current ratio is nothing but current assets divided by current liability. Since you know current liability, you can easily find out current assets also using that. Okay. Now the requirements. Calculate operating expense for the year ended 31st March 2021. That they are asking. Okay. And prepare balance sheet in the following format. So first is operating expense. Now fatafat we can do it off. Operating expense we need to find out. Okay. You already know this format. You have done sales minus COGS. If you want, you can have some columns as well here if you want to know the presentation aspect. Particulars, and then we'll have workings, and then we'll have amount column. Okay, I'll try to work it out as soon as possible. Okay, all right, first is sales. From sales, if you deduct the COGS, you're going to get sales minus COGS will give you GP. From GP, if you deduct operating expenditure, you're going to get EBIT, meaning earnings before interest and tax. From this, if you deduct interest, you're going to get earnings before tax. From that, deduct the tax, you're going to get earnings after tax or profit after tax. Now check what have they given in the problem, in this particular problem. Do you know earnings after tax or profit after tax? Yes, they have told that to be net profit after tax to sale is 6.5%. So net profit is 6.5% of sales. Sale is 75 lakh. This costs 6.5% if you calculate. There's a working that I'm putting it up. So 75 lakh into 6.5% will give you 487,500. This is the one. And they told tax is at the rate of, see somewhere they told tax is at the rate of 50%. So tax is at the rate of 50%. We know if profit before tax is 100 rupees means, and tax is payable to the government at the rate of 50% means what will be tax? 100 ka 50%, which will be 50. That means what will be profit after tax? 50. Meaning if tax rate is 50%, then the tax amount and profit after tax amount will be same. Okay, only at 50%. Here is a tax 50%. Yes. So if profit after tax is 487,500 means tax also will be same as PAT or earnings after tax, which will be 487,500. That means what will be earnings before tax? Earnings before tax will be double of that because this is 50, this is 50. Earnings before tax will be at what percentage? It will be at 100%. No? So you can calculate 487,500 into 2 times of that. So 487,500 into 2 will give you 9,75,000. From 975, if you deduct 487,500, you're going to land up with 487,500 like that. Okay. Interest check. They have only given the interest on debentures to be 75,000. So this is given in the problem. No need to work out. That is 75,000. That means what is EBIT, sir? This minus 75 is 975. That means what is that EBIT? That is nothing but 9,75,000 plus 75,000. Now we have to work backwards. That's all. So that means EBIT is the 10,50,000. Operating expenditure only is they're asking us to find out. Sales have they given? Yes. Sales they have only given in the problem to be 75 lakh. COGS as in cost of goods sold, they have only given 22.5 lakhs. Okay. That means how much is your GP? From 75, if you deduct 22.5, your GP is 52,50,000. GP minus operating expense, if you do, you should get 10,50,000. Therefore, what is your operating expenditure? Operating expenditure is nothing but 52.5 lakh minus 10.5 lakh. That will be how much? 42 lakh is your operating expenditure. That's how we got it. You can present in multiple ways. This is how I am choosing to present. That's why COGS is given. Okay. You can check the answer. They have presented in multiple way, but just check the final answer. That is 42 lakh rupees is the operating expenditure, and we also got 42 lakh itself. That's okay. That's the first requirement. Second requirement, using the ratios, you need to find out the balance sheet is what they are saying. Okay. Sir, you know profit after tax? Yes, 487,500. We'll go from the top. Return on net worth they have given. Return on net worth is given with the formula return. Return here stands for profit after tax. Because net worth belongs to shareholders, equity shareholders. Only after paying a tax, you can give the earnings to equity shareholders. That's the reason it is PAT. Okay. So PAT divided by net worth is equal to 25% is what they have told. So we can put working note number 1 to find out net worth. So they have given return on net worth. That is given by PAT divided by net worth is equal to 25%, which is 0.25. PAT we already know, which is 487,500. So 487,500 divided by net worth is equal to 0.25. Therefore, how much will be net worth? 487,500 divided by 0.25, which is 19,50,000 is your net worth. Net worth means what? There's nothing but equity share capital plus reserves and surplus. And they told you in the problem, equity share capital and reserves in surplus is in the ratio of 6:4. Equity share capital and reserves in surplus put together is your net worth. So net worth is in the ratio of 6:4 means what is equity share capital? Equity share capital will be 19,50,000. You have to distribute in the ratio of 6:4. So into 6 by 10 you do. That will be 11,70,000. Therefore, your reserves and surplus will be balance. From 19.5, if you deduct 11.7, you're going to get the balance to be 7,80,000. Or you can also calculate as 19,50,000 into 4 by 10. That's your net worth. So two component of balance sheet we already worked out. See, equity share capital 11,70,000, reserves in surplus 7,80,000. So that is done. Easy. Okay. Anyway, all such problems, many such problems we have done in the class. Now, in the interest of time, I'm trying to do it as quickly as possible. Hope everyone is able to establish that connection. Okay. All right. Next. Sir, they have given current ratio. Current ratio is 2.5. Okay. That means what will be your current assets? Current ratio is nothing but current assets divided by current liability, which they have given it to 2.5. So that means current assets is equal to 2.5 times the current liability. Do you know current liability? Yes, we just now wrote payables plus bank overdraft is your current liability, which is 4 lakhs. So 2.5 into 4 lakhs will give you a current asset to the extent of 10 lakhs. Okay, let this number be as it is. This is working note number 2 for current assets. Let's see next what we can find out with using the question. They have given this, okay, inventory turnover ratio they have given based on COGS. So how do you get inventory turnover ratio? So with this help, we can find out closing stock. Okay, inventory turnover ratio is given by the formula COGS divided by average inventory. But since they have not given average data, instead of average stock, I will write it as closing stock. This is only your inventory turnover ratio, the formula. Inventory turnover ratio, they have only given in the formula problem to be 12. So this is equal to 12. COGS, they have only given it to be 22,50,000. So 22.5 lakh divided by closing stock is equal to 12. That means the closing stock will be 22,50,000 divided by 12. So closing stock will be 187,500. Check if they got the same number. Closing stock 187,500. That's a closing stock we are at. Great. Closing stock we got. Receivables, they only given. Receivable means debtors and bill receivable put together. That they have only given in the problem to be 2 lakh. So this we got it to be 187,500. Total of current assets, don't you know? Yeah, just now we found out total of current asset is 10 lakh. That means you can put up working note number 4 to find out the last component, which is what? Cash. How do you get cash? So current asset is nothing but stock, as in closing stock plus receivable net closing stock plus receivable plus cash. Current asset is 10 lakh, closing stock is 187,500, receivables they have only given it to be 2 lakh, cash we don't know, let's find out. So if you solve this, you're going to get cash to be, cash is nothing but 6,12,500. That's your cash element that they have taken. All this put together is your current assets, which is 10 lakh rupees. So all this component we worked out. Okay. All right. Next what have they given? COGS is okay. Interest on debentures, they've given 75,000 and they told these are 15% debentures. So how do you get debenture interest? Debenture interest is nothing but debenture value or debenture amount multiplied by the rate of interest. From the debenture value, if you multiply rate of interest, you're going to get the debenture interest. Here, interest on debentures, they've given it to be 75,000. Debenture value, we don't know. These are 15% debentures. 15% means 0.15. Therefore, what will be debenture value? Therefore, debenture value will be 75,000 divided by 0.15, which will be what? 5 lakh rupees. So basically, debenture value is given by the formula. If you want to know it as formula, that is nothing but debenture interest divided by rate of interest. So that is your debenture value, which is 5 lakh that they have got. Okay. All right. Next, what have they told? Receivables we have already plugged in. Payables also 2,50,000, 1,50,000, which we can plug it in. So liability side total, everything we have got it. All this, if you add it up, you're going to get 28,50,000. On the asset side, you'll only have fixed asset and current assets. Total is 28,50,000 because total liability side and total asset side should match. Okay. If current asset is 10 lakh and the total is 28.5 means fixed asset, you can get it as balancing figure, meaning 28.5 minus 10 lakh, which will be 18,50,000. So that's how you can work out, or that's how the ratio problems gets asked. It's more like fill in the blanks wala questions. Some they give you, some they don't give you, which you have to find it out. Okay. That's all is how the ratio. This problem came for in the July 21 paper for about 10 mark. Easy question. Okay. I know that I have done it a little faster, but I hope you can understand that. Okay, we are in the last day revision mode, so we have to be a little faster. Otherwise, this session will go for a really long time. Okay, so that's with respect to ratios. So one we have already done. Now let's move on to the next topic, that is cost of capital. Okay, what does cost of capital mean? See, sir, if you want to do any business, you need funds. Correct. If you want to do any sort of business, you need funds. You can raise that funds either by issuing equity shares or preference shares or debentures or bank loan. Bank loan and debentures, we call it as debt, right? So from some source of finance, you need to take the money. Otherwise, you cannot do the business. Correct. So each source of finance, suppose you want to issue equity shares. That means you have to raise the money by issuing equity shares. Means, can the company raise equity shares with zero cost? No. Nobody will give the money at free of cost. If banks give you a loan means, badle mein they will expect interest. Yes or no? So there will be, for each source of finance, there will be a cost associated with it. Okay. To get a bank loan, the interest rate may be 10%, like that. Yes. For each source of finance, there is a cost element associated with that. That is what we are trying to compute in this particular topic. For various source of finance, what is the cost associated with it? Okay. And here cost means, okay, cost of capital means the return expected by the providers of finance. Suppose the company wants to raise the money means, okay, from equity shares means how much return the equity shareholders are expecting. That to be referred to as cost of capital. Cost of capital means not the actual amount paid by the company. It is the return expected by the providers of finance. Like if the company is issuing preference shares, then preference shareholders will expect a return. Yes, that we call it as cost of capital. For the company, it will be a cost, but for the preference shareholder, it will be a return. The return expected by the providers of finance, we term it as cost of capital. That's the first thing. Okay. So you have various sources of finance like equity, preference, debt to and all. For each source of finance, how to calculate the cost of debt is what the scope of this particular topic is all about. So let's, without delay, let's dive into it. First, if you have a debt as in debentures or a bank loan, how do you get the cost of debt? Before you find out cost of debt, that we call it as, it's expressed as KD, as in not Kannada KD, okay? Here, cost of debentures, okay? So cost of debentures, you have to, before you calculate that, no? First check whether these are redeemable debts or irredeemable debts. Redeemable debt means after some point of time, you need to repay that money. After some point of time, if you have to repay the money, we call it as redeemable debts. No, the company does not have any obligation. It will continue forever. If that is the nature of the debt means, it will be irredeemable. Generally, all the debts will be redeemable only, but it's there in our book, so we need to study. So if it is irredeemable debt, then the cost of debt is given by the formula interest rate, as in I into 1 minus tax rate divided by net proceeds. I into 1 minus tax rate divided by NP will give you the cost of debt. I here stands for interest rate, T here stands for tax rate, NP here stands for net proceeds. So why do we have to compute that? Suppose the company has issued the debentures. On that debentures, let's say the interest rate is 10%. The company has issued debentures, and on these debentures, company has to pay interest at the rate of 10%. Simple. The company is paying 10% means shareholders are or debenture holders are receiving 10%. Why can't we directly take 10% itself as cost of debt? Easy, no? Why to, it's unnecessary. Why to remember this formula and all that? This formula and all during examination time, God knows we will remember or not. This is a lot simpler. Yes or no? Why can't we take this? We can't take this because interest is an expense for the company. Yes or no? Because company is paying interest. on your expense. No, if your expense increases, then your profit reduces. Yes, if your expense increases, then your profit reduces. If your profit reduces, if your profit before tax reduces, then your tax amount also will reduce. What am I trying to say? On this interest, meaning on this interest expenditure, you will get some tax benefit or tax shield. Meaning if the tax rate is 30%, now you think logically, interest maybe the company is paying 10%, but interest is an expense, and due to this expense, profit will reduce and tax also will reduce. Yes, that means company will get taxes reducing, means they are saving in the form of tax. That only we call it as tax the shield or tax benefit. So cost to the company is not really 10%. It is something less because they're getting tax benefit also. Hence, you think they might be paying interest at the rate of 10%, but 30% of that they will be saving in the form of tax. So effectively the cost is what? 10 minus 30% of 10, which is what? 10% minus 3%. So effectively the cost of the company is only 7%. Because out of this 10%, 30% they will save in the form of tax. That means effectively the cost is 7%. Hence, that is only being expressed in the formula here. Hence, we don't take interest rate. We take it as interest into 1 minus tax rate. 1 minus tax rate, if you do, you're going to get after tax wala savings or after tax interest. That divided by net proceeds you have to do. So, what is net proceeds? If it is newly issued debentures, if it is the newly issued debentures, then you will take net proceeds to be issue price. How much ever price you are issuing that debenture for, that will become your net proceeds. Okay, that minus flotation cost. Flotation cost means what? Sir, to issue debentures, right? Debentures may be issued to lakhs and lakhs of debenture holders. It will be issued to many people. Yes. So company, to issue the debentures to the public, they may take the help of certain people, certain brokers that we refer to as underwriters. And they will not do all this activity at free of cost. They will charge some commission. Basically, to issue these debentures, if you have any issue expense, okay, to issue these debentures to the public, if there is any issue expense, like debenture issue expense, some consultants you hired to know the legal process or to know the documentation, etc., etc. All that issue expense we refer it to as flotation cost. Okay. So net proceeds means basically how much money company is receiving. So from debenture holders, they would have received the issue proceeds, but they are also incurring some issue expense also. So net of that or reduce that, that becomes your net proceeds. This is for the new debt. If it is, however, existing debt, then instead of issue proceeds, you will take market price of the share or market price of the debenture. This is common both for the shares, debentures, equity shares, preference shares, debentures, everything. This is a common thing. Hence, I'm taking this. So market price you take, from that you reduce flotation cost, you'll get the net proceeds. That's how to get the net proceeds. Okay. So basically interest into 1 minus tax rate divided by net proceeds. When you will use this? When the debentures are irredeemable. However, if it is a redeemable debt, then the formula you have to bring in slight to tweak. That's given by the formula interest into 1 minus tax rate, the same thing, plus RV minus NP divided by N. The whole thing divided by RV plus NP divided by 2. In our regular class, more than 5-6 problems we have done just on these things. Okay, I'm quickly revising this. RV here stands for redemption value. NP, I've already told you, is the net proceeds. N is the remaining life of the debentures. N is the remaining life of the debentures. How many more years will this debenture stay in the company? That we call it as N. Divided by RV plus NP divided by 2. Okay, so if you apply this, you're going to get the cost of debt. Okay, these are the two ways you can work it out. Or based on the nature of debentures, these two formulas have been developed. So why is the redemption value written? If you think about it, let's say debentures were initially issued at a face value of 100, meaning the issue price is, let's say, 100 rupees initially. Let's say the term is 10 years. The term of this debenture is 10 years. That means after 10th year, the company has to repay this debenture holders their money. The company has to redeem these debentures, meaning they have to repay the debentures. Correct? Yes. Do you think even repayment will happen at 100 rupees only? No. The redemption value or the redemption price could be 100. It may be greater than 100 or it could be lesser than 100. Suppose the redemption price is 110. Redemption value per debenture is 110. Now you check what is happening. When the company issued the debenture, they got how much money? 100. But how much money are they paying back to the debenture holders? 110. That means are they not getting, is the company not paying something extra? Extra means there is some extra cost for the company. Yes. So hence, if the redemption is not happening at par value, so there will be some extra cost to the company because you are redeeming the debentures at premium. Hence, this component is also brought in into the formula to calculate the revised cost of debt. So these are the two ways in which you can work out the cost of debt. Okay. All right. These methods, above methods, we call it as approximation methods. Okay, because they are trying to approximate the cost of debt. You can also use IRR method to calculate the cost of debt as well. IRR as an internal rate of return, or you can also call it as implicit rate of return. We have done this extensively in investment decision. We're going to study that also in a bit, but just see. IRR is given by the formula lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. You can use IRR application as well to find out the cost of debt. We have done a couple of problems on this also in our regular session, okay, on the cost of debt, okay. So the same way, which way you work out IRR, using the same concept, you can work out as well. Don't worry, in the examination, they'll clearly specify which method should you apply and get the cost of debt, okay. They'll be very clear on that. If they don't mention, either you can use this approach or IRR approach, both are fine. IRR will be a little lengthy, so I suggest go for the above method, that you will get the answer a lot quicker. Not that IRR method is wrong. In fact, IRR method is probably more clearer. If they don't mention, time wise, the first one is a lot better. Okay. That's your cost of debt. Next, cost of convertible debentures. If you have convertible debentures, what to do? Convertible debentures means what? There is some option given to the debenture holders. Company has given some option to the debenture holders saying, hey, macha, hey dude, if you want at the end of the debenture life, let's say the term is 5 years, the company is telling the debenture holders, hey dude, look, at the end of 5th year, if you want, I'll redeem your debentures by paying you cash. I'll redeem your debentures. Company is telling, I will redeem your debentures by paying you cash. Cash means cash or check or whatever. Or I will convert your debentures into equity shares. Okay, the company is giving two options to the debenture holders. Either he can accept after 5 years, either he can accept cash or he can accept shares. Okay, equity shares basically. In that case, what will you do? In that case, more importantly, how will you calculate redemption value? Because redemption value could be in the form of equity shares, redemption value could be in the form of cash. What will you choose? They have said, now you tell me, if you are a debenture holder, what will you choose? You will choose cash option or share option. Obviously, you will compare, right? Whichever is more beneficial, the higher of that you will choose. Whichever is more beneficial, that you will choose. So hence what we have to do is find out the redemption value, both the option. If cash is opted means what will be the redemption value. If equity is opted means what will be the redemption value. Meaning find out what is the value of equity that you are giving to the debenture holders. Whichever is higher, that number will be taken to calculate the cost of debt. Okay, that will become basically your RV. Okay, that's all is what they are trying to say. All this again we have applied also numerically, but now we will only target the important questions or what question generally oftenly get asked in the examination. Only that much we'll be doing. Everything you can understand, every problem every concept, every problem I cannot do it in this revision session because it will become way too lengthy. Okay, next is cost of preferentials. So if you know cost of debt, you know cost of preference shares also. Remember, here also check whether the preference shares are redeemable or irredeemable. If it is irredeemable, there what did you write? Interest into 1 minus tax rate divided by net proceeds. Here instead of interest, substitute with PD. PD as in preference dividend. Sir, on interest is a charge against profit. In accounts you have learned. Interest is a charge against profit. Meaning on interest, you will get some tax benefit. But dividend is an appropriation of profit. Meaning only after paying tax to the government, company will give the dividends to the shareholders. Meaning on dividend, you will not get any tax benefit. On dividend, you will not get any tax benefit. Hence, you need not do 1 minus tax rate for preference dividend. That portion you can cut it out. Okay. So here the formula will become preference dividend divided by P0, or you can write it as net proceeds. That's your formula. If it is irredeemable. However, if it is redeemable, same. There you wrote interest into 1 minus tax rate. Here, since tax benefit is not there, straight away you write preference dividend. Plus there you wrote RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. Same component here also it will repeat. RV as an redemption value. Net proceeds is the, I've already explained you. Net proceeds, what is it? N is your remaining life of the preferentials. Using that, you can find out the cost of the preference shares. Okay. Then moving on, cost of equity shares. Cost of equity shares, there are various approaches under which you can find out the cost of equity shares. One, you can use dividend approach. If you use dividend approach, cost of equity shares, that we refer to as KE. So cost of equity shares is given by the formula dividend divided by price of the shares. P as in price of the shares. Okay. Dividend divided by net proceeds. If you do, you're going to get the cost of the equity under this particular approach. Like, let's say company is paying a dividend of 10 rupees, but the market price of the share, let's say, is 100 rupees. Market price of the share is 100. The company is paying a dividend of 10 rupees. That means how much return the company is paying. 10 divided by 100 into 100, which is nothing but 10%. So cost of equity using dividend approach will become 10%, like that. Or you can use earnings approach to find out the dividend. That is given by, cost of equity is given by EPS divided by NPS. Same funda. Let's say company has an earnings of 20 rupees. Company has an earnings per share. EPS means earnings per share. EPS of a particular company is 20 rupees. Market price of the particular company ka share is 100 rupees. So 100 rupees, see, earnings means EPS belongs to equity shareholders, correct? EPS belongs to equity shareholder. So if you own one equity shares of a particular company, on that one share, you are eligible to get an EPS of 20 rupees. Yes, because EPS is attributable or is given, EPS, using EPS only the company will give dividend, correct? So this 20 belongs to equity shareholders. Okay, you own one share means EPS for you is 20 rupees, correct? But to buy this one share, how much you need to pay? If you want to buy this one share today, in the market, price of one share is 100 rupees. So by paying 100 rupees, if you buy the share, you are eligible to get an earnings of 20. So what is the return percentage? 20 divided by 100 into 100, 20 divided by 100 into 100, that is 20%. So using earnings approach, you can find out the cost of equity like this. Okay. Or the most important one for examination is a Gordon's growth model, we say, or simply growth model. That is given by the formula D0 into 1 plus growth rate divided by P0 minus flotation cost plus the growth rate. This is very important as far as examination is concerned. Most probably cost of equity, they will be asking you this. Anyway, we have done enough number of questions on this in our regular class. D0 here what stands for what, sir? D0 is last year ka dividend. Last year ka dividend or dividend already declared, we call it as a D0 into 1 plus G. G here stands for the growth rate. Growth rate. Okay, divided by P0. P0 is the net proceeds. So the current P0 is nothing but the market price of the share, current MPS of the share. Current market price of the share, we call it as P0 minus flotation cost. F for flotation cost. It's not necessary in every problem flotation cost. Some problems may flotation cost will be there, some may it will not be there. But always in formula, do mention them so that you will be reminding yourself that even flotation cost has to be considered. Plus your growth rate. If you do that, you're going to get the cost of equity using Gordon's growth model. Okay. Or you can also revise this formula as if you do this D0 into 1 plus growth rate, that is nothing but you're going to get expected dividend for next year, which is D1. Instead of D0 into 1 plus growth rate, you can also revise this formula as D1 divided by P0 minus F plus growth rate. Check the problem. If the D0 means last year's dividend, we'll also take one problem targeting this as well to understand it better. D0 is last year declared dividend. D1 means expected future dividend or dividend expected at the end of the year, not declared. Dividend expected, we call it as D1. If they give you D1 in the problem, directly you can substitute this and do it. If they give you last year's dividend, then use this and work out the cost of equity. Okay, all this data will be provided to you. Just need to remember it and replicate it. Write that in your paper and get the marks. That's all. Okay. Growth rate, if it is not given in the problem, you can find out growth rate is equal to, growth rate is nothing but B multiplied by R. B is your retention ratio. B is your retention ratio and R is your rate of return. Rate of return on investment. Okay, I have already proved it to you in my regular class that y g is equal to b plus r. We did a case study, we assumed some numbers and we proved this equation. Now we don't have much time to go into all that stuff, so we'll just simply work it out. So if they give you retention ratio and rate of return on investment in the problem, using those two also you can find out growth rate. So g is nothing but b multiplied by r. Retention ratio means how much earnings has been retained by the company. Like, let's say company has an EPS of 10 rupees. Company has an earnings per share of 10 rupees. Is it necessary company has to give entire 10 rupees to the equity shareholders as dividend? The company has an earnings of, or we can take total earnings also if you want. Let's say company has a total earnings or each earnings attributable to equity shareholders. Let's say that is 10 lakh rupees. Is it necessary entire 10 lakh the company has to give it to equity shareholders as dividend? No. Let's say company declared a dividend of company has given a dividend of only, let's say 2 lakh rupees. Out of 10 lakh, only 2 lakh they have given it as dividend. Okay. That means what is your dividend payout ratios? Dividend payout ratio is nothing but either you can calculate on a per share basis or total level basis. It is fine. Here I'm doing a total level basis. When we did ratio analysis, I also showed you per share data. There we wrote DPS divided by EPS. Here I'll write total dividend divided by total earnings. You can do it on a per share basis or a total basis. The answer will in each way be same. Total dividend is 2 lakh. Total earnings is 10 lakhs. That means how much is this? 20%. Indirectly they're saying out of the earnings, 20% the company will pay as a dividend. So how much the company is retaining? Because entire thing they're not giving it as dividend. How much are they retaining? 80%, right? That we call it as retention ratio or denoted by the symbol B. B is nothing but the retained portion. That is retention ratio. Okay. R, as I've already explained you, is the rate of return on investment. So these are the ways in which you can find out the cost of equity. In fact, there's one more known as capital asset pricing model, CAPM. Capital asset pricing model. That's given by the formula. Cost of equity is nothing but RF as a risk-free rate of return plus beta into RM minus RF. Sir, RF stands for risk-free rate of return. B stands for beta. RM stands for market rate of return. I'm sure all of you have done this, but I'm just spending 2 minutes on the formula so that we understand better. That's all. So cost of equity is given with the formula RF as in risk-free rate of return plus beta into RM minus RF. What is this capital asset pricing model ka funda is? See, sir. Let's say if you have some money, you can invest in Government of India bonds. Now RBI will issue some bonds. Many state governments will issue their own bonds, etc., etc. Obviously, even governments need money to fund their activities, no? To construct bridge, to construct flyover, etc., etc. They also need funds. So companies or the governments periodically, whether state government or central government, periodically they will also issue some, they give out some bonds. Let's say Government of India bonds is having a return of 7%. On that bonds, government is giving a return of 7%. This we call it as RF. RF as in risk-free rate of return. Meaning there is no risk attached to this. If you invest, 100% guarantee government is giving that we will give you 7%. Are we okay? Now, you're running a business means, do you want only 7% return? See, 7% any which way aram se you can earn. You don't have to do any activities to get the 7%. Yes or no? If you simply give the money to the government, government will give you 7% every year. Yes, that is risk free. But if you're doing some business, you will not expect 7%. You will expect more. Okay. Let's say market rate of return is, let's say 10%. Market rate of return is 10%, or maybe we can take it as 15% also. 15% is the market rate of return. In a general industry, they're earning 10%. That means, what is RM minus RF? What is the extra return? See, 7% any which way you're going to get. But by taking risk, how much extra are you getting? That extra only we call it as risk premium. By taking risk, how much extra return are you getting? Anyway, 7% without any risk you're getting. But you are expecting 15 means, by taking risk, how much return are you expecting extra? 8%. How 8%? RM minus RF. That is 15% minus 7%, which is 8%. Yes or no? By taking risk, you want 8% more. Because 7% anyway government will give you. You want to take more risk and earn 8% more. Okay, so hence your return is 15%. The market may generally the return is 15%. Now what is beta? Let's say beta is 1.5. Beta, let's say there is one company X Limited. They have a beta of 1.5. What this beta tries to measure is if the market rate changes by 1%. Normally we give beta for the stocks and all. Like I can correlate that with better. If Sensex or Nifty, that is a market, share market, Sensex or Nifty. If market changes or if market increases by 1%, then if the beta of the stock is 1.5 means, then X Limited ka share price will not increase by 1%. It will increase by 1.5%. Meaning 1 ka 1.5. That is your beta. Beta for 1% change in the market, there will be 1.5% change in the company. Why 1.5? Because beta is 1.5. Beta measures volatility. Okay. So suppose the market changes by 2%, then the company ka share will change by 2% into 1.5 times. It will be what? 2 ka 1.5 is what? 3%. It could change means it could be increase or decrease. Both way it works. That is your beta, right? So that is what the CAPM model is trying to say. Okay, by taking risk, how much extra the company is, or by taking risk, how much extra return we can earn. That is expressed in this particular formula. Okay, that's all. All right. Normally, what do you do? Risk-free rate of return plus RM minus RF you do. That you will get market rate of return. Yes, overall return. But since company may have a different beta, one company may have 1.5 beta, another company may have 2. Hence, we multiply by beta to get the cost of equity for this particular company. Because company and market are not same. Yes or no? Right? Company may have more, may be willing to take more risk than the market, and company may be willing to take less risk in the market. That's the reason we always multiply by beta to get the cost of equity for this particular company under CAPM model. All this you need not remember, just saying for reference. But yes, again, this is also quite oftenly tested in the examination. Okay, so these are a few things. Then cost of retained earnings is also there. Retained earnings means the money which the company has not given as a dividend to the shareholders, but they have kept it with themselves. Let's say the company has earnings attributable to equity shareholders to the extent of 10 lakh. Each is 10 lakh rupees. Company gave 0 dividend to the equity shareholders because dividend is not compulsion. The company wants, they will declare dividend. Otherwise, they may choose not to declare dividend. This company is saying, no, we will not give anything as dividend because we need money for our expansion. For our expansion purpose only, we need money, so we don't want to declare dividend. Okay. So that means how much have they retained with themselves? Entire 10 lakh rupees. Yes or no? So this retained earnings also will have a cost. What cost? See, this 10 lakh rupees belongs to equity shareholders. Yes, ideally you should have given this money as a dividend. Are you giving now? No. That means the shareholders are sacrificing their dividend so that the company can use this money for further expansion. So companies or shareholders' loss or sacrifice of dividend, we call it as retained earnings or cost of retained earnings. Since shareholders are sacrificing their dividend, even that retained earnings will have a cost element. That is nothing but cost of retained earnings. There is no new formula for retained earnings. It is the same. Whatever you applied for cost of equity, same thing will continue. But there will not be any flotation cost for retained earnings. Because flotation cost means what? The issue expenses. When you issue equity shares, you may have flotation cost because there could be some issue expense. When you issue preference shares or debentures, there could be some flotation cost, meaning some issue expenses. But for retained earnings, where there will be flotation cost? Because retained earnings is not a new issue. It's existing data. Yes or no? So wherever flotation cost is there, eliminate that when you're calculating cost of retained earnings. That's all. Okay. All right. Cost of retained earnings is given by one more formula. If you have cost of equity, from cost of equity, you can find out cost of retained earnings. That is given by cost of equity into 1 minus flotation cost. Cost of equity will have flotation cost. Cost of retained earnings will not have. That's the reason you do 1 minus F for that. And when you give dividend, this is cost of retained earnings is related to dividend, right? If the company gives dividend to the shareholders, on that dividend, the shareholders have to pay some tax on that dividend income. Shareholders have to pay some tax. That we call it as TP, as in personal tax on the dividend. So cost of retained earnings is given with the formula cost of equity into 1 minus personal tax rate on the dividend, if you know, into 1 minus flotation cost. This also can be used to get the cost of retained earnings. All right, this is another way to get it. Meaning from cost of equity, you can arrive cost of retained earnings. Okay, All right. So again, don't worry. Some of it I'll just apply it in one of the problem also. And in our regular class, everything we have done. This is quickly revising. I'm sure our regular students will not be having any issues with that because we have done it. For the new students, even you should not be having because this is a revision. So once I'm assuming that you've already studied and you're comfortable with these terminologies, there's a quick recap that I'm trying to do here. Okay. All right. Next is WACC, or we call it as overall cost of capital. The overall cost of capital, also denoted by the symbol KO. Overall cost of capital, okay, is WACC, weighted average cost of capital, or also known as overall cost of capital. What this means? See, suppose company needs a fund of 10 lakh rupees to do one project. One company, they require a fund of 10 lakh rupees. Now, this money, this 10 lakh rupees, company can raise through equity shares, or they can raise through preferentials, or they can raise it through debt, meaning debentures or bank loan. Okay, they have an option. Now, do you think entire money the company will raise only from one source, or can the company do mix and match, chow bath, mixture? Okay, possible. The company may say, out of this 10 lakh, 5 lakh rupees I will raise through equity shares, 1 lakh rupees I will raise through preferentials, 4 lakh rupees I will raise through debentures. Like this, company can mix and match, quite possible. Okay, some companies may choose to raise the entire money through equity, some may choose to raise entire money through debt, or you can do any of these combinations also. Yes. So if you have multiple source of finance, then maybe cost of equity may be 15%, cost of preference shares maybe, let's say 10%, cost of debt maybe, let's say 8%. Yes, because each of the source of finance will have their own cost of capital, right? Since you are using multiple capital and each capital have their own cost, what is the overall cost of capital of this project? That we are calling it as KO, overall cost of capital. Fine, that is what we are trying to find. That normally what you do, if you have multiple things, no, you can find out simple average. How do you find out simple average? Add all of this and divide it by 3. That's how we used to do. But here we don't do a simple average. We use weighted average cost of capital. Instead of simple average, here we use weighted average cost of capital. That only we call it as KO, or overall cost of capital. How do you get that? I've given you a simple table that we do normally in all our problems. We have seen this table. I've just called out this table for your reference. One is the source of finance. That source of finance could be your equity share capital, could be your debt, blah, blah. Yes. Next column is your market value or book value. Okay, either it could be market value or book value. They will only tell you in the problem what you should use. Should you use book value or market value? Let's say market value they have told. This is 1 lakh. This is, let's say, 50,000. Then you have to find out the weights, because we are doing weighted average cost of capital. No? Okay. Or maybe I'll take this simple number. Easy calculation. This is 2 lakh. This is 1 lakh. So the total is 3 lakh. Meaning out of 3 lakh rupees, 2 lakh has come through equity shares. 1 lakh has come through debt. So the weights will be the ratio of this. That's all. What is the ratio of this? The weights will be what? Here will be 2/3, meaning out of 3 lakh, 2 lakh has come through equity shares. The weightage is 2/3, like that. So out of 3 lakh, 1 lakh has come through debt. So the weightage is 1/3. Okay. So that's your weight column. To find out this weights, no, either you can use market value or book value. Market value means you will find out you will take the market price of the share and find out the total value. Book value means the face value of the share that you show in your books, records, accounting records. Okay, they will mention in the problem. Then take after tax cost of capital. Equity shares cost of capital may be 15%. This will be 10% maybe. So overall cost of capital, KO, is given by these two multiplication. So 2/3 of 15 will give you 10. 1/3 of 15 will give you 3.333%. So if you add everything, you're going to get 13.33%. That 13.33% only we call it as overall cost of capital. Okay. So why is overall cost of capital necessary? See, you're running a project means you want to know whether the project is successful or not. Or why do we take overall cost of capital is ultimately you want to know whether the project is successful or not. Yes or no? Like if I am running an IPC, a CA inter batch over here, if that is my project. So at the end of the year, I want to know whether my IPCC batch is successful or not. Yes or no? How do I do that? Let's say from IPCC batch, I got a return of 20%. I conducted this batch, many students came, they gave the fees and we paid to all the lecturers, everyone. After doing all this, I'm getting a return of how much? From this CA Inter project, I am getting a return of 20%. But to do the CA Inter project, I wanted some money. I have raised the money through equity shares and debentures. And my overall cost of capital is only 13%. Now tell me, is this project successful or not? It is successful. Why? Sir, the return that I got from project is 20%. But my overall cost of capital is only 13%. So if return is greater than the overall cost of capital, then the project is successful. Other way around means not so successful. Like that. Okay. So that's your component. All right. So if they don't tell market value, book value, what to do? If they give you both market value and book value, and in the examination they don't tell what to use, my suggestion is always stick to the market value. Preference, you always give it to market value. Because market value is a current data. The subject is financial management. So you don't want existing data. You want the most updated data. Yes or no? So most updated data you will get through market value. Hence my preference is, if they don't mention anything, take market value. If they say calculate overall cost of capital using book value approach, then use book value. Like that. What if they say something, do that clearly. If they don't mention, preference you always, or first preference you always give it to market value. Like that. If market value is missing, then you can go for book value. Okay. That's your WACC, or overall cost of capital. Then there's the last one, that is marginal cost of capital. Marginal cost of capital simply means what is the cost required to raise additional funds. The cost that you need to raise additional funds, we call it as marginal cost of capital. Yes guys, how are we doing? Marginal cost of capital. Marginal cost of capital means cost of raising the additional funds. If the company is raising additional funds for any new projects, then the overall cost of capital that was there before, no, it will not be same, meaning it will change. Let's say overall cost of capital before the project is, let's say, 12%. Now one company wants to do new project, so they want to raise additional source of finance for it. Let's say that particular project costs 10 lakh rupees, meaning to do that project, company needs 10 lakh rupees more. That 10 lakh rupees, let's say company will raise in the form of equity debt in the 50-50 ratio. Meaning 50% will come through equity, 50% will come through debt. Because of this project, overall cost of capital will not be 12%. It may be different. It may be 13%, 14%, etc., etc. So meaning overall cost of capital is changing. So that we refer to as marginal cost of capital, meaning the cost of raising the additional funds. Okay. We'll also apply this. So whatever we have learned till now, we'll apply it in one of the problems on the examination question to understand it a little better. Okay. Let's take up question number 2. Again, this question came in July 2021. Came in July 2021 paper for about 10 mark. Okay, that's the weightage this particular chapter carries. Okay, following information of TT Limited, the company they have given. Earnings per share is 10. Dividend per share is 6 rupees. So dividend per share means dividend already declared. Earnings 10 means earnings already the company, this much earnings company has already made, which is 10. This much 6 rupees dividend they've already declared. That means this is a D0. Dividend already declared, or last year dividend we call it as D0. That is given. Expected dividend at the end of the year we call it as D1. So here they have given D0. Growth rate they have given 6%. Great. Current market price of the share they have given it as 120. Fair enough. Tax rate is 30%. Requirement of additional finance is 30 lakh. So that means you know what the requirement is going to be. They're going to, because of this additional finance, your overall cost of capital will change. Okay, that they will ask you to find out. That only we refer to as marginal cost of capital, the cost of raising the additional funds. So to do a new project, they require additional funds to the extent of 30 lakhs. So they will raise this additional funds in the form of debt and equity. Meaning 30 lakh will come in the form of debt and equity. They're saying in the ratio of 2:1. Meaning 2 rupees will come in the form of debt. So and 1 will come in the form of equity. So that means the debt element will be what? This 30 lakh is in the ratio of 2:1. So 2/3 of this will be in the form of debt. So 30 lakh into 2/3, that is 20 lakh will be coming in the form of debt. And the balance 10 lakh or 30 lakh into 1/3 company will raise in the form of equity that they have given. So that's how this total funds of 30 lakh is being arranged by the company. Okay. Cost of debt, however, if you are borrowing the debt, no, if you're borrowing the debt up till 5 lakh, from 0 rupees up till 5 lakh, the interest rate is only 10%. The bank is saying up to 5 lakh, the interest rate for you is 10%. From 5 to 10 lakh rupees, the interest rate is 9%. So they have given a slab rate. It's not one rate. Up to 5 lakh debt, interest on debt is 10%. 5 lakh 1 rupee to 10 lakh rupees, that is 9%. Above 10 lakh rupees, if you're borrowing, the interest rate will become 8%. Like that, they've given it a slab basis. Assuming that there is no reserves in surplus available in T&D Limited, meaning there is no retained earnings, you are required to calculate pattern of finance for additional requirement. How the additional funds is going to be raised. That we already wrote. The pattern is what? 2/3 is going to come from debt, that is 20 lakh. 1/3 is coming through equity. Out of 30 lakh, 2/3 through debt, 1/3 to equity. So 20 lakh from debt, 10 lakh from equity. That's the first requirement. Very simple one. All right. Calculate the post-tax average cost of additional debt. So they're asking you cost of the debt now. So we know already. How do you get cost of debt, sir? Cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. So we read the problem. Nowhere they give redemption wala data. So redemption price that they have not given. They have not mentioned anything about that. Hence we will assume that the debt is irredeemable and apply this particular component. Okay. Now interest rate. I stands here for interest rate. So let's find out that. Interest, we have only one component or it's on a slab basis? Slab basis, yes. So total debt you require is 20 lakh. Okay. So they have given for the first 5 lakh, the interest rate is 10%. I'm not saying, they are saying. So for the first 5 lakh, the interest rate is 10%. That means this will be 50,000. But you want only 5 lakh debt? No, the total debt is 20 lakh. So, all right. So that means up to first 5 lakh rupees, the interest rate is 50,000, meaning 10%. Then for the next 5 lakh, from 5 lakh 1 rupee to 10 lakh rupees, the interest rate is 10%. Meaning on the next 5 lakh, the interest rate they are saying is 9%. Yes or no? Which will be 45,000. That's how it was on a slab basis. For the first 5 lakh, the interest rate is 10. For the next 5 lakh, it is 9%. And if your debt goes beyond 10 lakh rupees, then the interest rate will become 8%. Is it going beyond 10 lakh? Yes. You want to raise 20 lakh. That means how much more you require? 10 lakh more you require. On this 10 lakh, they are saying interest rate is 8%. So calculate, this will be what? 80,000. So if you add up all this, it will be what? 1,75,000 or 50 plus 45 plus 80 will give me 1,75,000 is my total interest. So we got the interest here. Tax rate is already given. Net proceeds we already know. The total net proceeds by issuing debt is 20 lakh. We have all the data. So cost of debt is interest, which is 1,75,000 minus tax rate. Tax rate, they only told in the problem is 30%. 30% when you express in full number, it will be 0.3 divided by net proceeds, which is 20 lakh. Do this. 1,75,000 into 0.7. So you're going to get 122,500 divided by 20 lakh. Cost of debt will express in percentage. So we'll multiply by 100 divided by 20 lakh into 100. If you do, the cost of debt will be 6.125% is the cost of debt. Have they got the same answer? 6.125% is the cost of debt. Don't worry about the approach. Okay. Final answer you just check. That should be good enough. Okay. So that's your cost of debt. That's the second requirement. Then they're asking cost of equity. So the moment they gave growth rate, to find out cost of equity, we have ARS approach, dividend approach, earnings approach, Gordon's growth model, CAPM, blah, blah, blah. The moment they give growth approach, no, so you have to use the growth model. So how do you get that? The growth rate ka formula. That is, check if they have given D0 or D1. If they have given D0, the formula will be D0 into 1 plus growth rate divided by P0, that is current market price, minus flotation cost plus the growth rate. Here they have given you D0 only. The dividend already declared, which is 6 per share. Okay. Into 1 plus growth rate. Growth rate also they have given it to be 6%. So plus 0.06. Divided by P0, that is the current market price. Current market price is 120. We don't have any flotation cost, so minus 0 plus the growth rate, which is 0.06. Do this. 6 into 1.06. 6 into 1.06 will give me. So this will be 6.36 divided by 120 plus 0.06. If you do that, your cost of equity you're getting at 0.113 or 13.3% is your cost of equity. Check what did they get? 13.3%. All right. Last May they are asking overall cost of capital of additional finance. How do you get overall cost of capital? You know, right? That particular dabba you need to put it up. One is the particulars, equity and debt. How much came through equity? 10 lakh. How much came through debt? 20 lakh. So total is 30 lakh. So out of 30 lakh, 10 lakh is coming through equity means what is the weightage of equity? 1/3, that is 10 lakh divided by 30 lakh, which is 1/3. Debt ka weightage is 20, out of 30 lakh, 20 lakh is coming in the form of debt. So the debt ka weightage is 20 lakh divided by 30 lakh, which is 2/3. Then take the respective components ka after tax cost of capital. So equity ka cost of capital is 11.3. Debt ka cost of debt is 6.125. So how do you get overall cost of capital? If you want, you can number them. This is 1, 2, this is 3, this is 4, and this is 5. The overall cost of capital, that is 5. Overall cost of capital, 5 is given by the formula. The weights multiplied by the respective cost of fund. These two ka multiplication you do. 11.3 ka 1/3 if you do, you're going to get 3.76%. 6.125 ka 2/3 if you do, you're going to get 4.083. So overall cost of capital is 7.85%. That is what they have asked in the particular problem. Quite easy. Yes or no? So like these, the question get tested from this particular topic. Okay. So chapter number 2 is also done or rather chapter number cost of capital is also, we have finished. Let's dive into the next topic, that is capital structure. Capital structure. So what is this topic? What is this all about is? So this topic we're trying to assess. Suppose you want money for a project means, okay, if you want let's say 30 lakh from the project, you can take the money from debt, or you can take through equity, or you can take through preferentials. Like this, we have various source of finance. Now here, what are we trying to study is from which source of finance the company should raise the money. From which source of finance the company should raise the money so that the overall value of the firm is maximized. The company using which source of finance if they raise, the overall value of the firm is maximized. That is what we are trying to assess in this particular topic. Okay. All right. Here again, you need to just remember 3 or 4 particular formulas, and that is driving the whole topic. 1. The value of the firm is given by, okay, or I'll just tell you, or maybe once I'll tell you, value of the firm is given by EBIT divided by overall cost of capital, which is KO. V is given by EBIT divided by KO as an overall cost of capital. Now, what is the significance of this? Check. Excuse me. Sir, let's say I have raised a total finance of 1 crore rupees. I have raised a total finance. The market value of my finance is 1 crore rupees. Okay. All right. Sir, using this finance, I have made a 10% return. I've used this money, okay, and I've earned a return of 10%. Are we fine? That means, can you tell me the return amount? This is the return percentage. Okay. Or rather, like I'll just say, okay, no problem. What is this now? This will be your return. Yes or no? This will be a return. Or maybe I'll just write it as a return. So how much is the return you're getting in amount? 1 crore is the value that you have raised, and you have earned a return of 10%, means the total return you're making is 10 lakh rupees. Okay. Now, if I give you the return and if I give you the return percentage, can't you find out the value of the firm? Yes. How do you find out value of the firm? That is nothing but return divided by the return percentage. Correct? Yes, that's how we'll do it. That is only we calling it as value of the firm. Value of the firm here stands for return divided by return percentage. Return here stands for EBIT. Okay. All right. Return percentages. See, return percentage expected by the shareholders or the providers of finance. For the company, it is cost, but for the providers of finance, it is their return. So you might have raised the money from many sources, right? So you should take the return percentage as overall cost of capital. Okay. Because for the company, it is cost. For the others, it will be a return. So if you do this, you're going to get the value of the firm. So hence we say value of the firm is nothing but EBIT divided by overall cost of capital, which is KO. Okay, that's your first formula. All right. Or you can also present, this is one. Second way to remember this is value of the firm is given by S plus D. Value of the firm is given by S plus D. S is nothing but market value of equity. D is nothing but market value of debt. So value of the firm is given by market value of equity plus market value of debt. That is what I've called out over here. Okay, fair enough. So yes, they would have given to you in the problem. All this market value of debt generally will be given to you in the problem. Market value of debt they would have given to you in the problem. Market value of equity, which is denoted by S, you can find out. This is a third component. S is equal to, you find out value of the firm, right? Similarly, you can find out market value of equity. Okay, that's another, you can find out that. Instead of EBIT. Now, is EBIT available for equity shareholders? No, what is available? Each. So you will take in the numerator as each or net income. Instead of EBIT, it will become net income. Since you're finding market value of equity, you can't take overall cost of capital. You will take cost of equity. There's another formula to find out the market value of equity S. That is each or net income divided by cost of equity. That's all. So these are your driving force for this particular chapter. These three things. Okay. There are certain theories that is revolving around capital structure. Let's go over them one by one. One is the relevance theory. What relevance theory says is or we'll say this. Under relevance theory, we have net income approach. What net income approach says is use debt as much as possible because debt is cheaper. See, debt is cheaper when compared to cost of equity because equity shareholders are the risk takers. Equity shareholders of the company are the risk takers. The more risk you take, the more return you will expect. Yes or no? So since debt holders take less risk, they will get less return. So hence we say use as much debt as possible because the cost of debt will be lesser than the cost of equity. Okay, cost of debt or debt will be cheaper than debt or debt will be cheaper than the equity. So hence what they're saying is since your debt is cheaper, meaning your cost of debt is less. So because of this, what will happen is your overall cost of capital will reduce. If you use more and more debt, your overall cost will reduce because debt cost will be on the lesser side, right? Because equity shareholders take more risk and they expect more return. So cost of equity will be more. So in net income approach, they say use as much debt as possible. Take more and more debt. Since debt is cheaper, your overall cost of capital will reduce. This would imply that the value of the firm will increase. Now these two have ulta relationship, meaning if overall cost of capital reduces, value of the firm will increase. You can prove that also. I did that in the regular class. Here also maybe for 2 minutes we can spend. So how do you get value of the firm? EBIT divided by overall cost of capital. Let's make EBIT to be 10 lakh assumption. Overall cost of capital, let's make it as 10%. Okay, 10% is nothing but 0.1 full way. So if you do this, 10 lakh divided by 0.1, that will be 100 lakh or 1 crore rupees. Yes, if you do that, you're going to get that number. Yes. All right. Let's do a thing. Cost of capital, instead of 10%, let's make it as 9% or 8%. 8% in full number it will become. Instead of 10%, I'm making it as, here your overall cost of capital was 10%. Now I'm making overall cost of capital as 8%. If you do this, what will be the number? 10 lakh divided by 0.08 if you do, you're going to get 1 crore 25 lakh or 125 lakhs. Check. Your cost of capital reduced. Yes, from 10 it became 8, but value of the firm increased. So they have ulta relationship. If your overall cost of capital reduces, your value of the firm will increase and vice versa. That is what they have written it over here. If you use as much debt as possible, then since debt is cheaper, your overall cost will reduce, meaning your KO will reduce. And reduction of KO will result in increase in the value of the firm. So hence we will increase is what net income approach says. Okay, these are some theories revolving around this. Not that these are important for examination. Quickly I'm running them by, that's all. Traditional approach says, hey, no dude, you're not entirely right. We agree that debt is cheaper. But what traditional approach says is you have to use both debt and equity judiciously, meaning carefully. Since debt is cheaper, left, right, center, you cannot take debt. You have to use debt and equity judiciously, carefully. Because what they say is debt though is cheaper, all right, up to a certain point of time, debt may be cheaper. Okay. So initially we do agree because of debt, your overall cost of capital will reduce. So your value of the firm will increase. But as the years pass by or months pass by, the cost of the debt will increase. Like let's say the banks may say up to 1 crore loan. One bank is telling one company, if you take 1 crore loan or up to 1 crore loan, I will give you interest of 10%. of up to 1 crore loan, if you want to avail from me, take from me, the bank is telling, I will give you interest rate of 10%. So let's say the company took 1 crore loan. After 2 years, again they came and told, I want 2 crore more loan. So bank, do you think will offer it at same interest rate? No, bank will tell, boss, okay, debt is like you're taking more debt. If the bank is asking the company, if you don't make profits, then the bank is telling, I'll be at risk. So 2 crore, no, 2 crore loan I'll give you, but I'll not give you at 10%. I will give you to at 15% because your borrowings have increased drastically. And if you don't end up making enough profits, then I will not be able to recover my interest. Hence, bank may increase the cost of the debt from 10, it may make it to be 15. That is what traditional approach is trying to say. Up to a certain level, debt will be cheaper. So your overall cost of capital will reduce. So your value of the firm will increase. But after a certain limit, the cost of the debt will also increase. And then cost of equity also will increase, because you're taking debt means whether you make profit or you make loss, you have to pay interest to the debt people, meaning bank people or debenture holders. Whether the company earns money or they don't earn, the bank interest or debenture interest has to be paid. So the business becomes more risky. Hence the shareholders' expectation also, since business has become more risky because of debt, equity shareholders also will start expecting more return, because higher the risk they take, higher the return they'll expect. So increase in cost of debt or increase in the debt will make the business more risky. So the equity shareholders also will expect more return. Hence your cost of equity will increase. If these two increases, means your overall cost of capital again will increase and your value of the firm will reduce because of ulta relationship. Okay, that is what traditional approach says. Initially you may be using debt, you may increase the value of the firm, but later on it will get offset. If you use too much of debt, value of the firm may actually get reduced. That's what that particular theory is trying to argue. Okay, these are relevance theories. They're saying debt is irrelevant. Now we have some irrelevance theory. What irrelevance theory says is debt is irrelevant for the value of the firm. Irrelevance theory ka funda is you use whatever debt is possible, it has no impact on the value of the firm. That's what irrelevance theory ka funda is all about. Under irrelevance theory, you have net operating income approach. What they say is use of debt has no impact on the value of the firm. Whether you use more debt or less debt, value of the firm will be same. What is their hypothesis is, okay, debt initially is cheaper, no doubt. Okay, so since debt is cheaper, the cost of debt will reduce. So that means your overall cost of capital will reduce. If you are using more and more debt, debt is cheaper, so overall cost of capital will reduce initially. We agree on that. But as you borrow more and more debt, the business becomes more and more risky. So cost of equity or the expectation of the equity shareholders will increase. So overall cost of capital also will increase. So this decrease in overall cost of capital will offset this increase in overall cost of capital. That is what they are trying to say. Both will get offsetted and there will be no impact on the value of the firm. Right? So again, I'll repeat that. What did I say? As per this approach, debt has no impact on the value of the firm. You can use how much ever debt as possible, the value of the firm will be same. The hypothesis is very simple. If you take more and more debt, the debt is cheaper. So since debt is cheaper, the overall cost of capital will reduce initially. Okay. But as you borrow more and more debt, the business becomes more and more risky, because whether business make profit or loss, the interest to the debt people has to be given. So equity shareholders will start expecting more returns because the business has become more risky. So that means cost of equity will increase. Since cost of equity will increase, your overall cost of capital again will increase. So this decrease in overall cost of capital will get offset with or will get nullified with increase in cost of capital. Hence the value of the firm will be same is what this particular point is trying to prove. Okay. All right. approach, Modigliani and Miller approach or approach. What they say is, again, they are also proving the same thing. Debt has no impact on the value of the firm. So the point you need to remember for our examination here is, if there is no tax, if we are in a particular country and if that country has no tax rate or no tax, then they say value of the levered firm will be equal to value of unlevered firm. The overall cost of capital of the levered firm will be equal to overall cost of capital of the unlevered firm. So what is levered firm? Levered firm means that firm which is using debt as a source of finance. that company which has taken debt, meaning that company which has taken some borrowings from bank, that company which has issued some debentures, that company we call it as a levered firm. The company which is using debt, we call it as levered firm. Unlevered firm means that company which is not using any debt, meaning all their money is coming through equity other than the debt portion. Okay. If there is no tax world, or if you live in a no tax world, or if there is no tax, then the value of the levered firm and value of unlevered firm will be same. And both the firm ka overall cost of capital also will be same as their hypothesis. Okay. If, however, there is a tax rate, like for instance in India, we obviously have a tax rate, then they've established a connection between levered firm and unlevered firm. What they're trying to say is, or this and all is very old data, okay, 1950, 1960s, I think, but it's still there in our syllabus, so kind of we need to remember it. So value of the levered firm means value of the firm which is using debt. That is given by value of the unlevered firm plus the tax benefit. Levered firm means they are using tax, or rather they're using debt. Debt as in debentures, yes. On debentures, you will pay debentures or loan. On that, you will pay interest. On interest, you will always get the tax benefit. So hence they are saying, if there is any tax, then the value of the levered firm, meaning that firm which is using debt, will be given by value of unlevered firm, meaning that firm which is not using debt, plus the tax benefit. This is the only difference between the two companies. The unlevered firm will not get tax benefit. Levered firm will get tax benefit. Because on debt, you have to pay interest. And on interest, you will obviously get some tax benefit. Okay. So how do you calculate tax benefit? Tax benefit is nothing but the total debt multiplied by the tax rate. Because on total debt only you will pay interest. So take the total debt multiplied by the tax rate. That will give you tax benefit. So take the value of the unlevered firm. Let's say the value of the unlevered firm is 100 lakh. Okay. Calculate the tax benefit. Like let's say the debt amount is 50 lakh. The tax rate is, let's assume 10%. Okay. Or maybe let's make it as 30%. The total debt is 50 lakh and the tax rate is 30%. That means what will be the tax benefit? 15 lakh. So take the value of unlevered firm. So that you add tax benefit, you're going to get 115, right? This is nothing but the value of the levered firm as per the hypothesis. This may be asked or may be applied in one of the bigger questions. We have done such question in our regular class as also. Okay. All right. So this is about some theories revolving around the capital structure. They're all that much important for examination, but quickly we are running them by. But so for our sake, that's all. This is important. Financial break-even point, or we can call it as FBP. Financial break-even point. First of all, break-even point means no profit, no loss zone. That no profit, no loss zone, we call it as break-even point. Or you must have already studied in your costing. Some of you have written your group 1 or prepared for your group 1, or in your BCom, you must have heard about this term, break-even point. No profit or no loss zone. So we are trying to calculate. Financial break-even point means what should, listen to this very carefully. What should be your EBIT? What should be your EBIT so that your EPS becomes 0? Meaning at what level of EBIT your EPS will become 0. That is what we refer to as break-even point. Break-even point means no profit, no loss, right? So meaning your EPS has to become 0. Okay. What should be your EBIT? EBIT should be what number? Whether it should be 1 lakh, 10 lakh, 5 lakh, 3 lakh. What should be EBIT? So that your EPS will become 0. Okay. This I proved it to you with the one of the case studies also. We assume some random numbers and we proved it to you. That synopsis I've called it out here. Financial break-even point for equity is 0. Meaning only if EBIT is 0. Meaning if the company has raised the money through equity shares. If the company has raised the money through equity shares, then if EBIT is 0, then only EPS will become 0, and under no other circumstance EPS will not become 0. Meaning, if you want, you can do a quick analysis as well. Let's say EBIT is 100 rupees. Assumption, I'm taking around things. Okay, let's say company has only gone for equity option. That means there will be no interest. So from EBIT, if you deduct interest, you're going to get earnings before tax, which is how much? 100. Less tax. So let's say tax is at the rate of 30%. That means this will be 30. That means earnings after tax will be 70. Let's say there is no preference dividend because company is only going for equity option. So that means there is no preference dividend. So that means you're going to get what here? Net income, or you can call it as earnings attributable to equity shareholders. How much is this? 70. Okay. Number of equity shares. Let's say company has 100 equity shares for assumption. Tell me, how do you get EPS? EPS is nothing but each or earnings attributable to equity shareholders divided by number of equity shares. Yes or no? Meaning 70 rupees is the earnings belonging to 100 shares. 70 rupees is the earnings attributable to 100 shares. For one share, how much is the earnings? If you calculate this, 70 divided by 100, you're going to get 0.7. Did you get 0? No. So, financial break-even point means what should be your EBIT so that your EPS should become 0. For EPS to become 0, your EBIT has to be 0. That is what hence we say financial break-even point for equity is 0. Only if EBIT is 0, then only your EPS will become 0. Otherwise, EPS will never become 0. It will become 0.45, 0.15, some extra number you're going to get. So hence financial break-even point for equity is always 0, meaning EBIT should be 0. If you have debt option, then at what level of EBIT, then EPS will become 0. That financial break-even point we call it as EBIT should be equal to interest charges. If EBIT is equal to interest charges, then your EPS will become 0. If you want, you can prove that also. If you go for debt option, but this and all we have done it in the class. Quickly, I'll just show it to you. Let's say EBIT is 1 lakh rupees. EBIT is 1 lakh. Interest is also 1 lakh because what does the financial break-even point for debt option say? EBIT should be equal to interest charges. Only then EPS is equal to 0 is what it says. So do this. If EBIT is 1 lakh, then interest also has to be 1 lakh only. Only then it will work out. So earnings before tax will be 0. Tax also will be 0. This also will be 0. Preference dividend is not there. Each is 0. Number of equity shares is 100. EPS is also 0. That's the reason we say financial break-even point for debt options. Meaning if the company has raised the money using debt, some debentures or bank loan, for your EPS to become 0, your EBIT should be equal to interest charges. Only under that circumstance, EPS will become 0. Otherwise, it will not. Hence, we say financial break-even point for debt option is EBIT should be equal to interest charges. Okay. Similarly, financial break-even point for preference shares. If the company has raised the money by issuing preference shares, then financial break-even point means what level of EBIT should be there so that your EPS will become 0. EBIT should be equal to preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate, if you do, you should get EBIT. That should be your EBIT so that your EPS should become 0. Okay, we can prove this also if you want. Let's say preference dividend is 10,000 rupees. Tax rate is 50%. Assumption. Okay. First of all, calculate. What is as per the formula, what is it? For financial break-even point means at what level of EBIT, or meaning what should be your EBIT so that EPS will become 0. For preference shares, EBIT ka financial break-even point is preference dividend divided by 1 minus tax rate. Preference dividend is what? 10,000 into 1 minus tax rate. 1 minus tax rate is 0.5. That means 10,000 divided by 0.5. That will be what? That will be 20,000. Yes or no? Correct. Only if your this one is 20,000, then only this will become 0 is what it tried to say. Okay, this is under preference shares option. Okay, so if your EBIT is how much here? 20,000. Check if you want. Since we're going only for preference options, interest will be 0. That means earnings before tax will be 20,000. But tax rate here I made it as 50%, guys. Be careful with that. I took it as 50% for my calculation. Okay, here. So that means your tax rate will be 20,000 ka 50%. That will be 10,000. From EBIT, if you deduct tax, you're going to get earnings after tax, which is 10,000. Less preference dividend. How much is preference dividend? 10,000. That means your each became 0. Number of equity shares is still 100. EPS is still 0. Okay. Why this is fancy formula is, if you have preference dividend, no, you will pay preference dividend only after paying tax. Yes or no? Only after paying the tax, if any money remains, then only out of that you will pay preference dividend. Yes or no? That means whenever you have preference shares, no, company has to recover two things. One, they have to recover the tax paid to the government also. Another one, they have to recover preference dividend also. Only then EPS will become 0. Hence, that is expressed in this fancy formula. So hence, EBIT or financial break-even point for preference option is preference dividend divided by 1 minus tax rate. In your examination, you need not do all this, but this was just to prove that point. You need to remember this. That's what I've given in this chart book. If you remember this, and if they ask you the financial break-even point, accordingly, you can bring it up. Okay. So if you have all the three in the problem, what to do? If you have all the three options, then the financial break-even point is given by For equity, we know there is no financial break-even point. Only if EBIT is 0, then only it will become. If you have all the three as source of finance, meaning company has raised the money from all the three sources, then financial break-even point is given with the formula. 1, interest charges. All the three you need to add. That's all. Equity you leave. Equity does not have financial break-even point. So interest charges plus preference dividend divided by 1 minus tax rate you need to do. Okay. If you do this, okay, that will be your financial break-even point, meaning EBIT should be equal to this particular component. Only then the EPS will become 0 if you have all the three like that. Okay. This is about financial break-even point. Simple. All right. The next important component is indifference point. What does indifference point try to say is, okay, let's say company has two options, option 1, option 2. Option 1, let's say company needs 10 lakh rupees money for a particular project. They need 10 lakh rupees for a particular project. They have two options to raise this 10 lakh rupees. First option is to raise this 10 lakh rupees through equity shares. All right. Second option is to raise this 10 lakh rupees through debt, meaning debentures or bank loan. One option is to raise it by equity shares. Another option is to go for debt option. All right. What are we trying to calculate in IP? IP as an indifference point is what should be your EBIT? What should be your EBIT so that both alternatives gives the same EPS? What should be your EBIT so that whether you go for option 1 or whether you go for option 2, both will give you same EPS. Whether you go for option 1 or option 2, you should get the same EPS. That is what we are trying to find out. What should be your EBIT? EBIT should be 10,000, 15,000, 1 lakh, 10 lakh, 50 lakh, what? What should be your EBIT so that both the alternatives will give you same EPS? That is what we are trying to find out here. Meaning you can go for any of them, you will get the same result, same end result as an EPS. Okay, how do you calculate this? Given us fancy formula, EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1 is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Okay. All right, this should be equated. Both this should be equated. Okay, then you will find out EBIT. What is this formula, sir? Okay. Anyway, we have done many questions. Our regular students will not be asking this, or even those guys, you must have applied this. This is not a fancy formula, guys. This is a very simple one. See, how do you calculate EPS? To calculate EPS, we take earnings available to equity shareholders or net income. Yes or no? Earnings available to equity shareholders divided by number of equity shares. Correct? This only has been expressed as this particular formula. Check if you want. From EBIT, if you deduct interest, what EBIT, you know, I1 means interest under first option because you have two alternatives, right? Interest under first option, we call it as I1. From EBIT, if you deduct interest, what are you going to get? From EBIT, if you deduct interest, you're going to get earnings before tax. From this, if you deduct the tax, you're going to get earnings after tax. From this, if you deduct the preference dividend, you're going to get earnings available or attributable to equity shareholders. And we need this for our EPS calculation. Yes or no? This only they are represented as an equation. Check. EBIT minus interest if you do. You got to get earnings before tax. From this, you have to deduct tax rate. Either you can write minus tax rate or you can do 1 minus tax rate. I told you already previously. If you do 1 minus tax rate, directly you're going to get after tax wala number. Yes or no? So if you do 1 minus tax rate, 1 minus T, T here stands for tax rate. From EBT, directly you're going to get earnings after tax. If you want, you can prove. Let's say earnings before tax is 100 rupees. Tax is at the rate of 30%, let's say. Okay, which is 30. 100 ka 30% is 30. So what will be earnings after tax? 70. Okay. One way to get the 70 is what? You can do EBIT minus tax, meaning 100 minus 30 if you do, you're going to get 70. That is one option. Or you can also do, if you want to get directly earnings after tax, simply you can do earnings before tax into 1 minus tax rate. You can do this. What is earnings before tax? 100 into 1 minus tax rate. What is tax rate? 30%, which is 0.3. So 100, 1 minus 0.3 is 0.7. So do this. What are you getting? 70. Are you not getting the same number? Yes. So if you do multiply by 1 minus tax rate, directly you're going to land up with earnings after tax. That's what they've done here. Okay. So if you do this 1 minus tax rate, you're going to get earnings after tax. Do we need earnings after tax for our EPS calculation, or what do we need? We need each. For that each, you also need to deduct preference dividend. So if you do this, effectively, what are you going to get? Only are going to get earnings attributable to equity shareholders. So it's not really a fancy formula. That's what they've given. Okay. Divided by E1. E1 is nothing but the total number of equity shares. So why have they written 1? Because we have two options here, no? So the number of shares under first option, we call it as E1. Right? Again, indifference point means what? Both options should give same EPS. Hence, this is equated with another option. This is option 1 ka EPS calculation should be equal to option 1 ka EPS should be equal to option 2 ka EPS. Yes or no? That is what is your indifference point. So how do you calculate EPS under option number 2? Same. Take EBIT minus I2. I2 means interest under option number 2 into 1 minus tax rate minus preference dividend divided by E2. E2 as in number of equity shares under second alternative. Okay, this you equate. Generally in these problems, now every data will be given to you in the problem except EBIT. Only EBIT will be question mark. Rest every data will be available to you. So when you solve this equation, directly you're going to get EBIT. Okay. So let's say you solve that equation and you got EBIT to be 1 lakh assumption. Then what is the conclusion is? If the EBIT is 1 lakh, you got this 1 lakh after solving this equation, right? So if you get EBIT after solving as 1 lakh, what it means is, if EBIT is 1 lakh, whether you go for option number 1, that is equity shares, or whether you go for option number 2, that is debt, both the alternatives will give you same EPS. Okay, same EPS, no change. Not 0 EPS, same EPS. That EPS could be 2, 3, 0.5, 0.8, anything. But both will give you same alternative. Okay, this is one question also that gets often tested in the examination. All right. So yes, these are the concepts which are important from this topic for an examination. And also one more. There is no indifference point for debt and preferentials. There is no indifference point for debt and preferentials. We have indifference point only for equity and debt. Okay. For debt and preferentials, there is no indifference point because debt plan will always dominate preferential plan. If you want, we have also done in our regular class. If you calculate for debt and preference shares, you will not get the answer. You will not be able to solve that equation. Equation will get nullified. One of the problems we have seen it. Why? Because the debt plan will dominate preference shares plan. The reason being, on the debt plan, you get tax benefit. On a debt, meaning on your loan or debentures, the company will pay interest. And interest is an expense. Due to that expense, your profit will reduce. That means your tax also will reduce. So because of this debt, there will be savings in the form of tax. That only we call it as tax benefit or tax shield. But on preference shares, there is no tax benefit. You will not get any tax benefit on preference shares. Hence, a debt plan is always preferred to preference shares plan. If there is two options for the company, either to raise the money through debt or through preference shares, company will always prefer a debt plan because on debt plan, you pay interest and you get tax benefit. On preference share, you pay dividend at fixed rate, but on that dividend, you don't get tax benefit. Okay, that's the reason companies will always prefer debt over preference shares plan. Hence, between these two plans, there is no indifference point. Okay, all right. This is one. Let's do a thing. Let's apply in one of the questions normally from this chapter. What sort of questions you can expect, we will see. This question came in December 2021 paper. Let's run through this. Question number 3. Earnings before interest and tax of the company, meaning EBIT of a particular company is 4,50,000. Currently, the company has 80,000 equity shares of 10 each. That means your equity share capital will be, they have 80,000 shares of 10 each. So currently, the equity share capital is 8 lakhs. Retained earnings is 12 lakhs. Okay, they are only saying all this number. Okay, it pays annual interest of 1,20,000 on 12% debentures. So they're paying interest of 1,20,000 on 12% debentures. That means, can you tell me what is the value of 12% debentures? We already previously just now saw it. How do you get the value of debentures? That is nothing but interest amount 1,20,000 divided by interest rate. What is the interest rate? 12% or 0.12. So if you do that, 1,20,000 divided by 0.12, you're going to get 10 lakh rupees. So the company has debentures worth 10 lakh rupees. On 10 lakh, you're paying 12% interest rate. Hence, the interest rate is 1,20,000. That's what they've given. Okay. So this is the capital employed of a company. Capital employed means total source of finance taken by the company. The company is using three sources: equity shares, retained earnings, debentures. So total capital employed or existing capital employed I can write. When you add all of this, 8 plus 12 plus 10, which is 30 lakhs. Okay. The company proposes to take up an expansion scheme which needs an additional fund of 6 lakh rupees. So they want to do some expansion. To do this expansion, the company feels they need more capital or they need more finance to the extent of 6 lakh. Already they have taken a capital of 30 lakh. Now they need extra capital of 6 lakh rupees. When I say here in FM, no capital, don't be misled. Capital here means the source of finance. Okay. Only in accounts, capital means equity share capital or preference share capital. When in FM, whenever we use capital, capital means a source of finance. All right. It is anticipated that after expansion plan, the company will be able to achieve the same return on investment as at present. Currently, how much return we are able to generate, they are saying if we take a new project, no, the same return will be maintained. Meaning currently if we are getting 10% from our return from our existing project, after the new project also we will be able to achieve the same return is what they are trying to say. First of all, can you tell me what is the return? Return here means the rows. You remember return on capital employed we did? How do you get return on capital employed? EBIT divided by capital employed into 100. You have taken a total capital of 30 lakh rupees. How much return or how much EBIT you are able to generate? 4,50,000. Using 30 lakh finance, you are able to generate a return of 4,50,000. So what is your return percent? 4,50,000 divided by 30 lakh into 100, which is 15% is your return or existing return on capital employed. Currently, the company is achieving this much. They are saying if the company goes for this new project, same return they can expect. Same return will continue is what they are saying. Okay. All right. All right. 1 minute. Hang on. Maybe then I'll put up here. Can you tell me what will be the new EBIT then? The existing EBIT is 4,50,000. What will be the new EBIT? Because if you take up new project, you will not make the same earnings. No? Your earnings will increase. Your existing earnings is 4,50,000. What will be your new EBIT? On new project also you will earn a return. On new project, how much is the capital you are taking or how much is the finance you are taking? 6 lakh. By taking 6 lakh finance, how much return can you generate from the new project? They are saying how much ever return you were generating from the old project, same return will continue. Meaning on the 6 lakh new project or new capital employed, on that also you will be able to achieve 15% return. That means the new EBIT will be how much? 6 lakh of 50% is 90,000. That means this will be 5,40,000. So if company takes this new project, then the total EBIT of the company after the new project will be 5,40,000. Meaning from 4,50,000 it will become 5,40,000. Hope till here it's clear for everyone. Okay, these are all working note. Quickly I'm solving. That's all. Okay. All right. It can raise the funds either through debt at the rate of 12%. They need 6 lakh rupees additional money for new project. No, that they are saying. We can raise the 6 lakh rupees additional money by issuing debt. On that debt, we have to pay interest rate of 12%. So previously also 12%. On new debt also, interest rate is they're saying 12%. Okay, that is one option. To raise the 6 lakh with the help of debentures or debt. Or by issuing equity shares at par. Or the 6 lakh rupees you can raise with the help of equity shares. That means, can you tell me how many number of equity shares you need to raise? 6 lakh rupees totally you will raise from equity shares. And they're saying these equity shares are issued at par. The par value they've only given. Par value means the face value. Totally 6 lakh rupees you're raising from equity shares. And on one equity share, company will receive 10 rupees. So how many shares or how many equity shares the company needs to raise? 60,000 shares. Okay. That is option number 2. One is to go for debt entirely or another one is to go for equity entirely. 2 options. So let's see what are the requirements. Compute the earnings per share. Compute the EPS. If additional funds is raised through debt, that's 6 lakh rupees. If you have raised through debt means what will be your EPS is what they're asking. First requirement. If the additional funds were issued by equity shares, if the 6 lakh additional funds, if we raise it through equity shares, then what will be the EPS is what they're asking. Those are the requirements. Advise whether the company should go for expansion and which source of finance should be preferred. So you need to give two advices. One, first of all, should we take this new project by raising an additional fund of 6 lakh rupees? That is the first question. If at all you say yes, new project is worth it, then second question you need to answer here is, how are you going to raise that 6 lakh rupees? Will you go for equity option? Will you go for debt option? Simple approach for all the three, no? For the existing scheme, current data, and for the new project. One is the existing scheme. Simply what we have to do is we have to find out EPS under three buckets or under three pillars. One is the existing EPS. Without the new project, currently, what is my existing EPS? That is one. Then if you go for, suppose you're going for new project, you are going with the help of debt option. That 6 lakh rupees you raised with the help of debt. In that case, what is your EPS? You need to compute. Suppose that 6 lakh rupees you raised in the form of equity. Then what will be the EPS? Compare. Let's say this is 1, this is 1.2, let's say this is 1.1. Okay. Then how your selection will be based is, this is your EPS. I've assumed this number. Whichever option gives you the highest EPS, that should be selected. My existing EPS, I've assumed it to be 1. If you go for debt option, your EPS is 1.2. Equity option means it is 1.1. So which is giving you the highest EPS? The debt option. Like that you have to conclude. Basically for all these three, I need to just simply find out EPS. That's all. Okay, simple one. Can we fast do it? Alright. To calculate EB or EPS, what and all data I require? Maybe quickly we'll calculate off particulars, existing, and new project we are raising through debt option, and new project we are going for equity option. To calculate EPS, no, we require each and number of equity shares. So first we will start with EBIT. Do you know EBIT? Yes, we have already calculated. Existing EBIT is 30 lakh. But if you go for new project, this is the new project. If you go for new project, whether you raise the money through debt or through equity, EBIT they told will be same. That will not change. New EBIT, well, if you go for new project, is 5,40,000. Doesn't matter whether you go for debt option or whether you go for equity option. Okay, EBIT will be same. This is earnings before interest. No. Okay, earnings before interest will be same. If you go for debt option, then the interest amount will change. If you go for equity option, number of equity shares will change. But earnings before interest and before tax will be same. Doesn't matter whether you go for debt or equity, both will give you same option. From this, what do you need to do? Deduct interest. One on the existing and one on the new. Existing debt and new debt. Check. Company currently has some debt. Yes. Currently they have 10 lakh debt and these are 12% debt. That means how much interest company currently is paying. They only told. Currently company is paying an interest of 1,20,000. Currently company already has some debt. On that you have to pay 1,20,000 interest. So it doesn't matter whether you go for which option, this will still continue because that's already issued. New debt. The existing option, new debt will not come. New debt will only come if you take new project. And new debt will only come if you go for debt option. How much money you need for new project? 6 lakh. The interest rate is 12%. That means here it will be 72,000. Yes or no? If you go for new project under debt option, 72,000 extra interest will come. If you are raising the money through equity shares, then obviously the interest on new debt will not come because you are raising the money through equity. That means what will be your earnings before tax? 30 lakh minus this 1.2 will be how much? 28.2 or 28.8 lakh rather. Alright, this will be 5,40,000 minus 1,20,000 minus 72,000 will give me 3,48,000. That will be 5,40,000 minus 1,20,000, which will be 4,20,000. Okay, you got earnings before tax. What do we need to do now? Deduct the tax rate. Tax rate have they given in the problem? Yes, somewhere. Tax rate is 40% they have given. So let's write that. Tax at the rate of 40%. So 28,80,000 into 40%, that will be 11,52,000. And so your earnings after tax will be 17,28,000. From this you have to deduct the preference dividend. Company has some preference shares? No, they don't have preference shares. They only have equity shares and debentures. So if you have no preference shares, that means what? No point in deducting this because earnings after tax itself will become ish because there is no preference dividend. That divided by number of equity shares. This we can call it as 1. This is 2. Number of equity shares. Currently, how many equity shares we have? We already calculated that. Company has 80,000 equity shares currently. That means what will be your EPS? EPS 3 is equal to 1 divided by 2. As in each divided by number of equity shares. If you do that, my calculator is showing 17,28,000 divided by 80,000. That is 21.6. 21.6. Our number somewhere we didn't wrong. Somewhere we took your number wrong. Oh, 1 minute. Okay, existing EBIT, I took it as 30 lakh. What is 30 lakh? 30 lakh is not EBIT. 30 lakh is capital employed. No, my bad. Actually, existing EBIT is how much? Existing EBIT is only 4,50,000. Oh, okay, my bad. All the things I took, but this one I did incorrectly. This is 4,50,000. Existing EBIT, I think they've also given in the problem, no? Oh, no, in fact, we computed that. No, given here, 4,50,000. My bad. I took 30 lakh there. Okay. So 4,50,000 minus 1,20,000 will give me, all these numbers will change. So this will give me 3,30,000. So tax at the rate of 40% will give me 1,32,000 minus 3,30,000 will give me 1,98,000 divided by 80,000 will give me 2.475 is what I'm getting. 2.475. That is the number. In fact, they have also arrived at. Okay, that is your existing EBIT. Got it? I took capital employed instead of EBIT. That's why. Hence the numbers change. Rest everything is correct. Okay. All right. So if you go for new project, EBIT will be 540. That we have okay. That till here we worked out. Tax rate, let's find out. 348 ka 48. What is that? 348,000 into 40% will be 1,39,200. That means your each will be 208,800. Number of equity shares will be 80,000. Why? Because you are raising the 6 lakh rupees through debt. If you are raising through debt means will the number of equity shares change? No, you had 80,000 before. Now also it will be 80,000 only. That means your EPS will become 2.61. Okay. That is what they have got here as well. 2.610. Last, if you go for equity option, what will be your EPS? So till here we worked out. So 4,20,000 is your earnings before tax. Into 40% if you do, it will be 1,68,000. So 4,20,000 minus 168 will give you 2,52,000. Number of equity shares here will not be 80,000. Why? Because you are raising 6 lakh rupees money for the new project by issuing extra equity shares. How many equity shares you issued as extra? We already computed here, which is 60,000. 80,000 you already had, 60,000 more you issued. That means the number of equity shares will become 1,40,000. So if you calculate this, the EPS you're getting is 1.8. Which option is giving you the highest EPS? The debt option. That means that's what we need to select. So that's a conclusion. When the expansion scheme is financed by additional debt, EPS is higher. Hence, the company should finance the expansion project by raising debt. So conclusion is yes, the company should go for new project because from 2.475 EPS is increasing. So it is worth doing the new project. And whatever money is required for the new project, no, to raise it through debt option because that option is giving you the highest EPS. That's all is this particular question all about. Again, this question was asked for about 10 marks. Okay, so that's about the capital structure wala fund. Okay. Next, we shall dive into next topic, which is leverages. Okay, what is this leverage all about? Okay, first of all, leverage means it is trying to study. Leverage means it's trying to study or influence of one financial variable over another financial variable. The influence of one financial variable over another financial variable, we call it as leverage. So which variable are we talking about? We are trying to study here through leverage the impact of fixed expense. Due to fixed expense, how your EBIT or your EPS is going to change. Because of fixed expense, what will be the change in EBIT and what will be the change in EPS is what we are trying to study in leverage. Okay, the important component for leverage is fixed expense or fixed cost. If there is no fixed cost, there is no leverage. Leverage will only come into play if the company has some fixed cost. Okay, that's all. Only if you have fixed cost, then there is a leverage analysis. Otherwise, no. Okay, so that's it. Okay. All right. There are three types of leverage that generally they ask in the examination. One is operating leverage, financial leverage, and combined leverage. Operating leverage, financial leverage, and combined leverage. All right. let's do a thing. I'll just give you a little background maybe of this so that you'll be able to, I'll give you a small case study. Okay. That'll help you to remember. There are again 3 to 4 formulas that you need to remember. Out of that case study, you'll be able to remember those formulas a little better. So what is this? Maybe we'll study over here. Last year, change, current year. Okay. I'm going to take some numbers and then prove it to you what I'm trying to prove. Okay. Let's say sales in the last year was 10,000. We know this format, right? Sales minus variable cost, or maybe first I'll write the format. Sales minus variable cost, you're going to get contribution. All of you have done this in your costing component, costing syllabus, whether in your inter or CA inter or BCom somewhere. So sales minus variable cost is contribution. From contribution, if you deduct the fixed cost, excluding interest, meaning fixed operating cost, we say, contribution less fixed operating cost, meaning excluding interest, will give you EBIT. From EBIT, if you deduct interest, you're going to get earnings before tax. From this, if you deduct the tax, you're going to get earnings after tax. Okay. Anyway, in the previous section only, I told you that debt plan will dominate preference share plan. So we will take this itself to be ish. So companies will be favorable in taking a debt, meaning a loan from bank or debentures, than issuing preference shares. So that's the reason I'm assuming preference shares in this example is not there. If preference shares is not there, preference dividend also will not come. So earnings after tax and earnings available to equity shareholders will be same. Then we have number of equity shares. Then you are going to get calculate EPS. I'll call this as 1, 2, 3. EPS is given by 3 is equal to each divided by number of equity shares. Okay, let's take some numbers, random numbers. Sales is, let's say, 10,000 rupees. Let's say variable cost is 70% of sales. How much ever is sale, 70% of that I've assumed it to be variable cost. So 10,000 ka 70% will be 7,000. So sales minus variable cost is contribution. So if variable cost is 70% of sales, means contribution will be the balance, which is 30% of sales. Okay. Fixed cost, let me assume it as 2,000 rupees for simplicity. So your earnings before tax is 1,000. Interest, I'll assume all these numbers that I'm assuming. Let's say it is 500. So your earnings before tax is 500 again. Okay. All right. Tax, so let's say is 30%. So 500 ka 30% will be 150. So your ish will be 350. Let's say number of equity shares is 100 assumption. That means your EPS is 3.5. Okay, 350 divided by 100, 3.5. All these numbers are assumed and I've got these numbers. Okay, all cool so far. This is for the last year. This is for the last year. Let's say in the current year, no, sales has increased by 10%. In the current year, sales has increased by 10%. That means will it be 10,000? No, from 10,000 it has increased by 10% means it will become 11,000. What will be variable cost? Variable cost we know is 70% of sale. So 11,000. 11,000 ka 70% if you do, it will be 7,700. Meaning this also will increase by 10%. Yes or no? 7,000 plus 10% if you do, it will become 7,700. So 11,000 minus 7,700 if you do, you're going to get 3,300. Last year contribution was 3,000. This year it is 3,300. That means this also has increased by 10% because all these three go hand in hand. Sales, variable cost, contribution. If sale increase by 10% means variable cost and contribution also will increase by 10%. Numbers are proving it to you. Yes. Now check, sir. Fixed cost last year is 2,000. Current year also will it increase by 10% or will it be same? Fixed cost means that expenditure which will remain the same irrespective of your activity. Whether your sales could increase by 10%, increase by 100%, increase by 5% or decrease by 20%, it does not matter. Fixed expense will be same. Hence the name itself is saying fixed. Fixed means it will remain constant. Meaning this year also it will be 2,000 only because there will not be any change. Now you check what is EBIT. It has become 1,300. Last year it was 1,000. This year it has become 1,300. That means this has increased not by 10%. It has increased by 30%. Yes or no? If you do in a calculator, 1,000 plus 30% if you do, you're going to get 1,300 rupees. So EBIT has increased by 1,300 or it has increased by 30% and it has become 1,300. 300. Interest is again a fixed expense. If you take a loan from bank, the interest will be same, yes or no? That means this will be what? Again 500 rupees. Okay, all right, because you have freeze the interest rate. Okay, all right, that means what will be your earnings before tax? It will become 800. Last year it was 500, now it has become 800. Means, can I say there is 60% increase? Calculate in a calculator. 500 plus 60%, if you do 500 plus 60% will give you 800. So your earnings before tax is increased by 60%. All right, what will be your tax? 800 ka 30%, which is 240. That means your EPS is 560. Number of equity shares, let's say it is same, it is not changed. That means your EPS has become 5.6. Check what is the increase. 3.5 plus 60% you do. 3.5 plus 60% if you do, you're going to get 5.6. That means my EPS is also increased by 60%. My EPS also 350 has become 560. That means this also has increased by, actually I don't need that, so it's fine. All right, so EPS is increased by 60%. Okay, what am I trying to draw over here? All right, so leverage analysis means, first, what is the first leverage? We'll understand with the help of this particular example only. First we calculate. Leverage means leverage will only come into play if there is fixed expense. Yes or no? In this problem, I've given you two fixed expense. Let's box of them. One is fixed cost is this, another fixed cost is interest. Yes or no? These are the fixed expense that we have in this particular problem. Okay. What leverage analysis is trying to say is, because of that fixed expenses, how your EBIT and your EPS is going to change is what we are trying to study. Okay. First study is operating leverage, we say. Operating leverage is given by the formula. First we will work it out through formula and then we'll just check. It is given by contribution upon EBIT. How to remember it? Simple. What is the first fixed expense you got? This one. Take one number above this, take one number below this. This is your fixed cost. Take one number above that, take one number below this. That is your operating leverage ka formula. One number above this is contribution, one number below this is EBIT. So contribution divided by EBIT is your operating leverage or OL. Calculate first. Contribution for the last year, we are doing last year data first, which is 3000 divided by, or maybe I'll do a thing. Okay, no problem, I think. Okay, 3000 divided by 1000. Oh, we'll work with that only. How much is this? 3000 divided by 1000 is 3. Yes. Now, what operating leverage is trying to study is, it is trying to study the relationship between sales and EBIT. Operating leverage is trying to study the relationship between sales and EBIT. If operating leverage is 3, then what it means is, for 1% change in sales, meaning if sales increases or it decreases by 1%, doesn't matter. Change means whether it could be increase or decrease. For 1% change in sales, operating leverage is 3, no? EBIT may there will be 3 times. How 3 times? 1% ka 3 times. Why 3? Operating leverage is 3. 1% into 3 is how much? 3%. So for 1% change in sales, there will be 3% change in EBIT. Change could be increase or it could be reduction. That is what operating leverage is trying to study. The relationship between sales and EBIT. Okay. If operating leverage is 3, just to make sure you have got it, let's say sales has increased by 10%. Sales has increased by 10% and operating leverage is 3. Then your EBIT will increase thrice of that, because operating leverage is 3, right? Then EBIT it will be what? 10% into 3. That means EBIT should increase by 30% as per the formula. Yes or no? Figure it out. Did that happen? See here, sales increased by 10%. What happened to EBIT? Did it increase by 10%? No, it increased by 30%. So to get the impact on sales versus EBIT, you can either do it like this and get it. But these are all too fancy, correct? Too lengthy affair. Yes. Instead of that, simply you can calculate that impact with the help of operating leverage. If operating leverage is 3, then for 1% change in sales, there will be 3 times or 3% change in EBIT. That is what it tries to measure. So operating leverage, we call it as business risk. Operating leverage, we call it as business risk. This is the first leverage which we are trying to study. So why did it increase by 30%? The culprit there is fixed cost. Check. All other number increased by 10%. But what happened to fixed cost? Earlier also it was 2000. Now also it is 2000. Because of your fixed expenses, right? Your EBIT has increased by much more. That is what is leverage. Leverage analysis revolves around this fixed cost expenses. Because fixed cost is a risky affair, yes or no? Fixed cost expense is risky because why? Doesn't matter whether your sales is 1 rupee or 1 crore rupee. Fixed expense you have to pay. Here, if the fixed cost is 2000 rupees means like rent, like we are conducting classes in a rented building, whether 1 students come or 1000 students come, my rent has to be same. I have to pay rent to the landlord. I can't tell him, no, only 1 student came, I will not pay rent this time. It will not work. If I say like that, he will say, you vacate the premises. Yes or no? Like that only he will say. Yes. So hence fixed expense is risky. So it's more risky. And obviously it's natural phenomenon. No? If you're taking more risk, your return also should be higher. That is what leverage analysis is all about. Since you are having fixed expense, that means there is more risk associated with your business. If your sales increase by 10%, your EBIT will not increase by 10, it will increase by much more. That is what operating leverage is trying to study. Okay. Hence it is given by the formula contribution upon EBIT. This is one way to get operating leverage. There is another formula also to get operating leverage, which we call it as degree of operating leverage. Don't be misled by the term. Both the formulas will give you the same answer. That's given by the formula. First of all, what is operating leverage trying to study? It's trying to study the relationship between sales and EBIT, right? Sales and EBIT. So this is given by the formula percentage change in EBIT divided by percentage change in sales. Percentage change in EBIT divided by percentage change in sales. Do you know percentage change in EBIT? Yes, 30%. Percentage change in EBIT is 30%. Do you know percentage change in sales? Yeah, last year it was 10, this year it is 11. That means the percentage change is 10%. So 30 divided by 10, how much is it? 3. Whether you work out under this formula or the other formula, final answer will be same. So when to apply which formula? Sir, if they give you only 1 year data, if only 1 year data is available, then you use this formula. Okay. If they give you multiple year data or if they give you percentage, then you can go for this one. Because to find out percentage change, no, when will you find out change? Change you will get only when you can compare two things. Yes, no, last year data with current year data. Only when you have 2 data points or 2 data to compare, then only you will be able to calculate something known as change. So if they give you 2 years data or if they give you this change percentage, then you can use this formula. Otherwise, you can stick to this one. Okay. How to remember? I have simply given you there. Visualize your order of your P&L like this one. Okay. Freeze your fixed cost. Take one number above fixed cost, take one number below fixed cost. One number above fixed cost is contribution, one number below that is EBIT. Hence, contribution divided by EBIT will give you operating leverage. That's all. Okay. This is one. All right. Then we have something known as financial leverage. Financial leverage measures financial risk. Operating leverage measures business risk. Because when you're doing a business, no, as part of your business, you will have some fixed expense and you'll have some variable expenses. So that fixed expense relating to business, it is what it is operating leverage is trying to measure. Okay. But also when you do some business, you may need some money. Yes. That money you can raise it by going for equity option or a debt option. If you're going for debt option means there will be some interest component and interest on loan or interest on debt will be fixed. So that is the financial risk. So financial leverage is trying to measure financial risk, meaning by taking a debt, okay, what is happening? Okay, that is what it's trying to measure. Financial leverage is trying to measure the relationship between EBIT and EPS. Financial risk is trying to measure the relationship between, because operating leverage started from sales and it analyzed till EBIT, right? Financial leverage is trying to study from EBIT till the last number, which is EPS. So EBIT to EPS, it is trying to compare. That's what. Okay. That is what it's trying to study. So financial leverage is given by the formula. Again, same trick. Now one fixed expense is already gone. Check. Is there any other fixed expense? Yes, interest. Take one number above this, take one number below this. Above interest, what is there, sir? EBIT. Below interest, we have EBT. Financial leverage is given by the formula EBIT divided by EBT. That's all. EBIT upon EBT. What is EBIT? EBIT is 1000. Okay. Divided by EBT. What is EBT? 500. Okay. 1000 divided by 500 if you do, you're going to get 2. 5000 divided by 500 if you do, you're getting 2. What does this mean? Financial risk is trying to study the relationship between EBIT and EPS. Meaning for 1% change in EBIT, change meaning increase or decrease, does not matter. For 1% change in EBIT, there will be double 2% change in EPS because financial leverage is 2. That is what it is trying to say. Okay, just to make sure you have, let's say EBIT has increased by 10%. If EBIT has increased by 10% assumption, then what should happen? Then your EPS, since financial leverage is 2, EPS will increase by 10% into 2, which is 20%. So if financial leverage is this, then this should be the end result. Okay, this is just an assumed number. Let maybe take this data. Here what happened? EBIT increased by 30%. In our actual data that we took, EBIT has increased by 30%. Financial leverage is 2. That means you tell me, sir. Therefore, what will happen to EPS? Since EBIT has increased, EPS also will increase by the same percentage? No. Since financial leverage is 2, twice of that, 30% into 2, which will be what? 60%. Check. This is what as per our analysis we are getting. Our case study also gave the same thing. Huh? See here, EBIT increased by 30%. What happened to your EPS? EPS increased by 60%. So leverage is a short form of analysis. That's all. Okay. Instead of doing this whole data and trying to analyze, no, we can just simply apply it as formula and get it. That's all. So operating leverage deals with operating risk or business risk. Financial leverage deals with financial risk. Then we have something known as CL. CL as in combined leverage, which measures total risk. From the topmost number till the bottommost number. Combined leverage is trying to measure the relationship between topmost number, which is sales, and bottommost number, which is what? EPS. So combined leverage is trying to analyze the relationship between sales and EPS. That's all. Okay. So combined leverage is given by the formula operating leverage into financial leverage. Take operating leverage multiplied by financial leverage. What is operating leverage? Operating leverage is 3. Combined leverage is 2. So 3 multiplied by 2 you do. Combined leverage is 6. Okay. So what is the conclusion then? Okay, this if you want you can present. This is one way of presenting combined leverage, or you can also write. What is operating leverage ka formula? Contribution upon EBIT. What is financial leverage ka formula? EBIT upon EBT. So what will happen? EBIT will get cut. So what remains? Contribution upon EBIT. Like this also, if you want, you can find out the combined leverage. Is that okay? That's what I've written here on the chart also. Okay. Combined leverage is nothing but contribution upon EBT. Done, people? Or rather, this one is not EBIT. This should be EBT. EBIT got cut now. So this should be EBT, correct? That way also you can calculate. Or simply for examination, do this. This is a lot simple. Okay. Operating leverage multiplied by financial leverage is your combined leverage. Let's do the analysis. So what happened in our case studies? In our case study, sales increased by 10%. In our case study, sales increased by 10%. Now combined leverages, we calculated, we got it to be 6. Combined leverage measures the relationship between sales and EPS, the topmost and bottommost number. If sales is increased by 10% and if my combined leverage is 6, then what will happen to my EPS? You tell me, sir. For 10% increase, EPS will increase by 6 times, meaning 10% into 6, which will be 60%. Is that the results? Check. Sales increased by 10%. What happened to my EPS? It increased by 60%. So these are the short form of analysis. That's all. Okay. Which you can refer and do it. All right. That's with respect to these are what they ask you in the examination. Operating leverage, financial leverage, and combined leverage. As I told you, operating leverage measures the relationship between EBIT and sales. Operating leverage we refer to as business risk. It's given by this formula. There are 2 formulas to get it. Similarly, for financial leverage also, no, there are 2 formulas. One formula we already wrote. What is that? EBIT divided by EBIT. EBT rather. Or you can also get degree of financial leverage. What does financial leverage measure? The relationship between EBIT and EPS, right? So the formula will be given by percentage change in EPS divided by percentage change in EBIT. This way also you can do. percentage change in EPS divided by percentage change in EBIT. Calculate what is the percentage change in EPS. EPS increased by 60%. Percentage change in EBIT. EBIT increased by 30%. So 60 divided by 30 gives you the financial leverage as 2. Whether you use this formula or the second one, the final answer will be same. Okay. All right. So those are the things relating to the operating leverage and financial leverage. Combined leverage also, it measures the relationship between sales, the topmost number sales and bottommost number EPS given by this particular formula. Okay. All right. So one more you need to remember is sometimes they don't give you sales and all that stuff. They give you something known as margin of safety. There's a costing related concept that they have brought in here. Sometimes instead of the plain data, the sales or contribution and all, no, that will be missing. Other than that, they will give you something known as margin of safety, which I'm calling it as MOS. If they give you margin of safety, then using margin of safety, you can find out operating leverage. I proved it to you in the regular class when we take an example and we proved it. Operating leverage is given by the formula 1 divided by margin of safety. 1 upon margin of safety, if you do, you're going to get the operating, the leverage. That's another way to get it. So what is margin of safety, or how do you calculate that? To calculate margin of safety, you require break-even point. Okay, those are all connected. How do you get break-even point? All these are costing things you have already done. Break-even point, if you need it in units, that's given by the formula fixed cost divided by contribution per unit. The total fixed cost divided by contribution per unit, if you do, you're going to get the break-even point in units. First of all, what is break-even point? It's the point where if let's say break-even point is 1000 units. If the break-even point is 1000 units, then what it means is if the company sells 1000 units, neither they will make some profit nor they'll make loss. That's what we mean by break-even point. No profit or no loss. If they sell 1000 units, company will neither make profit nor make loss. That's your break-even point. Okay. If you want that in units, that's given by the formula fixed cost upon contribution per unit. However, if you want break-even point in value, that's given by the formula fixed cost upon PV ratio. Fixed cost divided by PV ratio, if you do, you're going to get break-even points in value. So how do you get PV ratio? Again, you have done it in costing. PV ratio is given by contribution upon sales into 100. Contribution divided by sales into 100, if you do, you're going to get the PV ratio. So how do you get margin of safety? Margin of safety is nothing but actual sales or total sales minus break-even point sales in value. Total sales minus, or total sales you can call it, or actual sales you can call it, no problem. Actual sales or total sales minus break-even point sales divided by actual sales, you can get it as margin of safety. What it means simply, let's say the total sales of the company is 1,50,000. The total sales in value, the total sales made by the company in value, total value of the sales made by the company is 1,50,000 assumption. Let's say break-even point in value is, let's say, 1 lakh rupees. Break-even point is 1 lakh rupees in value again. Then what it means, see, total sales may be 150, but up to 1 lakh rupees, no, will the company make any profit or make any loss? No. Why? This is break-even point, no? Meaning, till 1 lakh rupees sales, no, company will recover all its cost. If the company sells 1 lakh rupees means, whatever cost they have incurred, they will recover. If they have spent 100 rupees means, they will recover 100 rupees. That means the company will neither make profit nor make loss. Yes. Only beyond 1 lakh rupees, if company is selling, no, then only profit will start. Yes or no? That we call it as margin of safety. Beyond 1 lakh only, up to 1 lakh, the company will whatever up to 1 lakh rupees, the company, all the money, or the company will only be recovering the cost. After 1 lakh, if the company is making any sales, means if the sale value is greater than 1 lakh, then only profits will start getting accumulated to the company. Yes or no? That we refer to as margin of safety. That's all. So here, for the first 1 lakh sale, companies will neither make profit nor make loss. All the cost will be recovered. After 1 lakh, how much ever sales the company makes, on that only company will start making some profit. Yes or no? That to be referred to as margin of safety. Is that okay? If you want to express it in percentage, tell me, sir, how do you find out? That is nothing but margin of safety divided by sales into 100. Yes or no? How do you get margin of safety? How did you calculate margin of safety as 50,000 here? That is nothing but actual sales minus what? Break-even point sales instead of margin of safety. Because if you do this only, you're going to get margin of safety, no? Divided by sales into 100. Yes or no? This is your margin of safety ka percentage. Like for GP percentage, what do you used to do? GP upon sales into 100. To find out margin of safety ka percentage, it will be margin of safety divided by sales into 100. And to get margin of safety, how do you calculate that? Actual sales minus BEP sales. Okay, hence the margin of safety ka formula is this. Okay, if you do this, you're going to get in full number. You may get it as 0.8 or something. If you want to get it in percentage, multiply it by 100. That's all. Okay, people. All right. If you give margin of safety, if they give margin of safety in the problem, then operating leverage you can get by doing 1 divided by margin of safety. That if you do, I proved it to you in my regular class. I think I'll not go that again into it because of the lack of time. So 1 divided by margin of safety, if you do, you're going to get operating leverage. That's another way to get the operating leverage also. Okay. And one more way, if they sell directly, sometimes they may ask you this also. If let's say break-even point sale is 75%, or let's make it as 80%, then can you tell me what will be margin of safety? Because how do you get margin of safety, sir? Total sales minus break-even point sales. Total we always know. What is the total? If break-even point is 80% means total will always be 100%. That means what will be margin of safety? 100% minus 80%, which will be 20%. This way also they can ask you in percentage. Directly they'll give you. Instead of margin of safety, they may give you directly break-even point is 80%. That means margin of safety indirectly will become 20%. With this, you can find out operating leverage. That's another way to find out the components. All right. These are some of the concepts that you need to remember as far as the leverage is concerned. Okay. So let's do a thing. Let's also see how the leverage sort of questions or what sort of questions can come through leverage. One of the questions we'll take this question came in July 21 paper. Let's read that. Company had the following balance sheet on 31st March 2021. Equity share capital 75 lakh shares of 10 each. All the numbers are in crores, they're saying. So 7.5 crores. They've given you all this data. We have 15% debentures. These are your current assets and fixed assets ka breakup. Total is 30 crores and 30 crores. Fine. Additional information is given as under fixed cost per annum excluding interest. So this is your fixed operating cost. Okay, fixed operating cost is 6 crore rupees. All right. Variable operating cost ratio. So variable cost they're saying is 60%. What is the 60%? 60% of sales. So they're saying variable cost is 60% means 60% of sales. That means your contribution will be balance 40% of sales because sales minus variable cost only will give you contribution. Yes. That means can I write contribution is equal to 40% of sales. Okay. Total asset turnover ratio is 2.5. Okay. If you check the problem, they have not given sales here. Okay. Only if you have sales, you can find out variable cost, you can find out contribution, etc., etc. And only when you get contribution, you can find out operating leverage, financial leverage, total, etc. So here that is missing. So they have combined ratio analysis topic with leverage topic over here in this particular question. This question also came for 10 mark. Total asset turnover ratio is 2.5. You tell me, sir, how do you get total asset turnover ratio? Total asset turnover ratio is given by the formula sales divided by what, sir? You can take average total assets. You will take average only when they give you 2 years data. Have they given 2 years data? No. So instead of average, you can take total assets. Sales divided by total assets. If you do, you're going to get total asset turnover ratio that they have given in the problem. How much is that? They're saying is 2.5. That means can I say sales is equal to 2.5 times of total assets? And total assets you know because they have given balance sheet. The total assets they have given in the problem to be 30 crores. So 30 crores ka 2.5 if you do, that will be what? So sales will be indirectly they're saying sales is 75 crore rupees is your sales. Got it. This is your working node. One working node you need to put it out to find out sales because that is missing over here. Once you know sales, rest everything you can aramse find out. Yes or no? Here simple. We know the format, right? Sales minus variable cost is contribution. Contribution minus fixed operating cost. Contribution less fixed operating cost will give you EBIT. From EBIT, if you do interest deduction, you're going to get earnings before tax. From this deduct tax, you're going to get earnings after tax. We read the problem. We don't have any preference shares here. Since there is no preference shares, there is no preference dividend also. Meaning this only will become each 1, 2 and number of equity shares. If you do, then you will be able to calculate EPS. Correct? Let's see what they've asked in the problem. Okay, we have read the data. Income tax rate is 40%, they're saying. Calculate the following. You need to calculate EPS, operating leverage, financial leverage, combined leverage. That's all. Sales, you already know, we calculated. From working note number 1, sales is 75 crores. All the numbers are in crores. Variable cost, they only told. Variable cost is how much? 60% of sales they're telling. So 75 ka 60% if you do, that will be your variable cost, which is 45. So contribution will be 30. Okay, contribution is 30. Fixed operating cost, they have only given in the problem. Check. Fixed operating cost they've given in the problem. How much is that? 6 crore rupees. Okay, this is 6 crore. That means your EBIT is 24 crores. Interest given, not given, but debenture ka value is 15 crores and this are 15% debentures. That means what will be the debentures? What will be the interest? Debenture is 15 crore and the interest rate is 15%, means 15 ka 15% if you do, the interest will be 2.25 crores. So earnings before tax is 11.25. Tax, I think they mentioned it is at the rate of 40% somewhere. Yeah, tax is at the rate of 40%. So this will be what? 11.25 ka 40% will be 4.5. So your each will be 11.253. Number of equity shares they only given in the problem. 75 lakh shares. All these numbers are in crores. Number of shares they have given in lakhs. 75 lakh, if you have to express a number of shares, can I call it as 0.75 crores? 75 lakh is nothing but 0.75 crores. So your EPS will be 9. That is what they must have computed. Check. EPS, they have got it as, no, they got different number. Somewhere we did wrong. Final calculation wrong, is it? Just quickly, we'll just check. 3624, 2.25, all these are right, no? 11 point, no. Oh, somewhere here I've done it wrong. Oh, 1 second. Okay, this number. 24 minus 2.25, calculation mistake, that's all. This will be 24 minus 2.25 is 21.75. Okay. I mean, tax will be at the rate of 40%. So that means this will be 8.7. So 21.75 minus this will be, each will be 13.05. 13.05 divided by 0.7 is 17.4. That is a number. Okay. Again, dumber. That about 21.75 tax 40 only, no? Calculating wrong. 8.7, 8.7. 13.05 and the number of equity shares is 75. Oh, actually 1 second, hang on, 75 lakh shares. Okay, 13 crore 05, or we can take it in full number only. I have taken it also, you know. Same. Okay. 13 point, or did I punch in wrong number? 13.05 divided by 0.75. 17.4 only we're getting now. Oh, here again. Okay. I was checking this number. Okay, correct only. EPS is 17.4. That is your earnings per share. Quite simple problem. How much headache? Yes or no? This is the first requirement, calculation of EPS. Then they're asking operating leverage, financial leverage, and combined leverage. Operating leverage is given by the formula. One number above your fixed expense, that is contribution, and one number below, which is EBIT. Contribution is how much? 30. EBIT is how much? 24. So 30 divided by 24 you do. That will give you 1.25 is your operating leverage, second requirement. Then they've asked you financial leverage. That is what? Again, another fixed expense is interest. One number above interest, which is EBIT. One number below interest, which is EBIT here. One number above, one number below. So EBIT divided by EBT. EBIT is how much? 24. EBT is 21.75. So 24 divided by 21.75, that gives you your financial leverage of 1.10. I'll take. So combined leverage is nothing but operating leverage multiplied by financial leverage. So these two multiplication will give me how much? 1.21, 1.25, 1.10, and combined leverage is 1. The multiplication number, 1.25 into 1.1 will be 1.375 is a multiplied number. So combined leverage is 1.375. How much did they get? 1.375 or 379. That's okay. So these sort of questions you can expect in the examination. Okay. So that's with respect to the leverage. All right. So next we'll get started with investment decision. Now, investment decision ka scope is, the name itself is saying investment decision. So here we need to assess certain investments, should we take it up or not. To give you an example, let's say we are an academy. Let's say we are an academy, right? So we have a branch in, or we have our main office in Bangalore. Let's say we are thinking we should open a branch in, let's say, Hyderabad. So that is an investment decision. What is that? To expand or not, meaning to open another branch or not. Okay, that is one kind of investment decision. Okay, other investment decisions could be, say, let's say to conduct these classes, online classes or offline for that matter, we require various assets. Now, should we replace our old assets with a new one? That could be another investment decision that we may have to face. All right. Okay, let's say we decided to replace our assets with the old assets. We're planning to replace it with new one. Let's say laptops. We want to buy new laptops. Then the investment decisions could be, which laptop should we buy? Because there are many brands of laptop available. Should we go for Windows laptop or should we go for MacBook laptop? If we say we want to go for Windows laptop, there are various brands, Acer, Sony, Dell, etc., etc. So which one among them to buy? Okay, so these are all the scope, or these are all the things that we need to do in this particular topic, that is investment decision. Okay, whether should we take up that investment or not, or should we take up that project or not, is the scope of this particular topic. Okay, to assess these sort of decision, or to make these sort of decision, there are various techniques or various methods. So let's go over those methods one by one. First one is payback period. Payback period. What does payback period mean is, okay, within how many months or within how many years you will recover your investment. To take any investment decision or to take up any new project, you require funds. All right. So payback period is trying to assess in how many months or in how many years we will recover that invested amount. That's all is payback period. Okay. Now, how to find out that? It's very simple. If the benefit or if the cash flow, see, if you're doing any particular project, means from that project you will get some benefits or some cash flows. If that particular cash flow is constant, if that annual cash flow is constant, then payback period can be ascertained with a simple formula: initial investment divided by annual net cash flow. Like, to give you an example, let's say to start a particular project, I require an investment of 2 lakh rupees. Okay, to start a particular project, I require an investment of 2 lakh rupees. If I do this project annually, I'll get a cash flow or cash inflow of, let's say, 40,000 rupees. Every year, I'm going to get a cash inflow of 40,000 rupees. So my payback period will be, in how many years will I recover this 2 lakh back? That is simply given by initial investment 2 lakh divided by annual net cash flow, which is 40,000. If you do this for 5 are 20, so 5 years, meaning within 5 years, you can recover your investment. That's all this particular payback period tries to assess. Within how many years will you recover your investment? Okay. All right. So what to do if the cash flows are not constant? Meaning, what if this annual net cash flow, it is not same every year, rather it is fluctuating? In that case, what you have to do is you have to go for cumulative approach. What does cumulative approach mean? Let's take the same example. My initial investment, meaning my outflow is 2 lakh rupees. Let's say first year, or rather year I will write. Year 1, 2, 3. My first year, my cash inflow is, let's say, 80,000. Next year, let's say second year, it is 70,000 cash inflow. Third year, it is 50,000. Then what does this, since the cash flow is not constant, you have to do something known as cumulative approach. What does that cumulative approach means? Just find out cumulative cash inflow. That's it. Cumulative means first year ka cumulative cash inflow is same 80,000 only. Second year ka cumulative. Cumulative means till date what is the cash flow. So till second year, how much cash flow have you achieved? First year you have achieved 80,000. Second year you have achieved 70,000. That means the total is 1,50,000. Like that. That's what is your cumulative cash inflow. Similarly, third year ka cumulative cash inflow you find. First year ka 80, second year ka 70, third year ka 50. If you do that, you're going to get 2 lakh rupees. Like this, you add your all, you find out cumulative cash flow. check for which year your initial investment is getting matched out. At the end of third year, you are able to, or your cumulative cash flows, 2 lakh rupees. Yes or no? So that means what? Year 3 is your payback period. That's all is that. Either you go for a straight formula method if your cash flow is constant, or if it is varying, you do cumulative approach wala funda. Okay? Alright. This is about payback period. In how many years will you recover your investment? That's all. Alright? Next, payback reciprocal. Payback reciprocal, as the name itself is saying, payback reciprocal is given by the formula 1 divided by payback period. From the payback period, you do 1 divided by payback period, you're going to get a number that we call it as payback reciprocal. Okay. Now, why do we find out payback reciprocal is? We say payback reciprocal approximates IRR, meaning payback reciprocal will almost be equal to IRR if the life of the project is twice of the payback period. If the life of the project is twice of the payback period, let's say payback period is 3 years, okay, we want to do a particular project, that project ka life is, let's say, 6 years, okay. So what is the life of the project? Twice is the payback period here, because 3 into 2 if you do 6 years, 3 into 2 if you do 6. So if the life of the project, if it is twice of the payback period, then we say payback reciprocal will be approximating, or it will be more or less equal to IRR. Okay. You don't get numerical question based on this. Once I think they had asked a theory question about payback reciprocal. So yes, I've given in the normal notes, I've given you what are the points you need to write, but quickly just revising you over here. Okay. So payback reciprocal will be more or less equal to IRR if the payback period is twice of the, or if the life of the project is twice of the payback period. That's all is the funda. Okay. This is the second technique. Next technique is ARR, as in accounting rate of return, or you can call it as average rate of return also, some books will say. Alright. So how do you get ARR? ARR is simply given by the formula average net income divided by, either you can take initial investment in the denominator or average investment in the denominator. Anything is fine. Average net income. Net income means as per your P&L account. You'll have in your P&L account, you'll have net income, right? So take that, net profit basically, okay? Take that average annual net income divided by, either you can take initial investment or average investment. So how do we find out average net income? If they give you 3 years ka profit, let's say first year ka profit is 30, then 40, then let's say 50,000. If they give you 3 years ka profit like this, how do you find out average or something, sir? Add everything divided by 3. Why 3? Because 3 years ka profit. If you do that, it will be what? 1,20,000 divided by 3, which is 40,000. So this becomes your average net income. Basically sum up all the profits and divide by number of years. That's all. Okay. If suppose the profit is not given to you in the problem, in case they don't give profit to you in the problem, then there is another way to find out, okay, average net income. That is nothing but total cash inflows minus total cash outflow. If they don't give profit in the problem, but if they give you cash inflows and cash outflows, then the total of cash inflow, let's say for 10 years, they have given cash inflow is 1 lakh. And for 10 years put together, year 1 to year 10, they have given cash outflow to be, let's say, 20,000. From cash inflow, you reduce cash outflow for all the 10 years. If you do that, how much are you going to get? 80,000. So average net income will be cash inflow minus cash outflow divided by n, meaning 1 lakh minus 20,000. 1 lakh is your total cash inflow. 20,000 is your total cash outflows divided by n. N is the life of the project. Life of the project here is 10 years. So divided by 10 years. That will be how much? 80,000 divided by 10, which will be 8,000. So your average net income in that case will be 8,000. In our regular batch, we have worked out a problem also relating to this. Now quickly, just going through that. That's all. Alright. So that is your average net income ka, how you can figure it out. Now, initial investment is quite straightforward, right? To start a project, you require some money. So how much ever money you are investing, that only becomes your initial investment. If you want to take average investment, then average investment is given by the formula initial investment plus salvage value divided by 2. Initial investment plus salvage value divided by 2. Normally when you purchase any asset, the average investment is nothing but what, sir? When you buy if you want to do any investment, means you have to buy some assets. Let's say you bought the asset for 1 lakh rupees to do a project. Okay, so asset opening balance is 1 lakh. Basically, how do you get average? Opening balance plus closing balance divided by 2. Yes or no? Opening plus closing balance divided by 2 if you do, you're going to get average. Now asset, if you purchase for 1 lakh means the opening balance of that asset will be 1 lakh. At the end of the year, let's say the project life is 5 years. Asset will be depreciated, no? At the end of the life of the project, no, only salvage value will remain. The closing balance of the asset will be equal to salvage value. Hence, we say the formula is initial investment plus salvage value divided by 2. Okay, like you bought the asset for 1 lakh, original cost is 1 lakh. Let's say salvage value is 20,000. Life of the project is, let's say, 5 years. And how do you calculate depreciation under straight line method? Original cost minus salvage value divided by useful life, which is 5. So 80,000 divided by 5 if you do, you're going to get 16,000 depreciation per annum. Yes or no? So what will be the total depreciation then? For 1 year, depreciation is 16,000. So life of the asset is 5 years. That means total depreciation will be how much? 16,000 into 5, which is 80,000. Initially, when you bought the asset, the cost of the asset was 1 lakh. Can you tell me what is asset ka closing balance? Closing balance at the end of year 5. At the end of year 5, asset ka closing balance will be what, sir? You bought it for 1 lakh. So far, you have depreciated to the extent of 80,000. That means what will be the asset ka closing balance? 20,000. What is this 20,000? There's nothing but salvage value. To find out average, you do opening plus closing divided by 2. Closing balance of the asset will be equal to salvage value. Hence, this particular formula we have written. That's all. Okay. So, all right. What is ARR? ARR is accounting rate of return, or accounting, or you can call it as always average rate of return. Also, you can call it. That's given by the formula average net income divided by initial investment or average investment. How do you get average investment? Take initial investment plus salvage value divided by 2. That's all. All right. Alright, this is another technique of investment decision. At the end, I will tell you how to choose based on that. The decision rule, I have written it in a separate table. There we will go through. For now, we will just run through the various techniques of investment decision. Alright. Next is NPV. NPV is net present value. See, there are some disadvantages of the previous techniques. Previously, we saw payback period, the ARR, etc., etc. One of the main disadvantage or drawback of these methods are they don't give or they don't consider the time value of money ka importance. They don't consider time value effect for their decision making. So to sort out that, we have another techniques, or these we call it as discounting techniques. One such technique is NPV. Alright, net present value. NPV is given by the formula present value of cash inflow minus present value of cash outflow. From present value of cash inflow, if you divide, or from present value of cash inflow, if you deduct present value of cash outflow, the final number what we get is what we refer to as NPV. Now, what does this mean? Let's say you are doing one particular project. That project requires outflow or initial investment of, let's say, 1 lakh rupees. Okay. Now you have to invest. To start that project, you have to invest 1 lakh rupees. Let's say life of the project is 2 years. Okay. So year 1, year 2. If you're doing a project means you will get some inflows from the project also. You invest the money into the project and later you'll start, as and when you do the project, you'll start getting the inflows. Yes. Let's take it like this. Cash inflows. First year is 80,000. Next year is, let's say, 70,000. That means what is the total inflow you are getting? 1,50,000. Yes. How much did you invest? You are investing 1 lakh rupees now, and by the end of second year, you will recover how much? 1,50,000. Yes or no? Correct? Alright. Now, what is the problem is, straight away you cannot compare these two numbers. Why? Sir, you are doing the outflow now. You have to invest the money now. Not now only, or year 1 ka beginning only, we call it as year 0. Year 0 means now. Okay? Or year 1 ka beginning. You are investing the money 1 lakh rupees now, but this 1,50,000, are you recovering now? No, no, no. You are recovering at the end of second year. So straight away you cannot compare these two and take a decision. Alright? Because this is the present value. This is today's value. This 1,50,000, you are not getting it now. You are getting it after or by the end of second year or over a period of 2 years. That means what is this? This is FV as in future value. So both the values are on a different platform. So hence what do we need to do is, we need to find out the present value of these also by considering discount factor. Okay, the discount factor you consider, all right, the cost of capital or discount factor you need to consider. There's nothing but the present value factor. Let's say this is at 10%, let's consider the discount factor as assumption. So first year ka is 0.9090, second year ka is 0.8264. I told 10%, so literally you can mug it up. It always comes in many problems. So first year ka discount factor is 0.9090, second year ka is 0.8264. Now multiply, sir. If you multiply, you're going to get the discounted cash flow. So 80,000 into 0.9090 will give you 72,720. 70,000 into 0.8264 will give you 57,848. If you add both of them, you're going to get 72,720, which is 1,30,568. Okay, all right, 130,568. So this is the, by multiplying discount factor, the value that we get is what we refer to as present value. Now these two you can compare because outflow is happening now, that is the present value. This 130,568 is also present value. These two you can compare and take the decision. Are we fine? Alright. So how do you get the NPVs? That is nothing but present value of cash inflow minus present value of cash outflow. Present value of cash inflow, just now we got it to be 130,568 minus present value of cash outflow is 1 lakh. So if you do that, you are getting 30,568 as a net benefit. Okay, 1 lakh you invested now, and total benefits, the present value of benefits you are getting is 130,568. So 30,568 ka benefits you are getting extra. So hence it is worth doing the project. Meaning if NPV is positive, meaning greater than 0, you can go ahead and accept the investment proposal or accept the project. Otherwise, reject. That is the decision rule. Are we fine? All right. All these values are future value. So by multiplying the discount factor, the value weight we get, we refer to as present value. That's all is the funda of NPV. Okay. This discount factor, the previous method ignored. This only we call it as time value effect. That the previous method ignored, these method consider that. That's all. Okay. Alright. Next is PI. PI as in profitability index or present value index also they say. This is not a new, this is just an extension of NPV. Just an extension of NPV. So profitability index is given by the formula present value of cash inflow divided by present value of cash outflow. Present value of cash inflow divided by present value of cash outflow. Same thing over here. Present value of cash inflow is, if you have to find out profitability index for this problem, present value of cash inflow is 130,568 divided by present value of cash outflow is 1 lakh. All right. So 130,568 divided by 1 lakh will give you 1.30568. That is your profit or profitability index. Is that okay? Or also known as desirability factor. Different names means the same thing. Are we good? Alright. So decision rule is if profitability index or present value index, if it is greater than 1, you can accept the project. If it is lesser than 1, reject the project. That's all. Alright. So why don't we multiply present value to outflow, or why don't we multiply discount factor to outflow? Sir, outflow we don't need any discount factor because outflow is happening now only. Yes, I mean it is already there on which platform? Present value ka platform. Only these numbers you are recovering in future. So all these are future value. Hence to get them to present value, we multiply it by discount factor. Or no, if you want to multiply the discount factor to outflow also, we can also do that. Present discount factor for year 0, it's always 1. For year 0, discount factor is always 1. So that means the present value of cash outflow also will be 1 lakh. That way also you can present. Alright, so that's about NPV and profitability index. Quite straightforward. I'm sure all of you have done this in your BCom also. Something which you're learning. Same thing over here as well. Alright. Okay, no problem. Next is IRR as an internal rate of return. Sometimes it is also referred to as implicit rate of return. Internal rate of return or also known as implicit rate of return. What this means is, what is IRR is? It is a rate at which the present value of cash inflow will be equal to present value of cash outflow. The discount factor or the rate at which or the percentage at which the present value of cash inflow will be equal to present value of cash outflow. That rate we refer to as internal rate of return. Okay, that rate could be 10%, 15%, 17%, whatever. That is what we are trying to find out. Here we took discount factor at 10%, no? So that's what we need to find out. At what percentage both present value of inflow and outflow will be same. So how do we work out that? Here, no, this is done by approximation method. What we have to do is you have to assume any two discount factors. Assume any two percentages. Not only we call it as discount factor. Any two is okay. Then work out the NPV. First you assume any two discount factor and find out the NPV. Alright. Then you can find out IRR. IRR is given with the formula lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. If you do that, or if you apply this particular formula, you're going to get the IRR. So what is lower rate? Let's say you are assuming 10% and 15%. I told you can assume any two percentage, no? Alright, let's say you assumed it as 10 and 15. So 10 is your lower rate, 15 is your higher rate. At this lower rate, you need to find out NPV. At the higher rate also, you need to find out NPV. And then use this particular formula to find out the NPV. Okay? Or to find out rather IRR. That's how it works. Alright. Anyway, we have done enough, almost like 7-8 problems on IRR in our regular batch. But since this is a revisionary, so I'm quickly running through. Hope you can understand. We are trying to cover it a little faster because anyway, we are doing this is helpful for those guys on the last day. That's the reason. Okay, so this is about IRR. Next is MIRR. Right? Modified internal rate of return. Modified internal rate of return. What does this mean is? Alright. See, the problem here is one of the factors that got ignored here is now check. Or maybe let me redraft it over here. Year. Let's say year 1 to cash inflow I'm writing. Let's say, what is that number? You can take same thing or anything, it's okay. So let's say 80,000, 70,000. Okay. Normally, you take these cash inflows multiplied by discount factor and then find out NPV or IRR or whatever it is. Yes or no? But there is one loophole in these methods. What is that? Is it? Now just check at the end of first year. Sir, here 1 means at the end of first year. 2 means at the end of second year. So at the end of first year, from this particular project, the company is getting an inflow of 80,000. And at the end of second year, from this project, company is getting an inflow of 70,000. Now, or maybe we'll have one more year also, let's say 50,000, just for simplicity. 80, 70, 50, let's assume it as the inflows. Okay. Now, or let's say the cash outflow. Present value of cash outflow is let's say 1,50,000. 1.5 lakh is the outflow and these are your cash inflows. I've just modified that. Okay. Alright. Now what is the problem is, see 80,000 you received at the end of first year. Will the company keep that money idle? Now whatever money they received at the end of first year, will anybody keep it idle? No. Now suppose if we earn money by giving coaching, right? Will we keep that money idle? No. We will use that money again into the project. Yes or no? Meaning this 80,000 will not be kept idle. It will be reinvested into the project. Yes or no? Alright. Yes, that reinvestment element, okay, or that reinvestment factor, the other previous methods ignore. That is what is being brought into MIRR concept. Meaning this 80,000 you got it at the end of 80,000. No? That you can reinvest in the project for how many years? Project will end by the end of, or this will get over by the end of third year. No, that means this 80,000 you can invest it for 2 more years. All right. Let's say you are getting a return of 10% assumption. That means on this 80,000 you will get 10% return for 2 years, because 80,000 you got it at the end of year 1 and you can invest this 80,000 for 2 more years. Why 2 more years? Because project will end on year 3 and you got this 80,000 at the end of year 1. So for 2 more years, you can reinvest and earn some return out of that. So if you calculate this 80,000 plus 10% plus 10%, it will become 96,800. This we call it as TCF, as in terminal cash flow, meaning at the end of the life of the project. What is the life of the project ending date? 3 years. At the end of third year, this value will not be 80,000. You can reinvest and earn how much totally? 96,800. Similarly, this one you tell me, this 70,000 you got it at the end of second year. That means will the company keep it idle? No, they will reinvest. For how many years? You got it at the end of second year, this 70,000, and the project gets over by the end of third year. I mean, for how many years can you reinvest this 70,000? Only for one more year, right? And you can earn how much? 10%. This 10% rate, I've assumed it will be provided to you in the problem just in case they ask. That means what will be this? This will be 77,000. Are we good? This 50,000 you got it at the end of third year. Can you reinvest this? No. That means this will remain what? 50,000 only. So find out this terminal cash flow. 96,800 plus 77,000 plus 50,000 if you do, you will going to get 2,23,800. Now what MIRR is trying to target is at what rate, at what percentage 2,23,800 meaning the terminal cash flow will be equal to cash outflow. At what discount factor or at what percentage or at what rate terminal cash flow, that is this total 223,800 will be equal to cash outflow. How much is cash outflow in my example? 1,50,000. So at what rate these two will be equal is what we have to find. Okay, like this is how modified internal rate of return works. Again, you have to assume two rates and calculate this. Okay, so that's what is the funda of MIRR. If you want, you can write this like this, or you can also consider it as a formula. For the reinvestment, there is a formula 1 plus I whole power n. Like I here stands for 10%. So if you want to get the same 96,800, no, there is another way. So 1 plus I you do. I here is 10%. 10% is 0.1. This 80,000, how many years can you invest it for? 2 years, right? So n here is 2. So 1.1 into 1.1 if you do, the factor is 1.21. So 80,000 multiplied by 1.21 you do. 80,000 into 80,000 into 1.21 if you do, you'll get the same answer, that is 96,800. Okay. Either our study material uses this reinvestment wala factor wala formula, or if you don't want to remember that formula, you can straight away add 10% 2 times in a calculator, you'll get the same answer. Okay. That is what I've written here. Terminal cash flow is given by cash inflow into 1 plus I whole power n. This 1 plus I whole power n is nothing but your reinvestment factor, or you can also call it as future value factor. Future value factor. Okay, that if you multiply, you're going to get the terminal cash flows. That, right? Okay, this is about your MIRR wala funda. Next component is capital budgeting under capital rationing. Capital budgeting under capital rationing. What this means is, okay, let's say you have two projects, project A and project B. Project A gives you NPV of 1 lakh. Let's say NPV is present value of cash inflow minus present value of cash outflow. We have done that calculation and I'm assuming that you have got, or maybe let's take it as, okay, let it be 1 lakh for project A and 80,000 for project B. 1 lakh and 80,000. Okay. But project A requires initial investment. I'm calling it as outflow because initially when you have to invest, the cash will go out of the organization. So initial investment constitutes your outflow element. Let's say project A requires an outflow of 1,80,000. Project A requires an outflow of 1,80,000. Project B requires an outflow of only, let's say, 1 lakh rupees. Okay. One project requires an investment of only 1 lakh. Another project requires an investment of 1,80,000. Now, normally, what is the decision rule I told? If you are doing single project, if the project is having NPV of greater than 0, if you're doing only one project and if you have to decide whether should we do that project or reject, the simple decision making rule is if NPV is greater than 0, accept the project, otherwise reject. If you have multiple projects, then to choose among them, what is the decision rule based on NPV is whichever project has higher NPV, that you will choose. Now NPV of project A is 1 lakh, B is 80,000. So if you do straight away comparison, you will obviously choose which project? Project A. Why? Because it is having a higher NPV compared to B. Yes or no? But another big problem or main problem here is this project A requires an investment of 180, but the other one requires an investment of only 1 lakh. Is the outflow or initial investment same or is it different? Different, right? That only we call it as capital budgeting under capital rationing. Meaning if the project has different outflow if it is not same, what to do? What we simply have to do is we have to find out the NPV for 1 rupee invested, for 1 rupee outflow or 1 rupee invested. Now to tell you, see, NPV outflow. Okay, project A I'm doing. Project A requires an outflow of 1,80,000 and it has an NPV of 1 lakh. For 1,80,000 outflow, NPV is 1 lakh. If 1 rupee is the outflow, how much is NPV? Like that we are trying to find out. Okay, for 1,80,000 outflow, NPV is 1 lakh. Okay, if 1 rupee is the outflow, we are bringing everything to one platform now, rupee 1. If 1 rupee is the outflow, means how much is NPV? When you work it out, how are you going to x, how are you going to get here? X is nothing but 1 lakh divided by 1,80,000. Yes or no? Yes, that's how you're going to get. So 1 lakh divided by 1,80,000, if you do, you're going to get the x to be 0.55, or simply you can write it as formula. What is that formula? What is this 1 lakh? That is nothing but NPV. Okay, what is this 1,80,000 outflow or initial investment? So NPV divided by initial investment, if you do, you're going to get NPV for 1 rupee. So for project A, it is 0.55. Similarly, if you do it for project B, NPV is 80,000 divided by initial investment 1 lakh. So 80,000 divided by 1 lakh, if you do, you are getting it to be 0.8. Yes or no? Now what you have to do is you can rank the project. You have to rank this particular project based on their NPV for 1 invested. Now you tell me, for 1 rupee outflow, which is generating higher NPV? Project B. So this will be awarded rank 1. This will be awarded rank 2. Normally in these sort of questions, they don't give only 2 projects. They will give you multiple projects. Like if you want, they'll give you project C also. Okay, NPV is 50,000, but initial investment is, let's say, 75,000. Assumption. That means what will be the NPV for 1 invested? NPV is 50,000 for an initial investment of 75,000, means 50 divided by 75 will give you 0.66. They'll give you 4 or 5 projects. Just for simplicity, I've taken 3. Now you tell me, for 1 rupee invested, okay, which is giving you the highest NPV among all these, which is the highest number? Project B. So first rank will be given to that. Next best is 0.66. So second rank will be given to project C. Third rank will be given to project A. So that means if there is a choice, no, the company should select project B first, okay, then go for C, and lastly they should do project A. Or if they can do only 1 project, means the company will select B and move on. This is nothing but working out the NPV under capital rationing approach. So simple trick is what? They will give you total NPV, they will give you total investment or initial investment. What you have to find out is, for 1 rupee cash outflow or 1 rupee initial investment, how much is NPV? First find out that. If you want to remember it as a formula, it will be what? NPV divided by initial investment. Do that. Or cash outflow, you can call it. It's fine. Then check. Which, here there are 3 projects. Now, whichever project is giving you higher NPV for 1 rupee outflow, that will be awarded the first rank. Based on this, you award the ranks and accordingly select the particular project. That's all is capital budgeting under capital rationing. Okay. Next is projects with unequal life. Projects with unequal life. Possible that sometimes, or maybe I'll give you some small data. Let's say there is project X, project Y, project Z. Okay. Let's say NPV of the project is 1 lakh rupees. This is 80,000. This is, let's say, 1,20,000. Okay. So normally based on NPV, if you have to select, means which project will you select? That the project which has higher NPV, you will select that. So among all this, which has the highest NPV? Project X. So obviously you will select project X. Yes or no? Right? What? Okay. Let me give you another data. This project X ka life is, let's say, 10 years. Okay. Project Y ka life is 5 years. This one is, let's say 7 years. Okay. Basically, the projects have a different life. One project will go on for 10 years, another one for 5, another for 7. In these cases, how will you decide which project to be selected? Okay, so just by looking at NPV, you cannot do the selection, because that would be wrong, because the projects don't have same life. They have different useful life. In that case, what you have to do? In that case, what you have to do is you have to find out something known as EAC, Equivalent Annualized Criterion. Equivalent Annualized Criterion. Find out this Based on this EAC, you can do the selection. So how do we find out EAC? I've already written over here. EAC is nothing but NPV divided by present value annuity factor. NPV is already given. You also need something known as present value annuity factor, PVAF. What is that? Let's say the discount factor is 10%. Discount factor is 10%. Okay. Simple. What does present value annuity factor means? Now you find out discount factor, right? What is the discount factor for year 1? How do you find out discount factor first of all? You do 1 divided by 1 plus I whole power n. Yes or no? I here stands for interest rate or discount factor, that is 10%. So 1 divided by 1 plus I, that is 0.1 whole power 1. First year ka if you want to find out. So it will be 1 divided by 1.1 you do. Okay, that you're going to get 0.9090. Again, you go on pressing equals to button in a calculator and you will get the discount factor. For second year, it will be 0.8264. Okay, let me do a thing. I'll just modify this. Instead of 10, I'll take a smaller number. It will be a lot easier. Let's maybe take this as a 3, 5 and 4. Okay. Now, if you find out for discount factor for year 3, how will you find out? Just do 1 divided by 1.1, press equals to button 3 times to find out the discount factor for third year. I'm sure all of you are comfortable with this. 1, 2, 3. So it will be 0.7513. Year 4 it will be 0.6804, I think. Yeah, 0.6830 rather. And then how many years I took? 5. Okay, that means year 5 it will be 0.6209. Okay, these are individual year ka discount factor. We call it as present value interest factor. Each year ka discount factor we call it as present value interest factor. If you add up all the discount factors, right, all the years ka discount factor, if you add that added number, we call it as present value annuity factor. Okay, like if you want to find out the present value annuity factor for 5 years at 10%, you have to add everything like that. Similarly here, that's what we need to first find out, present value annuity factor at 10%. What is the life year? 3 years. For 3 years, you have to find out present value annuity factor. How do you find out that? 1 divided by 1.1, 1, 2, 3. Press equals to button 3 times and press GT button in your calculator. Automatically, you're going to get 2.4868. Similarly there, 1 divided by 1.1 you do. 1, 2, 3, 4, 5. And press GT button, you're going to get it as 3.79. I'll take maybe 2 decimals only for simplicity. Okay, present value annuity factor at 10% for 4 years. 1 divided by 1.1, 1, 2, 3, 4. 4 times you press equals to button and then press GT button. You're going to get this to be 3.16. Using this, you can find out something known as EAC. EAC is nothing but NPV divided by present value annuity factor. This I'm going to call it as 1, 2, 3. So EAC 4. 4 is equal to NPV divided by present value annuity factor. So 1 divided by 3. 1 lakh divided by 2.48 you do. That is going to give you 43,322. Here it will be 80,000 divided by 3.79. That will be 21,108. 1,20,000 divided by 3.16. This will be 37,974. Now, how do you select the project is whichever project has higher EAC. EAC is nothing but on an average, how much is the NPV you're getting every year? EAC is nothing but equalized annual criterion. So on an average, see 1 lakh is the NPV for 3 years, yes or no? On an average for 1 year, on an average what is your NPV is what we are trying to find out through EAC. On an average NPV of the projects for 3 projects is this much. So selection will be based on EAC. Whichever project has higher EAC, that will be selected. Which among this has higher EAC? Project X. So select that like that. Okay. So that's how selection will be done based on EAC model. Okay, that's what I've written over here. All right. But one thing you need to keep in mind is sometimes they also give you not just NPV, they'll only give you cost ka data. They'll say we want to do 3 projects. To do the project, we need to buy machinery. Machinery has initial investment this much, it has maintenance cost this much, it has a running cost that much, meaning they will not give you benefit data. They will only give you cost ka data. NPV means present value of cash inflow minus present value of cash outflow. NPV is the net benefit, yes or no? So if you are working from NPV point of view, you will select that project which has higher EAC. But suppose same EAC, if you are working from cost side, if benefit data is not available to us in the problem, if they give you only cost data, then if you're working EAC from cost angle, you will select that project with lower EAC. From benefit angle or from NPV angle, you will select that project which is higher EAC. From cost angle, you will select that project which has lower EAC. That's how the selection will be based on. Okay. All right. Now the decision making rule for project, I've simply given it over here. One is payback period. PP is as in the payback period. Based on payback period, how do you select this? One for individual project I've given, another for multiple project. If you have individual project, that will be based on, a selection will be based on lower than expected period. Let's say I want to do a project. I feel I want to recover my initial investment within 5 years. I want to do that project wherein I will recover my initial investment within 5 years. My payback period of this project is only 4 years. Can I accept? Yes, because I am expecting to recover investment by 5 years, but payback period of that project is only 4 years. That means I am recovering the money a lot sooner than I am expecting. So that will be your decision making rule. If the payback period is lower than expected period, you can go ahead. Suppose you have multiple projects, it's not individual projects, you have 2 projects or 2 or more projects, then how will you do the selection based on payback period is? Whichever project has a lower payback period, because you are talking about recover of investment, right? You want to recover the investment. The sooner you recover the investment, the better it is. Yes. So whichever project has lower payback period, you will select that. Then based on ARR. ARR is a return, right? All right. If you're doing selection for individual project, if the return is higher than expected return, by doing a particular project, I am expecting a return of 12%, but actual return from that project is 15%. I'm expecting 12, but I feel I'm going to get 15. That means you can go ahead and bindas accept that project because you're getting higher return than expected. That's for the decision rule for individual projects. If you have multiple projects, whichever project is giving you higher ARR, you can select that. All right. NPV. NPV, as I told you, for individual project, if NPV is greater than 0, accept the project. Otherwise, reject. For multiple projects, select that project which has higher NPV. Okay. Then profitability index. Decision rule is if profitability index is greater than 1, accept it. Otherwise, reject. For multiple projects, select that project which has higher profitability or present value index. IRR. For individual project, if IRR is greater than KO already we have covered, overall cost of capital. If IRR is greater than overall cost of capital, IRR is a return. Let's say the return is 15%, but my cost of capital is only 12%. That means it makes sense to do this project, no? Because to do this project, I have to take a finance, and on that finance, I'm incurring a cost of only 12%, but my return from this project is 15%, means we can go ahead and accept that project, otherwise reject it. If you have multiple projects, whichever project has higher IRR, you can select that. Those are your decision making rules for this particular component. Okay. All right. Yes. So let's maybe quickly run by one of the examination questions as well, just to know how they get asked out. I think this question, it came it came for 10 marks. I think it came in July 2021 paper, I think. I'm not very sure about which attempt it came, but there's an examination question only. All right. Let's go through this. A company wants to buy a machinery and two different models, namely A and B are available. So 2 particular models are available. Great. That means we have to choose one among the 2. That's your investment decision that you have to do or take in this particular problem. So that's what they've given some data about this. Original cost of machine A is 8 lakh, estimated useful life is 4 and salvage value is 0. That means what will be depreciation for machine A? 8 lakh minus 0 divided by 4. So the depreciation will be, for machinery A, it will be 2 lakh per annum. For machinery B, 6 lakh minus 0 divided by 4, it will be 1,50,000 per annum. That's your depreciation for both the machineries respectively. The company provides depreciation under straight line method. Income tax rate is 30%. Great. The present value of rupee 1 at 12% discount factor and net profit before depreciation and tax. Net profit before depreciation and before deducting tax they have given. Alright, for both the machineries they have given you the net profit. Obviously, if you choose a machinery means you will utilize that machinery and you will be able to earn some returns, right? The returns they have given in the form of, not in the form of cash flow, they have given in the form of net profit here. No worries. And they have also given discount factor. Present value factor. PV factor is a present value factor, or you can also call it as discount factor. They have already told 12%. So they have only calculated. Basically 1 divided by 1.12 if you do, you're going to get the discount factor. For all the years discount factor, they have worked it out for you there. you need to calculate NPV, discounted payback period, and profitability index. Okay, suggest which is more beneficial under discounted payback period and all this. They're asking you the suggestion. That's all. This question came for about 10 mark. Right? Depreciation we've already calculated. For A it is 2 lakh and B it is 1,50,000. Now what you have to do is to calculate NPV. We require cash flow, but they have given net profit, and that too they have given net profit before depreciation and before deducting tax. First, let's note that down. First, we'll work it out for machinery A. What is the net profit given? This data 2.3, 2.4, 2.2 and 5.6. That's what we will copy first. This is only for machinery A. These are net profit before deducting depreciation and before deducting tax. See, company will pay tax only after deducting all the expenses. Yes or no? They will deduct all the expense and then only you will get the correct profit, and on that correct profit companies will pay tax. But since they're saying this is net profit before depreciation, meaning depreciation is not deducted, so deduct depreciation. What is the depreciation for machinery A? We already got 2 lakh. For all the years it is 2 lakh because it's a straight line method. Once you deduct, you're going to get profit before tax, these numbers you're getting. On this you pay tax at the rate of 30%. So 30,000 ka 30% is 9,000, 40,000 ka 30% is 12, like that they have calculated. From profit before tax, if you deduct tax, you're going to get profit after tax, PAT. That's what they have given all the numbers here. Last step you need to do is add back a depreciation. Add back depreciation. So why should we deduct first and then add back later on? Sir, we want not net profit for our decision making. For our decision making, the key component that we need is cash flow. Cash flow is what we need. We don't need net profit. If they give you net profit, from net profit you have to derive cash flows. Okay, how to do it is this. Okay, first deduct depreciation. Last step mein add back depreciation. Sorry, instead of doing that we can skip only. No sir, no, you can't skip. This is very important step. First of all, why is depreciation added back is, alright, first of all, why do we deduct depreciation? Because you pay tax after deducting all the expenses. Doesn't matter what sort of expense is it, everything you need to deduct, yes or no? So hence the depreciation needs to be deducted, because only then you're going to get the correct profit, and on that correct profit you will have to pay tax to the government. So later why you should add back? Sorry, depreciation is not a cash expense, it is a non-cash expense, meaning due to depreciation. Let's say there is a salary of 10,000 rupees. If there is a salary of 10,000 rupees means the company has to pay the salary to the employees. Okay, they may give the salary this month only, or they may give it 1 week later or 1 month later, but still they need to pay. This has to be settled in cash. You cannot escape. Yes or no? What about this depreciation? If the depreciation is 2 lakh rupees, will company say, here dude, take 2 lakh rupees depreciation? Will anybody give you? No. So that means what? Depreciation is not a cash expense. It is a non-cash expense. Meaning due to depreciation, your cash will not go out. That's the reason. Since you have already deducted depreciation over here, last step may add back depreciation. We do this step because on depreciation, you get something known as tax benefit, or it is also referred to as tax shield. Okay, because depreciation is an expense, no? Due to the expense, profit will reduce, and because of this, your tax also will reduce. So due to this depreciation, you will get some tax benefit. Hence, we have to route it like this. Okay. Alright. Since it is a non-cash expense, last step may you add. If you add, you're going to get the annual cash inflows. So by doing this project, how much is the cash annually? You're going to get the inflows. This number you have to take and work out your NPV. Same step they have done it for machinery B also. But machinery B this data is given in the problem only, net profit. Depreciation for machinery B is 1,50,000. We already worked it out. First deduct it, and then you will get profit before tax. Then pay the tax. Last step may add back depreciation. Why? Because depreciation is a non-cash expense. And then you're going to get the net cash inflow for project B. You have to take these numbers to calculate your NPV. How are you going to get NPV? Discount factor they have given here only. These are 4 years because life of both the project is 4 years only. Discount factor or present value factor they have only given. Net cash flow just now we got. This for machinery A. Here only we have got, right? This number they have substituted here. This 2,20,000 is it the present value or future value? It's a future value. How? Because this 2,20,000 company is not going to receive now. The company will receive at the end of first year. And this 2,20,000 again is future value because company will receive at the end of second year. So all these are future value. From future value, if you have to get present value, we multiply it by the discount factor. So multiplying these two, you're going to get the present value. That's all. All right. So if you add up all this, they're saying if you add up all this, you're going to get 8,18,909. That's what they've taken here. This is the present value of cash inflow. How are you going to get NPV? Present value of cash inflow minus present value of cash outflow. Cash outflow they've given in the question only. To buy this machinery, we have to invest how much now? 8 lakh rupees. So from this, if you deduct present value of cash outflow, you're going to get the NPV this much. Same thing, they've done it for machinery B also. They've done cumulative one more. I'll tell you that in a bit. So that's what machinery A and B ka NPV is pretty straightforward. Yes. Okay, this is your present value of cash inflow, this is your present value of cash outflow. How are you going to get profitability index? Present value of cash inflow divided by present value of cash outflow. That's what they have done and got the profitability index or present value index for both the machineries. That is pretty straightforward. No issues there, same numbers. One is a reduction, another one is just a division aspect. Yes, so because profitability index is just an extension of NPV, nothing new. The funda here is another one they've asked, that is they've asked one more, that is discounted payback period. They've not asked payback period, they've asked discounted payback period. See, one of the drawbacks of payback period is it ignores time value of money concept. Okay, it does not consider time value of money concept. That limitation or that drawback is sorted in case of discounted payback period. That time value of money ignoring fault is sorted in discounted payback period, meaning indirectly I tell you, discounted payback period considers time value of money. It considers a time value effect, discounted payback period. That means how will we work out that, sir? Okay. Now normally for payback period, what you used to do? You used to take cash flows. If cash flows was not same, then you used to find out cumulative cash flows. Yes or no? But all these cash flows, is it the present value or are they future value? They are future values. Yes or no? First multiply cash flows with the discount factor and get the present value of cash flows. Okay. First find out the present value of cash flows. And instead of doing cumulative cash flows, consider cumulative present value of cash flows. Don't do cumulative of this number, not the cash flows. Do the cumulative of present value of cash flows. How do you do that? First year ka number will be same. Second year ka cumulative cash flow will be these two ka addition. If you do 197, 353 plus 187 or rather 181, 716, 197,353 plus 181,716. My calculator is showing 379,069. That's how they've got this number. Then again, third year ka will be all these three ka addition, which is 531. Fourth year ka will be all these four ka addition, which will be 8,18,909. That's the difference between payback period and discounted payback period. In payback period, we take the cash flows and we cumulate them. But here we don't, for discounted payback period, we don't add up or we don't cumulate cash flows. We add up what? Present value of cash flows. That's all. Okay. But how do you still find out, sir? Okay. Check how do you find out. Payback period first of all means what? In how many years will you recover the investment? Okay. So what is the investment for machinery A? 8 lakh. Check. When you did cumulative cash flow, did you get any number equal to 8 lakh? Because wherever that number equals to cumulative cash flow is equal to 8 lakh, that is our payback period or discounted payback period. Yes, no? But is any number adding up to 8 lakh? No. That means how to find out? Simple one. Check. Up to third year, your cumulative cash flow is 531,437. When you come to fourth year, cumulative present value of cash flow has become 8,18,909. Yes or no? So you went from third year to fourth year. That means how much year? 1 year you increased. How can I write like this? Change in years. Change in year. 1 year you increased. From third year you went to fourth year. Meaning 1 year increased. Your cumulative cash flow from 531 became 8,80,000. So how much it increased? From 531 it became 8,80,000 means the increase is 818,909 minus 531,437. So the increase is, I'll write increase in cash flow or increase in present value of cash flows. I will write increase is 287,472. Okay, this is the one. How many years I need to increase my cash flow? I'll just write it as 1 year. Instead of 1 year, I'll just write it as 1. How many years should I increase so that from 531 this number becomes 8 lakh? Why 8 lakh? My initial investment is 8 lakh. in how many years, or how many years should I increase it by so that from 531 it becomes 8 lakh. So what is the difference? Check. 8 lakh minus 531, 437 you do. 8 lakh minus 531, 437 will give you 268. My calculator is showing 268, 563. This you need to prorate and work it out. Okay. So discounted payback period is given by, alright, discounted payback period is somewhere between 3 years and 4 years. Somewhere in between that. How do you find out that? First find X. How do you get X over here? X is nothing but 2,68,563 into 1 divided by 287,472. If you do that, my calculator 287, 472. If I do, my calculator is showing 0.93. So what is X? X is change in the year or increase in years. From 3 years, I need to increase it by 0.9342. Why 0.9342? This number is 0.9342. That means your discounted payback period is 3.93 years. That's how they've got it. 3.934 years. Easy? So this is how you work out the discounted payback period. Alright, when it is lying in between, this is how you just check. Okay? Alright, just to make sure that you have got it, let's work it out for machinery B as well. Alright, NPV I will not go for, we will only work out discounted payback period. First of all, check for machinery B, what is the initial investment? 6 lakh. Okay, you're not calculating payback period, you're calculating discounted payback period. That means what do you need to do? Cumulative cash flows you need to do? No, you need to do cumulative present value of cash flows. That is what they have done here. Okay. Now, what is outflow, sir? For machinery B, outflow is 6 lakh. Yes, here 6 lakh. Check. Is cumulative cash flow anywhere is becoming 6 lakh? Is it exactly 6 lakh? No. Can I say again discounted payback period is between 3 to 4 years? Because up till 3 years, my cumulative cash flow is 522,025. From third year, if I go to fourth year, for my fourth year, it has become 617,425. It is not exactly 6 lakh, but it is somewhere between that. Can I say so? Again, the same funda. From third year, I went to fourth year. That means how many years have I increased? 1 year have I increased. What happened to my cash flow? Cumulative present value cash flow. From 522,025, it became 617,425. So what is the difference? 617,425 minus 522,025. So the increase is 95,400. By how many years I need to increase? X I don't know. So that from 522,025 it becomes 6 lakh. Why 6 lakh? Because my initial investment is 6 lakh. By how many years I need to increase? So that from 522,025 it becomes 6 lakh. So what is the difference? 6 lakh minus 522,025. If you do, the difference is 77,975. So when you work out X, so that will be what? 77,975 divided by 95,400. X is 0.81. X is not a full number. X is how many years you need to increase by. From 3 years, you need to increase by 0.81 years. So your discounted payback period will be 3 plus 0.81, which will be 3.81 years. That is what they have computed here as well, 3.817. Okay. All right. So this is how discounted payback period calculation also works. All right, sir. So we have gone through this particular topic. Now let's move on to the next topic, that is risk analysis in capital budgeting. Risk analysis in capital budgeting. Now what are we doing here is, see, capital budgeting is a technique for investment decision. All that payback period, discounted payback period, NPV, all this we learned, no? Those are nothing but capital budgeting techniques. Okay, those are techniques we use and we analyze, or we decide whether we should do that investment or not. Yes. Now in capital budgeting, we are also bringing one more element known as risk analysis. What is this risk? Why is it necessary? Normally, if you remember, just now we did, to calculate NPV, IRR, blah, 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 you know, what do you do, sir? You take cash flow, you multiply it by discount factor, and you're going to get present value of cash flow or discounted cash flow. Yes or no? This is how you do. And here also you'll have year column. Let's say 1, 2, 3. Cash flows, let's say 80,000 or 1 lakh, 80,000, 70,000, etc., etc. is your cash inflow. You multiply it by discount factor and get it. But the problem here is, okay, is this cash flow guaranteed cash flow, or is this just an estimated cash flow? when you're doing the decision makings, right, or your NPV analysis and all, what are you trying to do? These are not achieved cash flows or short number. These are only estimated or projected cash flows. Yes. Okay. So what is the guarantee that you will achieve your estimate? Your estimates could be beaten, meaning you may be expecting 1 lakh. Maybe you achieved 1,50,000. You may achieve more than your estimate, or you may achieve less than your estimate. That means there is a risk. Yes or no? There is a risk element associated with this cash flow. Yes or no? That is what we are trying to do in this particular topic. So don't just do your investment decision just based on your cash flows and discount factor and all, because all these components have an element of risk, because these projections could be accurate. Okay, it may be, but actual number could be same. Whatever you estimated, that only you may achieve, or you may achieve a lower number or a higher number. So there's always some risk attached to these numbers. That is what we are about to consider here. Okay, so that's what this topic is all about. Okay, consider the risk element in these and then do your calculation. We are okay with that NPV, IRR and all. Okay, but the only thing is also consider the risk element and then work out that NPV, IRR, ARR or whatever is what the scope of this particular topic. Okay, okay. Here also we have various techniques to assess the risk. How can we find out the risk element? We have various techniques. Some are statistical technique, which you have done it in your 11th standard or CA foundation days. First technique is probability approach. Okay, probability approach is very straightforward. What it says is, normally you take cash flow multiplied by discount factor. What this method says is, okay, alright, let's say this is the cash flow. Maybe I just erase it off. What you have to do is find out the probability factor of these. Okay, or maybe I'll give you another example slightly here, man. Okay, alright, what this method says is, okay, you are estimating cash flow to be 1,80,000 and all. What is the guarantee that you will achieve that, or what is the probability that you will achieve that? So we have to find out the probability percentage. Let's say that is 0.9 and 0.1. If you add the probability percentage, it is always equal to 1. Okay, alright, so what does it mean? 0.9 means, probability is 0.9 means there is a 90% chance that you will achieve 1 lakh. There is a 90% chance that your cash flow will be 1 lakh, and there is a 0.1 as in 10% chance that your cash flow will just be 80,000. Normally for your NPV, you take this cash flow and do your calculations, right? Okay, what here we have to do is we have to find out the expected cash flows. How do you get that? Let's say this is column number 1, this is column number 2, this is column number 3. 3 is nothing but 1 multiplied by 2. First multiply cash flows with probability factor. So 1 lakh into 0.9 will give you 90,000. 80,000 into 0.1 will give you 8,000. So what will be this? 98,000. Let's say this is for year 1. Okay, all this data is for year 1. So expected cash flow is only 98,000. After considering the probability factor, find out the probable cash flow and use this probable cash flow to calculate your NPV, profitability index, IRR, etc., etc. Don't take these cash flows because they have an element of risk. They are not short number. Probability approach says multiply the cash flows with the probability factor. You will get the probable cash flows, or we also call it as expected net cash flows, ENCF. Okay, take that number. This is for year 1. This 98,000 is for year 1. If you have project like life is 3 years, means for all the 3 years, find out this expected net cash flow and then do your NPV calculation. Don't take this cash flow and work, take this and do your working is what this particular funda says all about. Let's say expected net cash flow. Okay, year 1, 2, 3. I did it for year 1, no? So let's say like that we do it for year 2, 3 also. Year 1 it is 98,000. For year 2 let's say is 80,000. Then let's say it's 1 lakh. Take this number and do your NPV calculation. Meaning this is also present value, I mean future value only, no? Because this 98,000 the company will receive at the end of first year. Now you consider the discount factor and then you find out the discounted cash flow. This becomes your base for your NPV calculation. That's all this method trying to say. Okay, don't take cash flow, take probable cash flows and do your working is the first method. Easy. Okay. All right. There is another method known as variance approach. Okay, what is variance approach? Variance is how far is the number away from average. Okay, I've just expressed it as a formula. Not necessary that you have to remember it as a formula. You can do it directly also. So that is given by cash flows. Okay, or this we can call it as NCF, net cash flow, minus expected cash flow whole square into probability factor. Net cash flow for year 1 minus expected net cash flow whole square into probability factor for year 1 plus NCF2 minus expected net cash flow whole square into P2, like this. If they have given for 4, if here there is 2 data, no? So that means the formula will be restricted at 2 components. If there is this data is given for 4, if you have 4 probabilities, then this formula will go on 4 times. Basically, NCF minus ENCF whole square into probability 1. NCF minus NCF2 minus ENCF whole square into probability 2. Like that it goes on. Okay. So that summation of all that, when you do, the number finally you're going to get something known as variance. Alright. So why is this necessary? This is not necessary. Actually, what is necessary is standard deviation. How do you get standard deviation? Standard deviation is nothing but square root of variance. Let's say variance was 10 lakh. Square root of that you do. Standard deviation is nothing but square root of this number 10 lakh. 10 lakh a square root, if you find out, that will be 1000, right? So standard deviation you're going to get is 1000. So standard deviation stands for total risk of the project. Total risk associated with the project. Okay. So if you have to select the project, select that project which has the lower risk. This is the total risk associated with the project. Okay. Alright, based on this you can analyze. Then there is also something known as coefficient of variance or COV. How do you get coefficient of variance? Is simple. Standard deviation, it's also given over here, divided by expected net cash flow. You remember we did already expected net cash flow. How do you get expected net cash flow? It is nothing but net cash flow multiplied by the probability factor. From net cash flow, if you multiply probability factor and add up everything, you're going to get expected net cash flow. So standard deviation divided by expected net cash flow will give you coefficient of variance. What is this? Simple, sir. Or maybe let's take this example only. I wrote it over here. No? What is the expected net cash flow? 98,000. Okay, here I've got it. Maybe I'll write it over here. 98,000. Okay, this is your expected net cash flow. Right? Okay. What is the standard deviance we got? All these are just assumed numbers just for explanation. This is 1000. Standard deviation stands for total risk. Alright. For total risk of 1000, the total expected net cash flow is 98,000. Okay. For 1 rupee of return, see, to earn 98,000 of return, you are taking a risk of total risk of 1000 rupees. I'll repeat that. To earn 98,000 rupees, totally you are taking a risk of 1000. To earn 1 rupee return, how much risk are you taking? To earn 98,000 rupees, you are taking a total risk of 1000. To earn 1 rupee return, how much risk are you taking? That only we call it as coefficient of variance. Find out x for me here. How do you get x? X is nothing but 1000 divided by 98,000. Yes or no? What is this 1000? Standard deviance. What is this 98,000? That is nothing but expected net cash flow. That is what I have written it as formula. If they give you ENCF in the problem, work it out using that. If they give you NPV, ENPV, work it out. You can also work out using that particular component. Okay. So what will be your selection rule? Okay, let's say there are 2 projects, project A, project B. Okay. Selection rule based on coefficient of variances. Let's say this is 0.80, this is 0.75. 2 projects ka coefficient of variance you have found out. Okay. How will you do the selection? First of all, what does coefficient of variance mean? The risk taken to earn 1 rupee return. Return is same for both the project. Return is only 1 rupee. To earn 1 rupee return, how much risk are you taking? To earn 1 rupee return in project A, you are taking a risk of 0.80. To earn the same 1 rupee return, you are taking a risk of 0.75 in project B. So basically, whichever project has lower or lesser coefficient of variance, that will be selected. In this, B has lesser coefficient of variance, so that will be selected. Basically, that is a risk. No, whichever has a lesser risk, you will select it. Okay. Same rule goes with standard deviance also. If you have to select the project based on standard deviation, do the project or calculate standard deviation for both the project. Whichever project has lower risk, meaning lower standard deviation, select that. Okay. Same decision rule is the same. Lower standard deviation and lower coefficient of variance is the selection rule for the projects. Easy. Okay, that's what I've written it out over here. Alright. Okay, I'm sure all these are pretty easy, and I'm sure, but I'll just quickly run it by you. Okay, risk adjusted discount rate or RADR. All right, coming back to this, see, I took you this example previously. Is there a risk only associated with cash flow? Or where is that number? It went off. Huh? Okay, or here maybe I'll take this. Is the risk only associated with cash flow, sir, or there is a risk in discount factor also? Discount factor is your cost of capital, sir, basically. Will the cost of capital be same throughout? No. It is based on economic conditions, yes or no? If condition is good, maybe the cost of capital may be on the lower side. Or if based condition worsens, then cost of capital may be more. That means what? Discount factor number is also not constant. There is an element of risk associated with discount factor also. Okay, so this approach, this RADR approach or risk adjusted discount rate approach, no, what it says is forget about cash flow adjustment. You consider the risk element or the risk factor for your discount factor calculation. You consider the risk element for your discount factor calculation. So based on the risk, you choose the discount factor. Okay, meaning if the project has less risky, then you can choose a risk-free rate of return. Risk-free rate of return means, let's say you have some money. Okay, you want to take least risk as possible. The least instrument which has least risk in India is the government of India bonds, RBI bonds, state government bonds. Because government agencies also need money, no? Okay, to construct the road, bridges, flyover, metro, etc., etc. Yes, sometimes the tax money is not sufficient. All right, so they may issue some bonds periodically. They do. All right, so whatever interest rate that you get, if you invest in that bond, you'll get some interest rate, right? That we call it as risk-free rate of interest. Okay, so RADR method says if the project has no risk, if it's relatively easy or no risk project, then you can use a risk-free rate as a discount factor and do your NPV, IRR and blah 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 calculation. However, if there is any risk element associated with the project, then your discount factor also has to be increased. As the risk goes up, your discount factor also should be increased. That's what we say risk premium, meaning your discount factor should be increased. Okay, so based on the risk associated with the project, adjust your discount factor. All this they will give it to you in the problem. Don't have to worry. Risk-free rate as well as the discount rate, they will the risk adjusted discount rate, they will give it to you in the problem, and they will also tell you the risk associated with the project. You can work out your NPV and blah 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 using the rate. That's how this particular method works. Basically, choose the discount factor based on the risk associated with the project is the funda of this particular method. Okay, all right. The next one is certainty equivalent method. Certainty equivalent method. The funda of this particular method is you have to select for your decision making. You have to select a guaranteed return, or you have to accept a guaranteed cash flow over higher uncertain cash flows. Let's say there is a guaranteed cash flow of 1 lakh, all right, and there is a uncertain cash flow of 1,50,000. Meaning the company is saying, okay, if this happens, if lockdown is not imposed, then we will achieve 1,50,000. Meaning if everything, if the inflation is under control, if lockdown is not influenced, if there is no recession, if Modi government does not change, or if the political stability is there, means if all the factors are rosy, good, then the company is saying we will achieve, first year we will achieve a cash flow from a project of 1,50,000. Like that. They are saying if things change, okay, or they are saying, okay, no matter what, whether things goes good or things goes bad, minimum I will earn 1 lakh rupees. Two components are given. They are saying no matter what happens, 1 lakh minimum I will earn. This is guaranteed. Whether things are good or things are bad, I will earn 1 lakh rupees. Right? However, if things are good, I will earn 1,50,000. What certainty equivalent approach says is you should prefer guaranteed approach. For your finding out NPV and other things, no, they say take 1 lakh and do your calculation. To calculate your NPV, IRR, blah blah, no, don't take this uncertain higher cash flow, but rather choose guaranteed cash flow and do your working. That's all. That's all is the hypothesis or the takeaway of this particular method. Choose the guaranteed cash flow over higher uncertain cash flows. Okay, so how do we find out guaranteed cash flow? Okay, that also there is a funda given here. What this funda says is, to get guaranteed cash flows, what we simply have to do it is take the cash flow multiplied by a factor. That factor we call it as certainty equivalent coefficient or certainty equivalent factor. Simply multiply certainty equivalent coefficient with that net cash flow to get the guaranteed cash flow, meaning to eliminate risk in the cash flows. Okay, to eliminate risk, if you are eliminating risk means it becomes guaranteed cash flow. Take the cash flow multiplied by the certainty equivalent coefficient. So what is the certainty equivalent coefficient? That they would have provided to you in the problem. Okay, this basically certainty equivalent coefficient is management driven assessment. Okay, there is no magic formula to compute this. So this is management driven exercise. So that's how you compute, and take this. When you do this, you're going to get some cash flows. No, this we can call it as adjusted cash flow. From cash flow, if you multiply certainty equivalent factor, the final number what you're going to get, we can call it as adjusted cash flow. Take this adjusted cash flow and do your NPV, IRR, etc. calculation. That's all is the funda of certainty equivalent method. Okay. Alright, now there is also one more problem. We'll run it by that. I'll show you how it works as well. Maybe there are a quick couple of other methods also. We'll discuss that and then we will dive into the numericals. Next is sensitivity analysis. What does sensitivity analysis talk about? Okay, this method ka funda is, see, to calculate NPV, we require what, sir? To calculate NPV, we require net cash flow. Yes or no? How do you get net cash flow? For that, if you remember, if they have given sales, can you arrive at net cash flow? Yes. From sales, if you deduct the contribution, or from sales, if you deduct variable cost, you're going to get contribution. Yes or no? From contribution, if you reduce fixed cost, you're going to get EBIT. From EBIT, if you deduct interest, you're going to get earnings before tax. From this, if you deduct tax, you're going to get earnings after tax. Correct? Alright. But we don't want earnings for our decision making. Okay. We want what? Cash flow. Hence, last step, what do? We add back depreciation and we're going to get net cash flows. Net cash inflows, you could say. Yes. We take this and do our normal NPV calculations. Yes. These are the way in which we work it out. Alright. What sensitivity analysis says is, to calculate this, using this only you calculate NPV. Alright. To calculate NPV, we require various input variables. To calculate this number NPV, we need the help of various variables. What are those variables? Sales is one variable. In sales also you can go for. How do you get sales? Number of units multiplied by selling price. Number of units sold multiplied by selling price will give you sale value. Yes or no? So this number of units is one input. Selling price per unit is one input. Variable cost is one input. Fixed cost is another input. Tax is one input. Like this, there are many inputs to calculate the NPV. Okay. All right. And this method says, if this input there is any change, if any of this inputs change, meaning if there is any increase in the inputs, change means it could be increase or decrease. If any of these inputs, whatever I've called out here, number of units sold, selling price per unit, variable cost, fixed cost, etc. All right, depreciation, blah blah. If any of this input variable there is a change, meaning increase or decreases, then your NPV also will change. Any input variable changes means your NPV also changes. Meaning if your sales is 1 lakh rupees means, then your NPV could be maybe 10,000. If sales increases by let's say 20% and it becomes 1,20,000, then your final NPV will not be 10,000. It will be something different. Maybe it will be 11,000 or it could be anything. Basically, if any input variable changes, then your NPV number also will change. So what this method is trying to assess is, which among these variables, among all this input variable, which is the most critical or which is the most sensitive? Okay, among all this, which is the most critical? Most critical means which changes your NPV the most. Like, okay, let's say sales increases by 10%. If sale increases by 10% means, I'm just assuming some numbers, I want you to answer this. Let's say sales increase by 10% means NPV is increasing by 25%. Just take a random numbers without, if I do numerical question, it will take half an hour, 45 minutes. So I'm giving you some data. All right. If sales increase by 10% means, let's say NPV is increased by 20%. Because sale is a benefit. No, if benefit increases means your final NPV is also benefit, the net benefit basically. Okay, so NPV increased by 10%, we are saying. Similarly, let's say variable cost has decreased by 10%. Let's say this is a favorable change. Favorable change means benefit will increase and cost will reduce. That is a favorable change. Yes or no? Benefit increases, benefit increasing and cost reducing, we refer it to as favorable change. Alright. They could also give you unfavorable change in the examination. Unfavorable change means benefit reducing, cost increasing. I'm taking favorable change just to prove a point. That's all. Let's say variable cost has reduced by 10%. If this happens means, let's say NPV increases by 20%. Okay. Let's say there is another one, fixed cost. We are talking about favorable change. Favorable change means fixed cost should increase or reduce. Cost should reduce. Let's say fixed cost, if it is reduced by 10%, then NPV has increased by, let's say, 18%. Alright. Now you tell me, just for simplicity, I have taken 3 input variable. Among all these 3 input variable, which is the most critical or which is the most sensitive? The most sensitive element is the sales. Why? Check. For 10% increase in sale, your NPV has increased by 25%. For other variable 10% change, NPV has only increased by 20 and 18. Which is causing the maximum change in NPV? Sales. That means this is the most sensitive element. That is what sensitivity analysis is trying to assess. Among all the input variable, which is the most sensitive one or which is the most critical one? Okay, that's how it tries to assume. But there is one fundamental drawback or about this method. What this method assumes is it assumes that all variables are independent. Meaning all these are independent means if sale increase by 10%, it assumes that only sale will increase by 10%. All other input variables will be same. It assumes that only one input variable will change at a time. That is not the case. Yes or no? Alright? Because all the variables are interconnected. If variable cost if there is increase in 10% means, if cost is increasing means, obviously selling price of the product also will increase, because otherwise business cannot survive. Yes or no? Like if the cost per unit was 100 rupees means, business used to sell this product at 110 rupees, let's assume. Okay, they used to buy, the total cost of this particular product is 100 rupees, which the business used to spend, one company. So they used to sell it at 110. Suppose the cost only has become 120. Do you think selling price will be 110 only? Yeah? No, maybe they may sell it at 140 now. Yes, because the cost is increased means selling price also will be, there will be an effect. That means, are these variables independent? No, they are interconnected. Yes or no? One ka change will affect the other also. Right? That is the fundamental drawback of this method. This method assumes that at a time, at one point of time, only one variable will change. Meaning if cost increases means only cost will increase. Selling price will be same. Like that it assumes, which is pretty outdated assumption or fundamentally irrelevant assumption. But examination it could be relevant. Okay. So that's about sensitivity analysis. Next is scenario analysis. Scenario analysis is much more relevant, you could say. What it says is, okay, we understood that sensitivity analysis has a limitation. The limitation is it assumes that all the input variables are constant, which is not so. Hence, they brought in scenario analysis. Scenario analysis, what they're trying to say is, if a particular scenario changes, scenario could be like recession period is one scenario. Okay, or boom period you can call it, is another scenario. Yes, recession means bad times. Boom period means super duper time, correct? Alright, then what will happen? Or if this scenario changes, how will your NPV changes? Meaning, if you're having how this method tries to calculate is, or I'll give you a simple example. Year 1, year 2, year 3. Best case, worst case. Okay, they've given you 2 cases. Best case, worst case. Let's say cash flows. If it is best case means cash flow for year 1 will be 1 maybe, okay, I'll take it as 10 lakh. This is 8 lakh. This is 5 lakh. Okay, under best case scenario, this is my cash inflows. Cash inflows. If it is worst case scenario, my inflow for first year will only be 9 lakh. This will be, let's say, 7 lakh and this will be 3 lakh. Okay. For what you have to do is in scenario analysis, for each scenario, meaning for best case, you have to calculate NPV. For each scenario or for each case, You have to work out the NPV. For worst case, what is your NPV? How do you calculate best case ka NPV? These are all your inflows, right? Okay, and take these inflows, multiply it by the discount factor, and then consider present value of cash outflow and work out the NPV. Yes or no? Simple. Cash flow, discount factor, present value of cash flows. If I have to really calculate this for your best case scenario, if I take best case scenario, what will be the cash flow for 1, 2, 3? You can also start with year 0, okay, or maybe I'll start with year 0 only. Year 0, 1, 2, 3, okay. Year 0 means now. Okay, at year 0 now means you have to invest, right? There will be initial investment. Let's say initial investment is 10 lakh assumption. And what is the cash inflow? For 1, 2, 3 you will get the cash inflow. I'm solving it for the best case. For best case scenario, what is the cash inflows? 10 lakh, 8 lakh, 5 lakh. So you have to take 10 lakh, 8 lakh, 5 lakh. Okay, discount factor, let's say as at 10%. Maybe let's make the outflow to be 15 lakh. Okay, instead of 10, let's write it as maybe 15 lakh. Okay. Outflows I'm presenting in brackets as a negative, inflows I'm presenting in positive number. So discount factor for year 0, as I've told you, is always 1. How do you get the present value of cash flow? These two come multiplication, which will be 15 lakh only. This will be 0.9090, 0.8264, 0.7513. So if you multiply, this will be 9 lakh 9,000. 10 lakh into 0.9090 will give me 9 lakh 9,000, correct? Then it will be 8 lakh into 0.8264 will give you 6 lakh 61,120. 5 lakh into 0.7513 will give you 3 lakh 75,650. Okay. How do you get NPV? NPV is nothing but present value of cash inflow minus present value of cash outflow. This is my present value of cash outflow. These are my present value of cash inflow. Yes or no? So when I do this, okay, when I simply add, because anyway I'm presenting outflow and negative, when I add it up, how much is the final number I'm getting? Plus 666 or rather 375,650 plus 661,120 plus 9 lakh 9,000 minus 15 lakh, that is correction, minus 15 lakh. If I do, the final number I am getting is 445,770. That is your net present value. That's what you have to do in scenario analysis. For each scenario, you need to work out the NPV. I've shown it for best case. Similarly, if you're doing for worst case, you will take these numbers as 9 lakh, 7 lakh, 3 lakh as your cash inflows and work out. Okay, that's how scenario analysis is done. Okay, all right. There is another, let's take up one of the examination question maybe. This question came in Jan 2021. I think it came for about 5 marks. Risk analysis and capital budgeting wala question. A project requires an initial cash outlay of 3 lakh, meaning this is your present value of cash outflow. Company uses certainty equivalent method to evaluate the project. Okay, the risk-free rate is 7%. Okay. Cash flow after tax they have given. They have not given earnings, they have only directly given cash flow after tax. Okay. These are your cash flows. Certainty equivalent coefficient or certainty equivalent factor they have only given. Discount factor also they have only given. Evaluate if the investment in the project beneficial. They are saying should we invest in this project or not. Okay, 5 marks. How do you calculate? Simple. Don't take this normally to evaluate the project. We calculate NPV. That's a preferred method. Now don't take this cash flows and find out NPV. Since certainty equivalent cash flows is given, you have to find out something known as adjusted cash flow. How do you get adjusted cash flow? Cash flows multiplied by certainty equivalent factor. Check here. This is your cash flows given. This is your certainty equivalent factor. Multiply these two. If you multiply these two, you're going to get adjusted cash flow. Meaning 1 lakh into 9.90 will give you 90,000. 1,50,000 into 0.80 will give you 1,20,000. So like this, you will get adjusted cash flow. Use this adjusted cash flow and then do your NPV calculation. Discount factor they have only given. See, once you multiply certainty equivalent factor, it became guaranteed cash flow. That means you can use risk-free rate of return. That is only they've saying it as 7%. So basically discount factor is 7%. At 7%, this is your discount factor. These may be adjusted cash flow, but they are not present value because 90,000 you will receive still at the end of year 1. So it's a future value. 1,20,000 still you will receive at the end of year 2. So all these are future value. From future value, if you have to get present value, we have to multiply it by discount factor. That's what they've done. They've considered only cash inflows here. So when you total it up, you're only going to get present value of cash inflow. minus present value of cash outflow, which is your initial investment you do, you're going to get NPV. What is the decision rule? If NPV is greater than 0, you can accept the project, otherwise reject. That's for the individual project decision rule, right? That's what you can write. Since the NPV of the project is positive, meaning greater than 0, it is beneficial to invest in this project, meaning we can take up this particular project is what they are trying to say. All right. Hello guys, welcome back after the break. So let's get started with the next topic, that is dividend decisions. So we know that FM only deals with 3 things, or only 3 decisions are taking place in FM, financial management. That is, one is what? Financing decision. And the next one is investment decision. And then is dividend decision. In financing decision, we think about from where to take the finance, where to arrange the finance, whether we should go for equity share capital, preference share capital, loan, debt, etc., etc. And how much to raise, etc. Alright, that's about the financing decision ka headache. Investment decision ka headache is, should we do this project, should we accept it or not, or if we have multiple projects, which one to choose, etc., etc. Third one is a dividend decision. In a dividend decision, the headache is, or the point of view is, how much dividend should the company pay and how often should they pay so that the value of the firm is maximized. How much dividend should the company pay? How much money should be retained so that the price of the equity shares is highest, meaning the value of the firm should be maximized. That's all is the intention of, or the scope of this particular topic. Okay. Under this, various people have given their own assertions. So we'll have to study their the methods or the things, the fine prints they have given one by one. First, we have some theories revolving around the dividend. One is irrelevance theory. Irrelevance theory, one such theory is given by Modigliani Miller approach or approach. And sir has given the theory that dividend is irrelevant as far as the value of the firm is concerned. As per approach, whether the company pays a dividend or whether the company does not pay dividend, value of the firm will be same. So dividend has no relevance to the value of the firm is what ka hypothesis is all about. For that, they have given their formulas. Okay. So P0, meaning the current market price, P0 we call it as current market price, is equal to, you can remember it as P1 D1K as we used to do it in class. That is nothing but P0 is equal to P1 plus D1 divided by 1 plus cost of equity. P1 is the expected price of the equity share at the end of the year, plus D1 is your expected dividend, divided by 1 plus cost of K is your cost of equity. If you do that, you're going to get the current market price. Alright, so why should we use this? Normally, in all our problem, in an problem, all the data will be given to you in the problem, like this P0, D1, cost of equity, etc. will be given. P1 will be missing, meaning the expected market price of the share will be missing. So we have to use this particular equation to calculate effectively the P1. Okay, every data will be given except P1. So use this to find out P1. Alright. As per theory, the value of the firm you can call, it is denoted by VF, or you can call it as NPO. Okay, that's the value of the firm. That is given with the formula N plus delta N into P1 minus investment plus earnings, the whole thing divided by 1 plus cost of equity. N plus delta N into P1 minus investment plus earnings divided by 1 plus cost of equity. Okay, N we already know that N is nothing but the number of existing equity shares. N is your number of existing equity shares. Delta N is the new shares issued. How many new shares you have issued? We'll spend that in a minute. P1 is the expected market price. I is the how much investment the company is planning to do. Normally, when the company gets money, they will use that money for further expansion plans, for the further future investment, right? That is denoted by I. I is the investment money required. E is the earnings which the company has presently, and present earnings of the company, we call it as E. K is nothing but your cost of equity. Now, what is this delta N? Let's say company has done an earnings. Okay, company has done an earnings in the current year of 10 lakh rupees. 10 lakh rupees they have earned. With this, with the earnings only, the company will declare dividend. Let's say company has declared a dividend of 3 lakh rupees. 10 lakh they earned, 3 lakh rupees they distributed as a dividend. That means how much money is remaining? The money available with the company is 7 lakh rupees. 7 lakh is available. So this 7 lakh rupees, will the company keep it idle or will they use it for the further expansion or for new investment? Nobody will keep the money idle. They will use it, right? Let's say this company has some investment plans in future. They want to expand and they need more investment for it. For that expansion plan, you need an investment of 15 lakh rupees. To undertake a new project or to undertake some expansion, they need an investment of, or they need funds of 15 lakh. Is 15 lakh available with the company? No. Company currently has only 7 lakh. That means company has some shortage. Yes or no? They have some shortage. How much shortage? In 15 lakh is available, but only 7 lakh is available. That means the shortage is 8 lakh rupees. Yes. That shortage, what the company is going to do is, they will issue new equity shares to raise the shortage. Towards this shortage, this 8 lakh rupees company still needs money. That 8 lakh company will raise by issuing new equity shares. That we refer to as a delta N. That is given by the formula shortage in funds divided by P1. So why not P0? You require the shortage, you require funds for in the next year, right? For the further expansion plan. So you will not issue the shares at the current market price. You will issue it at the new market price or expected market price, which is P1. So shortage divided by P1, the expected market price, will give you the new equity shares issued. That only we call it as delta N. Okay. So that means all these components are clear. All right. So as per hypothesis, whether the company pays dividend, here the company has paid dividend, I assume, whether the company pays dividend. Let's say this is case 1, and let's say there is another case 2. Let's say in second case, the dividend paid by the company is 0. They have not paid dividend. Under both the cases, the value of the firm will be, let's say here the value of the firm is 1 crore, means in this scenario also value of the firm will be same. As per hypothesis, the value of the firm will not change. Okay, whether the company has paid dividend or not paid dividend, value will be same. That's the hypothesis or the fine prints of theory. But theory has made some assumptions. They've assumed that it's a perfect capital market, meaning information is freely available. Whatever information you need to invest, okay, is freely available. All the information is available, which is hardly the case because many informations are sensitive, so the company won't disclose. Yes. So that is one assumption hypothesis makes. And then there is no tax and there is no transaction of flotation cost. To issue the new shares, there is no issue expense. There is no share issue expense like underwriting commissions or consultancy fees. Like this, the share issue expense is not there. That only we refer to as flotation cost, right? That it assumes that it is not available. All right. So that's your hypothesis theory. So these two you need to remember and write it in the examination if at all the question comes from this. Okay. All right. Next is the relevance theory. This is quite important as far as the examination questions go. A lot of questions have either come from this particular model in the past. So these come under relevance theory. Relevance theory means these guys or these theory proves that dividend is necessary to affect the price of the share. Meaning they say price of the equity share or the price of the share depends on the dividend policy adopted by the company. Based on dividends, the company share price will vary like that. So under this theory, two people have given their formulations. One is Walter sir, another one is Gordon sir. Okay. Walter sir ka funda is saying price of the share or the current market price P0 is given by the formula D plus R into E minus D divided by K, again whole divided by cost of equity. You can remember it as the red K. That's what we used to say in our class, right? The red K. D stands for dividend per share. R is the rate of return on investment. KE as in cost of equity. E stands for earnings per share as in EPS. D stands for dividend per share. So D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. If you do, you're going to get the current market price of the share as per the Walters model. Even Walters model make the same assumption as the same assumption as approach. Okay, this is about Walter approach ka funda. There is also another person who was given the theory, that is Gordon model. Gordon model is given with the formula. This one is important. Okay, P is equal to price of the share is equal to D0 into 1 plus growth rate divided by cost of equity minus growth rate. Okay, this is not a fancy formula. You have already learned it, or in fact we have applied Gordon's formula to find out cost of equity. In fact, you have done this. Cost of equity is given by what, sir? That is nothing but D0 into 1 plus growth rate divided by P0. If there is any flotation cost, you have to minus. But these guys make an assumption that flotation cost is not there. So cut off flotation cost in the formula plus the growth rate. Okay. Now in this formula, if I give you cost of equity, if I give you D0, 1 plus growth rate and this, can't you find out P0? Yes, you can. How do you find out? What do you do? First G, you send it to the other side. So that means it will become K minus G is equal to D0 into 1 plus growth rate divided by P0. Therefore, how do you get P0, sir? This is nothing but D0 into 1 plus growth rate. This will come here and the cost of equity will come here. So divided by cost of equity minus G. So that is what is a formula. That's all. We have done this formula when we did cost of equity. Same thing has been substituted here. So D0 into 1 plus growth rate divided by cost of equity minus G. D0 stands for dividend declared in the last year. Whatever dividend is already declared by the company, that we call it as D0, D0. G is your growth rate. Okay. K is your cost of equity minus G as in the growth rate again. Alright. If suppose they have not given D0, directly you can also do D1. If you do D0 into 1 plus growth rate, you will obviously get D1. You can also substitute this formula as D1 divided by cost of equity minus G. If D1 is not available, rather D0 is given in the problem, then you can apply this formula, because D0 into 1 plus growth rate, if you do, that is nothing but D1. Next year's dividend. Like let's say dividend declared last year as in D0 is a 10 rupees. Growth rate is let's say 5%. Growth rate means how much more dividend, how much is dividend expected to grow as year passes. Can you tell me how much will be D1? Last year dividend is 10 means this year dividend will not be 10 again, it will increase by 5%. No? So 10 plus 5% you do. 10 plus 5% if you do, D1 will become 0.5. Yes or no? Now apply the formula. D1 is also given by D0 into 1 plus growth rate. If you do this, you're going to get D1 as well. Check. D1 is 10, growth rate is 0.05. If you do 10 into 1.05, if you calculate the same number, you're going to get as 10.5. Okay, that's the reason I said D0 into 1 plus growth rate is nothing but D1. Okay, if they've given D1, use that and work it out. If they give D0, work out this and you calculate. That's all. It's a funda. Okay. Alright. There is another formula as well, that is E1 into 1 minus B divided by K minus BR. This is again not a new formula. If they don't give you dividend approach, if they give you earnings and retention ratio, if they give you EPS and if they give you retention ratio, there is another way you can work out as well. First we will decode. E1 is your expected earnings in future, not the actual earnings, expected earnings. Again in the problem they may give you E0 or E1 depending on the problem, check. E0, E1 is expected earnings in future. Into 1 minus B, we already discussed. B is nothing but retention ratio. Okay, let's say, okay, we'll take this data and prove it to you. We need what, sir? For our garden model, we need either D0 or D1. Effectively, we need D1. Okay, let's say like this. EPS expected, not the actual EPS. EPS expected in the next year is 10 rupees, let's say. Okay. Alright. B as in retention ratio. How much ever company earns, no? Company has a policy of retaining 70%. B as in retention ratio is 70%. That means how much ever company earns, 70% of that they will retain. So how much will be B, sir? Company has expected to earn 10 rupees means 70% they will retain means this will be 7. Okay. That means what will be D1? What will be D1? Because all these are expected numbers, no? In what will be do? In 10 rupees if they are expecting to earn, how much they will retain? 7. That means the D1 will be 10 minus 7 which is 3. Yes or no? That is what is given by the formula. Check if you want. Instead of D1 you can also write E1 into 1 minus B. E1 is expected earnings which is 10 minus 1 minus B. B is your retention ratio which is 0.7. Okay. Alright. So how much will be this? 10 into 0.3 which is 3 rupees. Are you not getting the same number? So that same thing. That's what. Instead of finding if they've given you earnings and retention ratio, to find D1 there is another formula, E1 into 1 minus B. Okay. Alright. So suppose they've given correct, not expected earnings but actual earnings that they've given. If they've given actual earnings, if this is not expected EPS, if it is actually earned EPS, actual number, then you will not get D1. You will get rather instead of D1, you will get D0. If they're given the actual earnings, then you will get D0. But we want in a formula D1. How do you get D1? D0 into 1 plus growth rate. Like that you have to substitute. You'll have to check and accordingly do what is given, use that data and work it out. There are multiple ways to get D1. One way to get D1 is D0 into 1 plus growth rate. This is one way to get D1. Another way is E1 into 1 minus B. If you have taken E1, then obviously you will get D1. If suppose if you take actual earnings, that is E0, then you'll end up getting D0 like that. Okay. If you're getting D0, then from D0 to get D1, you do D0 into 1 plus growth rate. Check and accordingly do it. That's all is the problem. Okay. You need to be a little careful when you're working out the formulas. That's all. Okay. So one of the formulas you can use and under Gordon's approach and work out the price of the equity share. Okay. Alright. This is about these guys. Then there are a few other people who have given their hypothesis as well. One is Graham and Dodd model. According to Graham and Dodd model, price of the share is given by MDE3, we can call it. M as in multiplier, open the brackets and write D plus E divided by 3. M into D plus E divided by 3. M stands for multiplier, which will be given to you in the question. D stands for dividend per share. E stands for earnings per share. M as in multiplier into D plus E divided by 3. If you do, you're going to get the price of the share as per Graham and Dodd model. Okay. Alright. Then there is something known as Linter's model. Linter's model is based on the survey which Mr. Linter did among the managers. He interviewed various finance managers and he came out with analysis. What he came out with analysis is D1, meaning expected dividend is given by the formula D0 plus EPS into target payout ratio minus D0 into adjustment factor. He told to get D1, you have to use this particular formula. Okay, this again looks fancy formula, but it's pretty easy only. What Linter ka like fine prints or what are the Linter ka takeaway is, or due to the survey or due to the survey that he conducted with finance manager, what he got to know is if last year, let's say last year, D0 means last year dividend, right? If last year, let's say his dividend is 10 rupees, means finance managers are willing to pay dividend of 10 rupees in the current year also. If they already paid dividend of 10 in the last year, current year also, he found that finance managers don't have any hesitancy to give the same rate of dividend as per the last year. If last year is 10 means, this year also the finance managers don't mind giving 10. But if you want to increase the dividend date, if D1 is expected to be 15, not 10, if it has to be 15, then he found out that managers are hesitant to increase the dividend in the going forward years. They don't mind paying the dividend which is already paid out in the last year. They don't mind maintaining dividend at the same level. But they have problems with increasing the dividend because if you give dividend out of earnings, right? Normally, if you give dividend out of earnings, the company ka earnings or retention ratio will reduce. Company also need funds for further expansion, right? So hence he found out that managers are little hesitant to increase the dividend as the year passes by. They don't mind paying the same dividend, but to increase they have a problem. Okay. So hence to find out that D1, he gave a formula. First take D0 into EPS multiplied by target payout ratio. Okay, check this. Maybe we'll work it out. Let's say D0 is 10 rupees. EPS expected is 20 rupees. Okay, EPS expected is 20 rupees in the next year. Let's say target payout ratio is 70%. Meaning 70% company wants to distribute as a dividend. Expected earnings is 20 rupees per share. Dividend payout ratio or the payout ratio is 70% assumption. Alright. If you do this, what are you going to get? 14 rupees. That will be your expected dividend or D1. Alright. Minus D0 you do. What is the D0? 10 into adjustment factor. Alright. Let's say I'll take the adjustment factor to be 0.5. Let's calculate this. This will be 10 plus 20 into 70% will be 14 minus 10 into 0.5. I'll explain you this 1 minute. First, let me finish it off. 10 plus 4 into 0.5 is 2. So D1 will become 12. Okay. What is this hypothesis? Okay. If company D1 is 14, right? How do you get 14? Expected earnings, that is 20 into payout ratio. 70% the company wants to give away as dividend. How much ever they earn, 70% they're planning to give away as dividend. That means that will come to 14. Alright. Last year, how much was the dividend, sir? Last year the dividend was 10. This year, how much is the company planning to give? This year company is planning to give 14. So compared to last year, how much is the increase in dividend? Last year company paid a dividend of 10. This year they are planning to give 14. So compared to last year, how much is the increase? 4 rupees per share. Yes or no? 14 minus 10, which is 4 rupees. Now, why do we multiply by adjustment factor? This adjustment factor is nothing but what are the chances that the company will pay this increase in amount. If you multiply by adjustment factor, that is 0.5, what it means is there is a 50% chance that the company will increase this dividend in the current year. there is a 50% chance that the company will pay the increase in dividend in the current year. Okay, if it is not 0.5, if it is 0.9, then there is a 90% chance that the company will pay this increase in dividend, which is 4 rupees, like that. That's all they're trying to say. Actually, this formula could have been constructed a lot easier way. Yes, no. Simply you could have taken D0 plus increase in dividend multiplied by adjustment factor, he could have told. Right? Instead of that, he told D1 is equal to D0 into E plus, D0 plus EPS into target payout ratio minus D0 into adjustment factor. Full on he is trying to kind of enlarge. There's nothing but what? Increase in dividend multiplied by adjustment factor. That is what his finding is. Okay. This is basically a component or a formula which can be used to find out D1. Okay. That's another element as well. Okay. This is about Linter's model, which targets the hesitancy factor. It is being considered in calculating the expected dividend over here. Okay. Okay. Next one is important for the examination. That is optimum dividend payout ratio. This applies for both Gordon as well as Walton. Both have given the same analysis relating to optimum dividend payout ratio. What they say is, if R, that is the return on investment, if it is greater than the cost of equity, if the R as in return on investment, if it is greater than cost of equity, then the optimum payout ratio is 0%. Meaning the company should not pay any dividend. When should they not pay out dividend? If return on investment, that is R, is greater than cost of equity, then the optimum dividend payout ratio is 0%. Meaning company should not pay any dividend. Simple logic. Let's say you're doing a particular project, and from that project you are getting a return of 15%. To do the project, okay, you're getting a return of 15% from the project. Okay, to do the project, obviously you need finance. Let's say you have raised the finance through equity shares, and the cost of equity is, let's say, 10%. The cost of equity, cost of raising this equity finance is 10%. Now you tell me, return from the project is 15%, cost of equity is 10%, so return is greater than the cost. If return is greater than the cost, isn't it a profitable project? Yes. If it is profitable project, do you think any company will distribute earnings as dividend? No. How much ever they've earned, let's say the company has earned 10 lakh rupees from this project in year 1. Okay. Do you think the company will give this 10 lakh rupees back as dividend to the shareholders? No. They will invest, since it's a profitable project, entire 10 lakh, again they would like to invest back in the project to earn more money. Yes or no? Like we are doing now CA coaching. Yes, we do our coaching for various other courses. I mean, in that CA is also one of the coaching or course that we provide coaching for. Suppose CA inter coaching we are providing, and that's a profitable project for us. Let's say many students have come and are taking coaching from us. So it's a profitable project. So from this profitable project, if I am earning any money, alright, that money I will distribute as to the shareholders as dividend. No, I will use this money to do more projects. Yes or no? If I'm doing morning batch of CA inter, then I will also think about starting evening batch. Yes. Yes, if I'm doing only face-to-face batch, then I'll think about doing live online batch, recorded batch, yes or no. Like these, I will think about expanding this, yes or no. So that is what Gordon and Walter is trying to say. If return on investment or if it is greater than cost of equity, then no company would like to pay the dividend. So dividend payout ratio should be 0% to maximize the price of the share. Alright. However, if it's other way around, if it is R is lesser than the cost of equity, let's say return on investment is only 8%, cost of equity is 10%, then you say optimum payout ratio should be 100%. Meaning how much ever you earn, entire 100% of the earnings should be distributed as dividend, because this is not so profitable project. Hence, whatever earning is there, entire earnings you distribute as dividend. So that is your optimum payout ratio, 100%. If R is equal to cost of equity, let's say R is also 10%, cost of equity is also 10%, then Walter and Gordon, both of them say that there is no optimum payout ratio. If R is equal to cost of equity, then there is no optimum payout ratio, or you could say whatever dividend you have paid, that only is optimum payout ratio. Indirectly, they're trying to say, we also have proved it in our regular class by taking a case study. Okay, this factor, how much ever dividend you pay, if R is equal to cost of equity means, whether you pay 10% dividend, whether your dividend payout ratio is 10%, 15%, 80%, 90%, 100%, doesn't matter. The price of the equity shares will be same. Price will not change. Hence, we say there is no optimum payout ratio, or whatever you pay, that itself is optimum payout ratio, or every payout is an optimum payout ratio itself. Optimum means ideal dividend payout ratio. What should be the ideal number? Okay, that's all it is. This also is being again often asked in the examination. All right, let's see one other examination question that came from this particular chapter relating to the things we have studied. This question came in July 2021 for about 5 marker. Let's read it up. Earnings of the company is 30 lakh. So total earnings of the company is 30 lakh rupees. Dividend payout ratio is 60%. So how much ever they are earning, 60% they are giving as dividend. That means how much they are retaining, sir? 60% they are giving it as a dividend means, can I say 40% they are retaining? That retention ratio only we call it as B. B as in Bengaluru. B here stands for retention ratio, which is 60% or rather 40%. Yes, 60% is dividend payout ratio. So B is 40%. Number of shares outstanding is 5 lakh rupees. Okay. So they have given earnings, they have given number of equity shares. That means, can you tell me how much is EPS? How much is EPS? EPS is nothing but total earnings available to equity shareholders. Each, that only we can, they have not given any preference dividend data and all over here. So each is 30 lakh divided by total number of equity shares, which is 5 lakh. So 30 lakh divided by 5 lakh, the earnings per share is 6 rupees. Okay. So how much is the dividend payout ratio? This company has already earned. That means what is the dividend, sir? Or these are expected data. 1 minute. Okay, all right, no problem. Okay, in fact, the earnings of the company, all right. This is not, they have not given earnings expected of the company. They have given earnings of the company. So what will be the D0, sir? 6 into, what is the dividend payout ratio? How much ever they earn, 60% they will distribute it as dividend. 6 rupees they have earned means 6 ka 60% will be 3.6. That will be your D0. Okay. All right, they have not told earnings expected of the company. They've just given earnings of the company. So earnings is the actual data, actual earnings they have given. So D0 is 3.6. Return on investment, that is R is equal to 15%. Equity capitalization rate, that means the cost of equity is 13%. Determine what should be the market value of the share as per Walter's model. So as per Walter's model, what is the formula, sir? That is nothing but what? Walter's formula is given by the formula. The red K I told. D plus R into E minus D divided by cost of equity. Whole thing divided by cost of equity. Yes or no? D is nothing but dividend per share. What is the dividend per share? Dividend per share is 3.6. Okay. Plus R as your rate of investment, rate of return on investment, which is 15% or 0.15, divided by cost of equity, which is 13% or 0.13, into E minus D. E is your 6 rupees. Minus D is 3.6 rupees, which we already got. In fact, here D0, D1 and all is irrelevant because Walter just uses the term dividend. That's all. Or dividend declared, in fact. Whole thing divided by cost of equity, which is 0.13. So solve this equation. It will be what? 6 minus 3.6 into 0.15 divided by 0.13 plus 3.6 divided by 1.13. If you do, as per Walter model, the price of the equity share. The price of the equity share will be 48.99, or you can call it as 49. Okay, you can round it off to 49. That's what they have got over here as per Walter's model. Okay, all right, that's the first case. Next scenario, compute the optimum dividend payout ratio according to Walter's model, and what is the market price of the company share at that payout ratio. At that payout ratio means optimum payout ratio. So you check. Here R is 15% and cost of equity is 13%. That means what, sir? R is greater than cost of equity because R is 15% and cost of equity is 13%. Since R is greater than cost of equity, what is your optimum dividend payout ratio? Optimum dividend payout ratio is 0%, meaning the company should not give any dividend. If you use this formula and find out the price of the share, how do you get? D plus R into E minus D divided by K, whole thing divided by cost of equity. D. As per optimum dividend payout ratio, you should not pay out any dividends. That means D is 0. Into R. What is R? 0.15 divided by cost of equity, which is 0.13. E is 6 earnings per share. D is 0. Whole thing divided by cost of equity is 0.13. You calculate that. 6 into 0.15 divided by 0.13, or 1 second, 6 into 0.15 divided by 0.13, whole thing again divided by 0.13. If you calculate, the price of the share will be 53.25. Check how much was the price before. Price of the share was 49 before. If you follow optimum dividend payout ratio, then the price of the share from 49, it will become 53.25. That is what they have proved it over here. Again, this is the examiner's favorite question. Alright, like this. Either they'll ask Walter ka price as per Walter's model, And what should be the optimum dividend payout ratio, they'll ask. Or they will apply the same thing to Gordon. They will give you data and ask you to calculate the price of the share using Gordon's model. And also they will say what should be the optimum dividend payout ratio and what is the market price of the share if optimum dividend payout ratio policy is followed. This is a question which is often asked in the examination. Okay. All right. So we have gone through dividend decision wala funda again. Okay. Next, let's get to the next topic, that is working capital management. Working capital management. Sir, first of all, what is working capital? Working capital is nothing but current assets minus current liability. So the chapter name is working capital management. So effectively you are managing what? Current assets and some current liabilities. So managing current assets and managing current liability is only what we refer to as working capital management. So why should we manage current assets and current liability? Because they are important concepts. They have some effect. All right, let's understand maybe. If, see, inventory is part of current assets, okay? If inventory increases, meaning inventory level increases, there are some advantages also and there are some disadvantages also. Like normally, let's say your closing stock value was 1 lakh rupees. Normally, you used to have a closing stock of 1 lakh rupees. Let's say this particular quarter or now this particular year, you are holding closing stock of, let's say, 3 lakh rupees. From 1 lakh, your closing stock level became 3 lakh rupees. So you have increased, meaning you purchased more goods and you are storing. Okay. All right. What is the advantage of this? If you are storing more goods or if you are having more goods, one advantage is you can keep up with the demand. Keep up with the demand means, let's say one particular vendor came to you and told, I want to buy goods worth 2.5 lakh rupees from you. One particular guy came and told, I want to buy goods worth 2,50,000 worth of goods from you. If you are storing goods only worth 1 lakh rupees, can you accept that sale order? No, because you don't have that much goods. You have only 1 lakh. You can't, with 1 lakh, you can't sell goods of 2.5 lakh. Yes or no? All right. But if you're storing 3 lakh worth of goods, you can accept this order. Yes or no? So that's what we mean by you can keep up with the demand. All right. Meaning if you have more goods means more closing stock means you can sell more. If you can sell more, obviously the profit will be on the higher side. Okay. All right. So that means yes, if you sell more means your profit will be on the higher side. These are the advantages. Equally, there are some disadvantages also. What is the disadvantage? Sir, if you have to buy more means you need money. All right. Earlier, you just by paying 1 lakh rupees, you with 1 lakh you were able to do the business because only with you required closing stock worth only 1 lakh. Now, if you want stock worth 3 lakh rupees means you have to invest more money. So your funds will get blocked. That is one disadvantage. Second, since you are buying more goods, no, your storage, you need probably a bigger place to store them. So your storage cost will increase. Another main disadvantage is your liquidity risk increases. How? Sir, earlier you had inventory worth only 1 lakh rupees. That means if you make a sale of goods of 1 lakh rupees, you are all set. Yes or no? Now you have goods worth 3 lakh rupees. Suppose if you are not able to sell them, especially if you are dealing with perishable goods like vegetable, fruits and blah blah. Okay, you bought more goods. If you don't find the customers, meaning if you are not able to sell, the goods will get perished. If large quantity of goods, if it gets perished or if it gets destroyed, all right, then what happens? More or less your business shutting down risk is on the higher side. Yes or no? That we call it as liquidity risk. So liquidity risk increases. Hence, managing this component, that is inventory, is important. Hence, managing this current asset is important. That's what we study under working capital management. Working capital management is all about managing current assets and current liability because it affects the liquidity and profitability of the business. Okay. All right. Just now I proved to you if you are holding more inventory means you can sell more. So your profitability increases. But at the same time, your liquidity risk also increases. So working capital management is trying to balance between liquidity and profitability. Meaning, we don't want to compromise on the profit, but at the same time, we don't want to take too much of risk also. So we are trying to balance between this. That's all we are trying to do over here. All right. Similarly, if you want to take one more current asset, that is debtors. If debtors ka balance increases, there is an advantage as well as disadvantage. Advantages. See, if debtors ka balance is increasing means one way that could happen is you are giving more credit period to the debtors. Let's say earlier you used to sell the goods to a debtor with 30 days credit. Meaning if you sell today, you will recover the money within 30 days. Now you told the debtors pay me after 120 days. From 30 days, you extended your credit to 120 days. So if you give so much credit, what do you think debtors will do? He'll start buying more goods from you. That means you will be able to sell more to him. Yes. So if debtors balance increase means obviously your sales will increase. With higher sales, you will have higher profit. That's your profitability aspect. So it's an advantage. But at the same time, there is a disadvantage also. Earlier, the debtor used to pay you the money within 30 days. Now he is paying you the money after 120 days. That means money is getting blocked for extra 90 days. 120 minus 30 is 90. Yes or no? That means the funds are getting blocked for extra 90 days. That is one disadvantage. Funds getting blocked. And bad debt risk also and liquidity risk also increases. Yes. If debtor does not pay you, it's a huge problem. Yes or no? Because some of them will have major debtor. If one of the major debtor is not paying you means, then your liquidity risk shoots up drastically. Yes or no? So again, this is your advantage and disadvantage in having higher levels of debtors. Same goes for creditors also. If your creditors balance increases, when will creditors balance increases? By delaying the payment to creditor. Okay. Or let's say the creditor gave you a credit period of 30 days. Alright. But you are making the payment only on the 50th day. Instead of paying him on 30th day, you are making him the payment on 50th day. That means you are delaying the payment for about 20 days. You are delaying the payment. Is there any advantages in delaying the payment to creditor? Yes, one advantage is it acts as a free source of finance. Meaning, if you are delaying the payment means you can use that money for some other purpose. For this, if you are delaying the payment by 20 days means for that 20 days you can use the money for some other purpose. Maybe you can use this money to pay off your rent, electricity, your salary, something like that. Yes. So by delaying the payment to creditor, for that you are getting extra source of finance or free source of finance for that many days. That is one advantage. But some disadvantages also there. What is a disadvantage? See, creditor is going on asking you the payment. Hey dude, give me the payment. You are going on delaying. Tomorrow I will give, day after tomorrow. Like this you are giving full reasons. What do you think will happen because of that? Your words will start having no value. Yes. That means there will be a loss of goodwill or loss of reputation. 2, he may increase the price of the goods. Alright. He may say earlier maybe he used to supply you the goods at 100 per unit. He may say you are acting smart. No? Okay, I will also start acting smart. Now onwards I will supply you the goods at 120 per unit now. Go. I have increased the price by 20% for you. Because you are delaying the payment. So he also told I will increase the price. In future he told I will sell you goods at 120 per unit. So increase the price of the goods. Or third one, he may say I will not give you the goods on credit anymore. If you want to buy the goods from me means give cash, take the goods. Meaning he may stop supplying the goods on credit for you. Alright. Or he may take extreme action saying I will not even transact with you. Alright. So these are some disadvantages by having high levels of creditors, meaning by delaying the payment to creditors. Hence managing all these components are very important because it affects the liquidity and profitability position. That is all that we are doing in working capital management. It's trying to get the current assets and current liability at optimum level. Okay. That's one. Alright. Next leg if you have to go to means next is something known as operating cycle. So operating cycle means what? Operating cycle means it's a time gap. It's a time period between the time you purchase the goods and pay money for it. Operating cycle means it's a time gap from the time you purchase the goods and pay the money for it till the time you sell the goods and recover the money. That particular period, time frame, we call it as operating cycle. Alright, like just to give you an example, let's say on a day 1, we purchase the goods from creditors. We purchase the goods from creditors and we made the payment. On the day 1 itself, we purchased the goods and we made the payment. Okay, let's say we made the payment on 10 lakh rupees. On day 1, we purchased the goods and we made payment. Let's say on a day 10, I sold the goods to my debtor. Day 1, I purchased the goods. It took about 10 days for me to sell these goods. I sold these goods on 30 days credit. I mean, my debtor is not going to pay me immediately. At day 10, I might have sold the goods, but he will pay me only after 30 days. Why 30 days? Because I've given a credit of 30 days. That means on day 40, I will receive the money from my debtor. Yes or no? I'll receive money from debtor. This particular cycle we refer to as operating cycle. Meaning, When did you purchase the goods and pay money for it? On a day one, you purchased the goods and paid money how much? 10 lakh rupees. You invested 10 lakh rupees for purchasing the goods on day one. When are you recovering this 10 lakh back? On day one only did you recover? No. You will recover this 10 lakh only when you sell the goods to your customer and when the customer pays you. On day 10, you sold the goods. That means, did you recover this 10 lakh on day 10? No. Because on day 10, you did not recover the money from debtors. On day 10, you sold the goods on credit. When did you recover the money from debtors? On day 40. So that means what? Your funds are getting blocked for how many days? On the day 1 you invested. Alright? And when are you recovering the money? On day 40. This time period we refer to as working capital cycle or operating cycle. Or in another way, operating cycle. Or if operating cycle is 40 days means, what is the indication is? If operating cycle is 40 days, then what it means is, for 40 days your funds are getting blocked. Because on day 1 if you have invested means, you are able to recover this 10 lakh only after or only on the 40th day. So your funds are getting blocked for 40 days. That is what operating cycle is trying to calculate. That's what I've written here as operating cycle is nothing but time gap for the payment of purchase of material till the time the goods are sold and the money is collected from customer. That particular, because the cycle of any business is what? Any business ka cycle is what? Purchase the goods, sell the goods, and then recover the money. That is your cycle. That is your operating cycle. That's all. To complete that cycle, how many days are you taking? That's all is operating cycle is all about. Okay. Or another way is operating cycle indicates the number of days for which the funds are getting blocked. See, if they ask you to find out operating cycle, you can't draw timeline like this in examination and get it right. Hence, operating cycle is given by a small formula. That is R. It's given over here. Operating cycle is given by R. R as in raw material holding period, plus W as in work in progress holding period, plus F as in finished goods holding period, plus D as in debtors credit period, minus C as in creditors payment period. So if you do this, automatically you're going to get operating cycle. Okay. All right. So with operating cycle, let's say operating cycle here maybe I'll take another easier example. Let's say operating cycle is 36. Maybe 1 minute. Okay, I'll take it as 36 days. Operating cycle of a particular business is 36 days. Assumption. I'm taking a different case study. Don't relate to this one now. I'm taking a separate case study. Let's say operating cycle is 36 days. Okay. So let's say the number of days in a year, for easier calculation, we'll take it as 360. I'll not take 365 because sometimes in the examination, they'll only mention. Take the number of days in a year as 360 days. Okay. This is just for easier calculation. If you take 365, sometimes you may land up getting with decimal number. That's the reason. Okay. Now, with the help of operating cycle, it's possible for you to calculate working capital. How much working capital you need, no? It's possible to calculate with the help of operating cycle. That's what I'm about to show you now. Let's say operating cycle is 36 days. There are about 360 days in a year. That means, can you tell me how many operating cycles can you run in a year? Number of operating cycles in a year. How many operating cycles can you run in a year, sir? To run one cycle, you need 36 days. Okay, to run one operating cycle, you need 36 days. And in a year, how many days are there in a year? 360. So how many cycles can you run in a year? That is given by the formula. Number of days in a year divided by operating cycle. In this problem, we have assumed that the number of days is 360. So 360 divided by one operating cycle requires how many days? 36. That means how many is this? 10. So in a year, you can do this operation 10 times. Operation means what? Buying, selling the goods and recovering the money. To do this one operation, we require 36 days. And we can do this operation in a year 10 times. Alright. Okay, 10 times, or you can call it as 10. Leave it to that, it's fine. Using this, you can find out working capital. Okay, how you can find out is, let's say your annual operating expenditure. So business means they will have some expenditures, right? Let's say your annual expenditure is 10 lakh rupees. Annual operating expenditures to run the business is 10 lakh rupees. Now check. How can you find out working capital is? Sir, 10 lakh, is it for 1 month, 2 months or whole year? I've given here annual. So it means 10 lakh is for the whole year. And in a year, how many cycles, how many operating cycles can you run? 10. That means 10 lakh is an expenditure for 10 operating cycle. For one operating cycle, how much of capital you require? Okay, how much expenditure you require? 10 lakh is the operating expense required for 10 operating cycles. Why 10? Because in a year, you can run the cycle 10 times. And this 10 lakh is the annual expenditure. So 10 lakh is operating expenditure for 10 cycles. For one cycle, how much is it? Calculate that. How do you get X here? That is nothing but what? X is equal to 10 lakh divided by 10. Which is equal to what? 1 lakh. That is what you can represent it as formula. Working capital is nothing but 10 lakh is nothing but your annual operating expenditure divided by number of operating cycles in a year. I've given all this here. That's what. Okay, this is what I just wrote it over here. Using this particular operating cycle, you can estimate working capital. That's also one type of problem which gets generally asked in the examination. Okay, annual operating expenditure divided by number of working capital cycles. Okay, all right. Okay, just to go one step back. All right, sir, is there any magic formula for operating cycle? Meaning operating cycle should be 35 days, 40 days, 350 days, 100 days, 80 days. Anything like that? No. Actually, there is no magic number for operating cycle. Operating cycle depends on the industry that you belong to. Okay, operating cycle is influenced by the nature of business, meaning the type of industry you belong to, type of products you are selling, if you are a manufacturer, etc., etc. Because if you just check, if you are in retail industry, sir, or rather not retail industry, let's say real estate industry, meaning you'll construct the apartments. Your job is you'll construct various apartments. One big society you will construct. Okay, it will have many apartments, and you will sell that apartments. Okay. Now, can you construct that apartment in 1 day or 30 days? No. To construct apartment, maybe you require 400, 500 days. Quite possible. Yes. So, if you are in construction industry, your operating cycle could be really lengthy. If you imagine, to construct only, they may require 400 days. After construction, they will sell it to the customers and then recover the money. So, if you are in constructing industry, the time gap of recovery of money could be really huge. It could be 400, 500, 700 also. Alright. If you are having an operating cycle of 500, 600 for construction industry, you cannot say it is bad, because for that industry, operating cycle is expected to be quite long. However, if you are in a food industry, hotel industry, or retail industry like supermarkets, the number of operating cycle will be really small. Okay, because what? If you buy the goods today, in 1 or 2 days, the customer will come and buy it off and sell it. I mean, you will be able to sell the goods to the customers. Yes or no? Like especially big bazaar and all, if you think. Okay. If they are buying any, or do you think they will hold their inventory for a really long period of time? No. If they buy the goods today, within the next 4 or 5 days, generally those goods will be sold off, and again they will buy. Yes or no? And moreover, they will not have any debtor headache also, because they work on a cash and carry system, right? If a customer walks into big bazaar, means he has to pay the money and then only he'll get the goods. Yes or no? So supermarkets and all can have really small working capital. Okay. So just because your operating cycle or working capital cycle, if it is big or number, don't say just because operating cycle is 40 days, 100 days, 50 days, don't comment that it is good or bad. It all depends on the type of industry and the type of products you are selling also. Like, if you give you a little more examples, if you are a trader, meaning wholesaler or a dealer, okay, you may have a less operating cycle compared to a manufacturer, because manufacturer has to first buy raw material, use that raw material to manufacture finished goods, and they'll sell that finished goods. So he needs time to manufacture also. But if you are a dealer, meaning if you are a wholesaler or a retailer, you will not have manufacturing time. No, you buy the manufactured goods and then sell. So your operating cycle could be little lesser. So it depends on the product also, etc., etc. So there is no magic formula, is what I'm trying to say there. Okay. All right. So these are some things. Generally in working capital management topic, no, there are about 3 to 4 types of problems which gets asked. So I've just jotted down a few points for you. Let's go through them. In our regular batch, we have, for each type of question, we have done at least 6 to 7 problems for each type. Okay. Now, since we are doing the revision, if we do start doing problems, it will take, each problem will start taking half an hour, 45 minutes. That there is no point. So whatever we do in the problem, I have listed out the points over here. So let's discuss that for our revision. Okay. All right. Normally, one sort of problem that they ask you in the examination relating to working capital management is estimation of working capital. Estimation of working capital, or maybe one step back I will go and then maybe tell you this. Okay. I mentioned this, but I just want to reiterate that point. Okay. We calculated operating cycle. Yes or no? What is this operating cycle? If operating cycle is 36 days, then what does it mean? If operating cycle is 36 days, what does it mean? The funds are getting blocked. the fund gets blocked for how many days? The fund gets blocked for 36 days. Yes or no? If operating cycle is 36 days meaning if you invest the money today, you will be able to recover the money only after 36 days. So for that 36 days, the funds will get blocked. Similarly, if let's say operating cycle is 100 days, then what it means? You will invest the money today, but you will be able to recover that money only after 100 days. Meaning funds will get blocked for 100 days. Now you think, let's say there is a business, they have operating cycle of 100 days. Okay. Meaning their funds are getting blocked for 100 days. Okay. Can this company, let's say name of this company is X Limited. Can this company X Limited tell their employees, can they tell their employees, hey, my operating cycle is 100 days, macha, I will give you salary on the 100th day, or I will give you a salary on after 100 days. Because if I invest the money today, no, I will recover the money from debtors only after 100 days. Okay. So I have shortage of funds. I will give you salary also after 100 days. Do you think this will work? What do you think employees will say? Salary people or your rent and all, like other expenses like salary, rent, blah, blah and all. If you say I will pay after 100 days, do you think they will agree? No, they will quit and go. Yes or no? They will say yours is Dabba company, waste company, or let me quit and find another company. Yes or no? Okay. Now what the companies do in such cases, since the funds get blocked for 100 days, right? To manage the business, you need money, yes or no? If your funds are getting blocked for too many days, then how will you pay salary? How will you pay rent? How will you pay electricity bill and all? You need funds. Hence, company takes something known as working capital loan. You must have heard about this somewhere. The company has a working capital loan of 5 lakh. Working capital loan or short-term loan or bank overdraft or cash credit and all, you must have heard. That is nothing but this. Since the funds are getting blocked for 100 days in this case, to manage this 100 days expenditure, company has to take some short-term loan. That we refer to as working capital loan. Is that okay? Fair enough? Alright, so that's about this. So why did I say that point here is, that is related to this point that we are about to solve. One sort of question that get asked often in the examination is estimation of working capital. How much working capital the company needs? Because if there is shortage means company has to take that working capital loan. So one sort of problem is estimation of working capital. First of all, what is working capital? Current assets minus current liability. So to estimate working capital, you have to estimate each component of current asset and each component of current liability, because only then you will be able to get working capital. Yes or no? So that is this sort of problems. Okay, you have to estimate each component. They'll give you some data. Using that, you have to estimate all these numbers, current assets and current liabilities. So how do we estimate? Let's go through them one by one. First, I've written the heading current assets. Under current assets, you will have stock. No? If you are a manufacturer, you could have 3 types of stock. One is stock of raw material, another one is stock of WIP, another one is stock of finished goods. Yes. Now, how do you get raw materials? How do you get raw material ka closing stock or raw material ka stock? That is given by the formula. Annual raw material consumed divided by 365, 52 or 12 into raw material holding period. Now what is this? Let's say one company. See sir, if you are a manufacturer means, okay, you will consume the raw material. You cannot sell the raw materials. Yes or no? If a particular company, if there are manufacturers and if they buy raw materials, will that manufacturer sell the raw material? No. They will use this raw material in their production process to manufacture finished goods. Yes or no? Meaning, can I say raw material will not be sold, rather it will be consumed to produce finished goods. Okay. That is what I've written it as raw material consumed. Raw material consumed means raw material used to produce the finished goods. Let's say a particular company, they have consumed, okay, in a year they have consumed 10 lakh worth of raw materials. Totally for their production process, they have consumed 10 lakh raw material. Cost of raw material worth 10 lakh rupees they have consumed. Okay, that means what sir? This 10 lakh is for the whole year. Yes or no? Like this, if you want me to present in box. 10 lakh is the annual raw material consumed. That means this is for the whole year. Okay, sometimes they will give you this year, no? Okay, they may give you in days, or they may give you in weeks, or they may give you in years. That's the reason denominator I've written it as 365. If they give you in days, you will use 365. If they give you data in weeks, you will use because 52. Why? In a week in a year there are 52 weeks. No, so. Or if they give it in months, you will write 12 because there are 12 months in a year. Okay. Sometimes they also say, assume that there are only 360 days in a year. Like that also they may say. So your denominator could be 360. Now why do we do that? Check. This 10 lakh is the total material consumed in a year. That means this is for 365 days. In the problem they say, see, entire raw material, you might have consumed 10 lakh worth of raw material in the year. That means entire 10 lakh raw material every time you will store. No, right? Only some goods you will store. Yes or no? Let's say on an average 30 days ka raw material you will store as inventory. Okay, 30 days ka raw material you will store as inventory, and when it gets over you will buy it again. Like that the company does. Now 30 days ka raw consumption they will store it as inventory for buffer, safety purpose. Okay, that much only they'll keep it as stock. Once that stock gets over or gets used in the production, they will buy the order again, or they will place purchase order again, and they'll keep buying. Is that okay? I mean, stock is maintained for how many days? 30 days. For 365 days, the total cost of raw material consumed is 10 lakh. For 30 days, how much? That is what is the formula. How do you calculate X over here? Check. 30 divided by 365 into 10 lakh divided by 365 into 30. That is what I have written here. What is this 10 lakh? Annual raw material consumed. Total material consumed in the year divided by 365, because I have taken the components in days, multiplied by 30. What is this 30? You're on an average how much raw material or how much stock of raw material you are holding. That stock of raw material you are holding only for 30 days. That's what I have written it as raw material holding period. If you do this, you're going to get raw material ka closing stock. Okay, that's one. Alright, first component. Similarly, you could also have stock of work in progress. Yes. Work in progress means what? You purchase the raw material. From raw material, you will produce finished goods. Yes or no? Alright. To convert this raw material into finished goods, if the production process is complex, sometimes it could take 10 days, 15 days, quite possible. Especially if you are in brewery industries like wine, beer and all. No? Okay. To convert this raw material into finished goods may take a lot of period of time. Yes or no? Okay. Let us say, for our business, no? Or maybe let's take like this. There is one business. They know to convert raw material into finished goods, they take 10 days. So it takes about 10 days to convert raw material into finished goods. Okay. So on day 1, let's say day 1 is 29th March 2023. On day 1, you started the production. You bought the material. You started working on it. Okay. And laborers also have come. Okay, so it means it will get completed, or maybe all right, 29 I've taken, no issues. That means let's assume the day 10, it will be completed on day 10 only. If you count from 29, 30, 31st, 1, 2, 3, 4, 5, 6, 7. Let's say on 7th April 2023, this raw material will get converted into finished goods. 10 days basically. I've counted 10 days from 29 March. Yes or no? But between these two dates, there is an important date. What is that important date? 31st March 2023. Okay, this is the date your year closes. Yes or no? Because your year ends on 31st March 2023. Now what is this is? Check on 31st March 2023. Is this goods raw material? No, it is not raw material because you started working on it. So it has changed its characteristics. Some process you have already done. So it is neither raw material. Okay, is it finished goods? No, is it not finished? It's not finished goods because still some work is pending. That goods which is neither raw material nor finished goods, which we refer it as work in progress. So it is neither raw material nor work in progress. It is not raw material because you started the work. So it does not have the characteristic of raw material. You have done some work on it. It is not finished goods also because the work is not fully complete. Only when the work gets fully completed, then only it will become, only when the production gets fully completed, it will become finished goods. That in between stage, Yadabidangi stage, need na garka na gatka, somewhere in between it is stuck. That we call it as work in progress. So if you are a manufacturer, you may have work in progress ka stock also. Is that okay? So how do we find out work in progress ka stock? Alright, work in progress means work is going on. So you'll start the work only after buying raw material. Yes or no? Normally in the problem, they will give you, okay, work in progress ka units. Let's say company has 4,000 units under work in progress. Okay, 4,000 units is work is still going on. It is not yet completed. Okay, so how do you find out stock of that? First, to start the work, you need materials. So number of units, just given by the formula, units multiplied by material cost per unit multiplied by percentage cost. Okay, now what is this? Let's say unit cost is 4,000 units. We have 4,000 units of WIP. Okay, and to buy one unit, it costs about 10 rupees. To buy one unit of material, it costs 10 rupees. 10 rupees. So we have 4,000 units. So 4,000 into 10 will become 40,000. Okay, multiplied by percentage complete. See, normally you start the work only after buying material. Alright, material will be fully 100% complete. Generally, in most of a problem, material will be 100% complete. Because only after buying all the materials, you will only start the work. Yes, there will not be anything pending related to materials. So, material generally will be 100% complete. That's your percentage. Is that okay? Because only after buying materials, you will start the work. Hence, this is 100%. Now, you will understand the significance of percentage for the next one. Let's say labor cost. Because if you want to convert raw material into finished goods, you need a material also. And some laborers also should come and work. Okay. And some other cost also you will incur that we refer to as overheads. Or overhead means your indirect cost. To convert raw material into finished goods, maybe you require some managers who supervises the affairs, etc. etc. All those indirect costs we refer to as overheads. Okay, because other than material labor, you require other cost also, other indirect cost also, which we refer to as overheads. So let's see how labor works. Number of units. How many units of WIP in this example I have taken? 100, or rather 4,000 units. Let's say labor cost for 1 unit is, let's say 20 per unit. Labor charges per unit is 20 rupees. Okay. Alright. Do you think labor will be 100% complete? Do you think labor will be 100% complete? See, let's say to convert raw material into finished goods, you require labor time of, let's say, 50 hours. If labor comes and works for 50 hours on this product, it is good time to convert, or it is sufficient to convert raw material into finished goods. Like for us to complete the syllabus, we need no. Okay, like FM. To complete FM syllabus, FM is like almost 100 hours. To complete FM, more or less, we take 1 month. Yes or no? So if a faculty comes for 1 month and if he teaches, then the FM will be completed. Yes or no? Alright? Alright, like that. Okay, like that only I've assumed. If labor comes and works for 50 hours on this product, then from raw material it will become finished goods. Let's say till 31st March 2021, labor has only come for 20 hours. Meaning, why 20 hours? Because the year has ended on 31st March. Till 31st March, labor has spent his time only to the extent of 20 hours. Balance 30 hours he will spend from 31st March to 7th April. Balance other days he will spend. Till 31st March, only 20 hours of labor time has been completed. That means, can you tell me the percentage? Total required is 50. In that, he has only come for 20 means, can I say 40%? Because 50 ka 40% is 20. Yes or no? That is what here we need to take as percentage complete. Normally, labors and all will not be 100% complete. Because if it is 100% complete, that means will this goods will still be work in progress? Huh? If labor and comes here and works for 50 hours, will this goods still be work in progress? No. If he comes and works for this 50 hours, then that goods will not be work in progress. Rather, it will become finished goods. Still, some work is pending. That is the reason we say it is work in progress. Yes or no? That is the reason it's important to multiply percentage complete. It will be generally given to you in the question. Towards labor and overheads, the work is 80% complete, 60% complete. Like that, they will generally give you in the problem. So in my example, how much percentage is complete? Only 20 hours he has worked means 40% of the work is complete. So hence you have to multiply this by 40%. Okay? Into percentage of completion, which will be mentioned. So why is it 100% for material? Because for material, there will not be anything pending. For labor, there could be pending hours. For material, what will be pending? Because only after receiving full material, you will start the work. Hence, generally for material, it will be 100%. But for labor and other cost, it will not be 100%. Because even if this material and overheads, if it is 100%, then it will not be known as work in progress. It will obviously will become finished goods. Yes or no? That's the reason percentage completion. Same thing if you want to do it for overheads, meaning other indirect cost. Number of work in progress units is still 4,000, I assume. Let's say overhead cost is 15 per unit. Okay. Let's say this is also 40%. This they will mention in the problem. You don't have to worry about this. This if you do. So work in progress means all these three costs will be incurred. If you add all of this, you're going to get work in progress ka stock. Okay. That's all. Raw material of closing stock of raw material you got, closing stock of work in progress you got. Then stock of finished goods. The finished goods means what, sir? Is it fully complete? Yes. So for this, how do you do is take the annual cost of production. Okay, there is a way to get this. I'll put it in the next chart. I'll show you. Annual cost of production. Okay, let's take the example like this. Let's say annual cost of production is 10 lakh rupees. Annual cost of production to produce the entire, in a year, to produce all the goods, totally you have incurred a cost of 10 lakh rupees. Annual cost of production. Okay. That means this 10 lakh is for 360, or we'll take it as 360 days maybe, or it's okay. 365 only we'll take it. This 10 lakh rupees is the annual cost of production, meaning it is for 365 days. Okay. Your produced 10 lakh goods means entire 10 lakh goods will be in your closing stock as inventory. Entire 10 lakh you will store it? No. This is your production for the whole year. Out of that production, some you would have already sold. They will give you in the problem. Normally, the company holds 60 days stock of finished goods. They will mention the number of days. For example, I'm taking it as 60. Don't worry about the days they will give you. I'll repeat that once again. In the problem, what they'll say is normally the company stores 50 or rather 60 days of stock as finished goods. Okay. So 10 lakh is the annual cost of production for 365 days. Meaning for 365 days, the value is 10 lakh. For 60 days, how much is it? That's what we are trying to find. How do you get X over here? 10 lakh divided by 365 into 60. Yes, no cross multiplication, everyone is comfortable. This two will be multiplied and here it will go like this. So what is this 10 lakh? That is your annual cost of production divided by number of days in a year, which is 365, multiplied by finished goods holding period. Normally you hold the finished goods stock for 60 days. That's what I've written it as formula over here. Stock of finished goods is given by annual cost of production divided by 365 into finished goods holding period. If they give you the data in days, take 365 or 360 depending on the problem. If they give it in months, take 12 in the denominator. If they give it in weeks, take 52 in the denominator and work it out like that. Check the problem and accordingly work it out. Okay, and this is about stock. If you add all of this, you're going to get the stock. Then debtors. Okay, the debtors. To calculate debtors, you have to take, I'll say this once and then we will connect. We need annual cash cost of credit sales divided by 365 into debtors collection period. Okay, annual cash cost of credit sales divided by 365 into debtors collection period. Now what does this, or how do you find out annual cost, cash cost of credit sales? That I have put it as a separate component over here. Okay, this many of you have studied in your costing. This is your cost sheet format. Okay, that I've just listed it out for a quick reference of yours. First, raw material consumed, total raw material, all these are annual data. Total raw material consumed in a year plus total labor cost plus total overhead cost. If all of this, if you add, you're going to get factory cost. And this total raw material consumed should be including finished goods, or rather it should be including WIP, meaning this raw material consumed should be considered for finished goods as well as WIP. Meaning, let's say company has produced 20,000 finished goods and they have 4,000 units of work in progress. For finished goods also you might have purchased some raw material. For work in progress also you might have purchased some raw material. Yes, towards both raw material will be consumed. So total raw material consumed both for finished goods and WIP you should consider. Okay. Same here, wages. You might have incurred some wages cost to produce finished goods. You would have incurred some wages cost for WIP also. So both you need to consider. How much is raw material for finished goods plus how much is labor or rather how much is labor cost for finished goods plus how much is labor cost for WIP. Both you need to add. That is this number. That's what I've written here as including WIP. Meaning this data should be considered for finished goods and WIP. So all this cost if you add, you're going to get factory cost. This is your cost sheet format. From factory cost, if you add opening stock of WIP, meaning work in progress, and deduct closing stock of WIP, you're going to get the annual cost of production. Annual cost of production. This annual cost of production you use to find out the closing stock of finished goods. You remember that's what we wrote here. Closing stock of finished goods is given by annual cost of production divided by 365 into finished goods holding period. So from this working note you will get annual cost of production. Okay. To that, if you add administrative expense means your administrative expense could be your accountant salary, etc., etc., corporate office depreciation, etc., etc. All these are administrative expenses which they will give it to you in the problem if at all it is available. It is there means add, and then if you add opening stock of finished goods and closing stock of finished goods, if you deduct, what you're going to get is the cost of goods sold, which we call it as in short form COGS, cost of the goods sold. From cost of the goods is sold, if you add selling expense, you're going to get the annual cost of sales, or you can call it a COS, annual cost of sale. All these figures are on an annual basis. That's the reason you're going to get annual cost of sales. This is a simple cost sheet format. You have done it in your costing. I've just called it out. Okay. All right. We take this as a base to work out debtors, or more importantly, we don't require annual cost of sale. We require annual cash cost of credit sales. Because on sales you will not get debtors. Debtors will only come into play if you're selling the goods on credit. So from annual cost of sales, you need to arrive annual cash cost of credit sales. Okay, how do you get that? Let's say this is 20 lakh rupees. Annual cash cost of sale is 20 lakh rupees. Let's say company sells 20% of its goods on a cash basis. 20% of the goods they sell it on cash basis. That means 80% of the goods they sell it on credit basis. Yes or no? So total cash cost of sale is 20 lakh, and in that 80% is on credit sales. Means multiply these two numbers. If you multiply, what are you going to get? 16 lakh. That is your annual cash cost of credit sales. We take this number and arrive debtors. Okay, how do you arrive debtors? I'll just give you a minute. Observe that. Take the cost of sale, multiply it by the credit sale percentage, which generally they would have given to you in the problem. So if they don't give, you can assume that entire cost of sale relates to credit sale only. Meaning you can assume that all the sales are made on credit basis only and do it the calculation. Okay. See, working capital means we require current assets and current liability. And one of the components of current asset is debtors. To calculate debtors or to estimate debtors, we need annual cash cost of credit sales. How do you get this? Check. Alright, 16 lakh is the number for whole year, meaning it is for 365 days. Yes. Okay. But to debtors, will you give a credit period of 365 days? Whole year you will not give credit. Yes or no? You may give a credit of 30 days, 40 days, 50 days, etc. Let's assume to debtors you give a credit of only 30 days. This if you do, you're going to get debtors. Calculate this. 16 lakh is annual cash cost of credit sales. The 16 lakh is for the whole year. If you want it in Dabba format, you can put it up. For 365 days, this is 16 lakh. For 30 days, how much is it? That's what is the representation formula. So 16 lakh divided by 365 into 30 if you do. I'm getting my calculator showing the debtors balance to be 1,31,506, or I can round it off as 1,31,507. This is your debtors. Okay. Alright. So one doubt you may ask, sir, debtors means it will come on sales. No sir, why did you take annual cost of sales and all? Alright. Sir, when you are estimating working capital, no, you should not take sales value and find out debtors. We should always consider cost of sales. We should not take sales number and arrive debtors. We should take cost of sale, or more importantly, cost of credit sales we need to take and derive. Why? As I already explained to you before, what is working capital? I told you, if working capital cycle or operating cycle is 40 days means, what is the meaning of that, sir? If working capital cycle or operating cycle is 40 days means, what does it mean? For 40 days, the funds are getting blocked. Yes or no? Yes. Now you're trying to ascertain, you're giving credit to the debtors. Yes or no? When you give credit to the debtors, your debtor is delaying the payment. Yes or no? Is delaying the payment. That means if you by giving 30 days credit to the debtor, your funds are getting blocked to the extent of 30 days. Yes. Now you tell me, you'll buy the goods at what price? To sell the goods, first you have to buy it. Yes or no? You'll buy the goods at selling price or no? First you will buy the goods at cost price. Let's say cost price is 100 rupees. Okay. And then you will sell it at maybe 120 rupees and make some profit. Yes or no? Right? Let's say profit will be made to the extent of 20 per unit. Yes or no? You will buy the goods at 100. It could be any number. Just for simplicity's sake, I've taken it as 100. First you will buy it at cost price. Then only you will sell. Okay. To buy the goods only you need funds. No? To buy the goods only you need funds. Yes or no? Alright. So that's the reason debtors we estimate from cost angle and not from sales angle. Is that okay? Because to sell the goods, first you need to buy. And when you buy, you have to invest the money. And when you invest the money, your money gets blocked. Why your money gets blocked? Because your debtors pays you only after 30 days. So to the extent of cost, why cost? Because you are buying the goods at cost price. First you are buying the goods and you are paying the money, you know. Alright. So the money gets blocked not to the extent of selling price. Money gets blocked to the extent of cost price. Hence, whenever you are estimating debtors or whenever you are doing estimation of working capital problem, debtors is always calculating using cost of sale approach and not the sales approach. Because sale is a residual value. To the extent of cost only your funds get blocked. That's the reason we take cost of sales. Alright. And more importantly, we don't take total cost of sales. We require cost of credit sales because debtors arises only because of credit sales. That's the reason we take this credit sales number on cash cost of credit sales number and work it out. Okay. Same fund. That's what I've written it as formula over here. Debtors is given by annual cash cost of credit sales. Annual means this is for the whole year, meaning it will be for 365 days. Multiplied by the credit period given to debtors, 30 days. Like that. Okay. That's what I've given it as box approach over here. I hope you understood that. Yes. 16 lakh or for 365 days, the number is 16 lakh means for 30 days, how much is the number? Because your debtors are outstanding only for 30 days. That's the reason you get this number. Fair enough. Okay. Always remember, for debtors, we have to take annual cash cost of credit sales. That's a point over here. So what is this cash cost, sir? That I didn't understand. Can you explain? Sir, cash cost, no, always no, you are estimate the working capital using cash cost approach. Cash cost means only those expense which you will settle in cash, only those will be considered for your working capital estimation. What did I say? Only those expense which will be settled in cash. Maybe you have already settled it or you're going to settle it in future. It does not matter. Only those expense which will be settled in cash, only that will be considered for your working capital estimation. So can you give an example? Yes, depreciation is an example. Is depreciation a cash expense or non-cash expense? Depreciation is a non-cash expense. So whenever you are calculating or whenever you are putting this statement, no, depreciation will never come into picture. If at all they say depreciation is included in overheads, suppose they say overheads is 10 lakh rupees, they give you in the problem like this, total overhead cost is 10 lakh rupees. In that 1 lakh depreciation is included, suppose they tell like that. For our working capital estimate problem, we will not take 10 lakh because 10 lakh includes a non-cash expense of how much? Depreciation of 1 lakh. That means how much is the cash expense? In a 10 lakh rupees, if non-cash expense, that is non-cash expense of depreciation is 1 lakh, means balance 9 lakh will be cash expenditure. Yes or no? We take only cash expenditure and we have to do our working capital estimates. So that means here we will not take 10 lakh, we will only be taking 9 lakh in doing the problem. Okay. This is the cash cost approach. There is another approach known as the total cost approach also. To estimate working capital, there are two approaches. Cash cost and total cost approach. If you are using cash cost approach, then only those expense which will be settled in cash will be considered. Meaning the other non-cash expense like depreciation, amortization, etc. will be ignored. Alright, for which approach? Cash cost approach. However, if you are estimating working capital under a total cost approach, then all the cost, doesn't matter whether it is cash cost or other non-cash expense, everything will be considered. So if you are working the working capital under total cost approach, then you will take the overhead cost here including depreciation, which is 10 lakh. Okay, check the problem what they are saying and accordingly revise. So in the problem, if they don't mention which method, whether to take total cost or cash cost, if they don't mention what to do. If they don't mention what to do in the problem, always prefer cash cost, because cash cost is more logical. Because working capital means what, sir? For how many days your funds are getting blocked. For your funds are getting blocked means some cash should be tied up, yes or no? Hence non-cash expenses are irrelevant as far as working capital is concerned. So if at all they don't mention, my preference is you should always solve under cash cost approach only, even if they don't mention. If they mention total cost, do it under total cost like that. If they don't mention, always choose cash cost approach. Okay. So yes, this is your cost sheet ka formula. Using this, you will be able to find out the debtors element basically. That's what I've given over here. Okay. Debtors, annual cash cost of credit sale divided by 365 into debtors collection period if you do. So all these are components of current assets. Normally cash and bank balance also. Generally these will be given in the question. No, this we don't have to estimate. They'll only say company wants to maintain a cash balance of 1 lakh, 10 lakh, etc. will be given. Cash is also current asset, no? So add that. So all these are your current assets. If you add everything, you're going to get total current assets, some number. Okay, let's say this is 50 lakh rupees. This is your current assets. But how do you get working capital? Current assets minus current liability. So now you have to estimate all the current liability. Current assets ka estimation only is little lengthy and important. Current liability more or less fatafat it will happen. Okay, because hardly one or two will be given. That's all. One such current liability is creditors. How do you get creditors? Okay, same data. So from creditors, first of all, if you are a manufacturer, what you will buy from creditors? You are a manufacturer means you will buy what? You will buy raw material and convert that raw material into finished goods. That means what do you need? The company needs raw materials. So raw material they will buy from creditors. Yes or no? Alright. Let's say you have purchased a raw material worth 15 lakh rupees in a year, meaning in 365 days. For the whole year, you have purchased totally 15 lakh worth of raw materials from the creditors. Okay, totally you have purchased 15 lakh for the whole year, 365 days. Entire 15 lakh, can you keep it outstanding? Whole year you have purchased. Can you keep entire 15 lakh outstanding? No. The creditor will not give you credit of 365 days and all. He may give you credit of how much? Maybe 30 days, 20 days, 50 days like that. Let's say the credit is, let's say 40 days. Creditors gives you a credit period of 40 days. Meaning, if you buy the goods today, within 40 days, you need to pay creditor his money. Yes. Alright. For 365 days, if the value is 15 lakh, means for 40 days, how much is the value? That's what you need to find out. How do you find out X here? 15 lakh divided by 365 into 40. What is this 15 lakh? Cost of raw material purchased, not consumed. Here you need to be careful. Annual cost of raw material purchased, because from creditor, what do we require? Cost of raw material purchased, and more importantly, cost of raw material purchased on credit. Okay, we require credit purchases only, because cash purchase is irrelevant. If you are purchasing on cash, means will creditors come? Creditors will only come when you purchase the goods on credit. So we require annual cost of material purchased on credit. That's what is this 15 lakh divided by 365 into 40. What is that 40? The credit period given by creditors. That's what I've written it as formula over here. Annual cost of material purchased on credit divided by 365 into credit period given by creditors. And watch out, the day, sometimes they may give you in days, weeks or months. Accordingly, choose one. Don't choose everything in denominator. Choose one component in the denominator to find out the creditors. Alright. Then you may have some outstanding expense also. Some labor charges outstanding, some overheads cost outstanding expense you may have. How do you get that? Same funda. Let's say we have electricity bill outstanding, or let's say labor cost is outstanding. Let's assume the 10 lakh is the total labor expense you have incurred for the whole year, meaning for 365 days. 10 lakh is the total labor cost for the whole year, meaning for 365 days. Entire 365 days ka wages, can you keep it outstanding? Then laborers will go on strike only. Full dangle it will be there. Yes sir. Alright. So 10 lakh is the total wages for 365 days. Let's say wages is outstanding for 30 days. This they will give you in the problem. How many days wages is outstanding? Okay, let's maybe take it as 20 days wages is outstanding. For 20 days, how much? So how do you get it? X here? 10 lakh divided by 365 into 20. What is this 10 lakh? The total expense for the year. Yes, no? Divided by 365 into lag in payment. Lag in payment means for how many days it is outstanding. Either they will use the term lag in payment is 30 days, or they will say wages outstanding is 30 days. That is nothing but the outstanding period. Do that and you will get the outstanding expense. I have given you one formula. Like this, you may have 3-4 outstanding expenses. Same formula will continue. If you add up all the current liabilities, you're going to get the total current liability. How do you get working capital? A minus B. A is your current asset, B is your current liability, is what I've represented. So current assets minus current liability will give you working capital. Generally in these questions, they say maintain safety margin. Meaning whatever working capital, let's say you have found out a working capital to the extent of 20 lakh. They will say in the problem, for unforeseen circumstance, maintain contingency of 10% or maintain a safety margin of 10%, they will say. Meaning whatever working capital you have got, when you calculated you got 20 lakh, right? Multiply the contingency percentage or safety margin percentage, which will be provided to you in the question. For simplicity, for explanation, I have taken 10%. It could be anything. So 20 lakh ka, this number ka 10% if you do, you're going to get 2 lakh. That means your net working capital will be 22 lakh rupees. Okay, that's how much you require. If you don't have that much, you have to take a loan to the extent of 22 lakh to manage your affairs. This is the estimation of working capital problem. If you do a problem, it will take a lot of time. Hence, I've just taken some random examples and I'm trying to illustrate how you can solve this problem. Generally, this is one of the examiner's favorite question. Has been asked previously a lot of times in the examination. Estimation of working capital. Okay. All right. Then, excuse me. Another sort of problems which generally that can come from this particular chapter is evaluation of credit policy of debtors. Let's say currently the company gives 30 days credit. The company gives 30 days credit to the debtors. Okay. So company is thinking, why don't we give let's say 90 days credit to increase the sale? Because we know the more credit you give to the debtors, you'll be able to achieve more sales. Yes. So your profitability, sales and all will increase. So let's say how this question will be phrased is, currently the company has a policy of giving 30 days credit to the debtor. They are thinking, should they extend this credit to 90 days? Meaning instead of 30 days, now should they give 90 days credit? That you need to evaluate. Existing scheme versus new scheme you need to evaluate and give a decision whether should the company continue with the existing policy or should they go for new policy. That is one sort of problems that they give. Simply what you need to do it is, under existing policy you need to find out the net benefit. Okay, the net benefits. Under new policy you need to find out the net benefits. if your new policy is giving you more benefits than the existing policy, you can implement the new one, or other way around like that. Or maybe let me take a point and prove it to you. Okay. Or let's say, I'll just take some random numbers. Let's say expected sales in the existing policy is 1 lakh. Under the current sales, we are making a sales of 1 lakh rupees. So to sell the goods means there will be certain cost. There will be maybe some variable cost and some fixed cost. Let's say variable cost is 50,000. This is, let's say, 10,000. Variable cost is 50 and fixed cost is 10. That means what is the total cost excluding bad debts? Meaning cash cost of credit sale. To sell the goods, how much cost you are incurring? Because bad debts and all will come only after you sell the goods. Yes or no? Only after you sell the goods, you will incur bad debts. Okay. So to make the sale, how much cost you are incurring? You have to incur some variable cost and you have to incur some fixed cost. So total cost is 60,000. That is what I have written it as. 4 is equal to 2 plus 3. These two are addition. Okay. Now after you sell, there may be some bad debts also. Let's say bad debts is 10,000. Bad debts means you sold goods to somebody or few of your customers and those customers are not paying you. Preferentials. Alright. So bad debts is 10,000, let's assume. So what is the expected profit you're getting, sir? Expected profit is what? You made a sale of 1 lakh rupees. Your total cost excluding bad debt is 10 and bad debts is 10,000 rupees. That means what is your profit you're getting? Whatever I've circled minus that, that's what I've written. 1 minus 4 minus 5. These three you need to consider. From 1 lakh, 60,000 sales is your 1 lakh, 60,000 is your total cost excluding bad debts and bad debts is 10,000 means the expected profit here is 30,000. Yes or no? Alright. Alright. Here in these problems, there will also be some opportunity cost. Now what is this opportunity cost? See, if you want to sell the goods to the customer means first you need to buy them. If you need to sell the goods to your debtor means first you need to buy them. To buy the goods, how much cost you will incur? Bad debts and all will come later. After the selling only it will come. To first of all, before selling the goods, you need to buy the goods. To buy the goods, how much cost you will incur? 60,000. Yes or no? Okay. Opportunity cost is given by the formula. The total cost excluding bad debts, which in my example sake is 60,000, into rate of return. Let's say that rate of return will be given to you in the question. Let's say that is 10%. Into credit period. How much credit period are you giving in the present policy? 30 days. Into 30 divided by 365. This if you do, you're going to get opportunity cost. Okay. Same component. To sell the goods, first you have to purchase the goods. Yes. So to purchase the goods, how much money you require? 60,000. Now when you sell these goods, will your debtor pay you the money right now? No. He will pay only after 30 days. That means this 60,000 funds is getting blocked for how many days? It is getting blocked for 30 days. Yes or no? Correct. Now, had the debtor paid the money right now without delaying, now right now he's delaying the payment and he's making the payment only after 30 days. If we had not delayed and if you had paid the money right now, then what you would have done? The 60,000 you could have invested somewhere. Maybe you could have taken the 60,000 and invested in State Bank of India and got some return. That return is percentage, I've assumed it to be 10%. For how many days can you invest? For 30 days. Yes, why 30 days? Because here debtors is delaying it for 30 days. That we refer to as opportunity cost. Opportunity cost means the cost of sacrifice you're making. Okay, the cost of sacrifice you're making. What is the sacrifice in company is making over here? Since debtor is delaying the payment for 30 days, okay, that means company is using some investment income. Had the debtor paid the money immediately, right now he's delaying the payment. If he had not delayed the payment and paid the money right now, that means they would have got the money 30 days early. So for this 30 days, they could have invested this money somewhere and earned some return. Okay, are they able to earn this return now? No. Since debtor is delaying the payment, okay, the company is losing out on this interest income. That we refer to as opportunity cost. Okay, this is a notional cost. We don't pass any journal entry for all this. It will not come in your accounts or taxation. This will only be considered for your FM purpose. Like in my regular batch, I used to give the common example. Yes, here I am teaching you, right? If I was not into teaching, I would have probably worked in a corporate and I would have got some salary. Yes or no? Right now, am I getting that corporate salary? No. I'm sacrificing that corporate salary. Yes or no? Because I'm into teaching, I'm not getting that salary from my corporate. Yes. That becomes opportunity cost for me because I'm sacrificing that. Yes. That is your opportunity cost. Okay. If you calculate over here, 60,000 into 10 divided by 100 into 30 divided by 365. That I'm getting it to be 493. Okay. So what will be your expected benefits? Profit is 30,000. From this deduct opportunity cost. So if you do that, you're going to get 29,506 or 507. I'll round it off. This is the expect benefits. Okay, fair enough. Alright, so this we need to do it. And this is the expected benefits from the current policies. Let's say you work out the same number from the new policy. Let's say this number is, let's say, assume 40,000. You worked out all these numbers. Let's say this final figure came to 40,000. Okay. Now you tell me, what should the company do? Under the existing policy, company is getting a benefit of just 29,507 rupees. Yes. 29,507. But under the new policy, if they implement new policy, they will get a benefit of 40,000. That means what should they do? The company should implement new policy because they are getting extra benefit. Yes or no? Okay, that's your conclusion. Okay. Sometimes they also ask you in such problem, solve this question under incremental approach. If they don't say anything, you can compare these two and give a conclusion. Sometimes they also say solve under incremental approach. If they ask you to calculate incremental approach, then you can bring in one more component known as incremental benefits. Incremental benefits means by going for new project, how much extra benefit you are getting. Incremental benefit means by implementing new project, how much extra benefits you are getting. Check. Under existing scheme, you are getting a benefit of only 29,507 rupees. But if you go for new scheme, you are getting a benefit of 40,000. How much extra benefit you are getting? 40,000 minus 29,507 if you do, you are getting an extra benefit of 10,493. Okay. Since you are getting extra benefit from new project, you can go ahead with a new product. You can implement this new policy is the conclusion. Is that okay? Alright. So these are some of the things that you need to keep in mind. Alright. Okay. This is another type of problem. Another type of problem that could get asked in the question is factoring. Another type of question is factoring arrangement. First of all, what is this factoring arrangement? Let's say there is a company A Limited. They have sold goods to many guys and they have yet to collect the money from them. Okay, let's say the money they have to collect is, let's say, 40 lakh rupees. They have many debtors to whom they have sold and they have to collect about 40 lakh rupees from them. Okay, let's say the company has given 60 days credit, meaning the company will recover this 40 lakh only after 60 days. Let's say A Limited needs the money right now. Okay, can they go to debtors and say, hey dude, give me this money? What will debtors say? Hey boss, you have given me a credit of 60 days, so I will pay you only after 60 days. Yes, because everyone needs money. Yes. So in this case, what you can do it is, A Limited can sell this debtor. They can sell this debtor to another particular company known as the factor. They can sell this debtor to a particular guy known as factor. In return, what will the factor do? If they sell this debtor, means factor will give money. They will not give full money. Let's say they give 39 lakh, or let's say it as 39 lakh rupees. Okay. Factor will give 39 lakh rupees to A Limited. Okay. A Limited sold this debtors, okay, to a particular guy known as factor, and in return factor gave the money to A Limited to the extent of 39 lakh. Then what will happen is, now this debtors, right, whom they had to pay? They had to pay A Limited. But what did A Limited do? They have sold this debtor to factor, right? Now what will happen is, the factor will approach debtors and tell, you give me the money, because your company A Limited have sold the receivables to me or debtors to me. Now you need to pay me. So after 60 days, all the debtors will pay the money to the factor. So factor will collect 40 lakh rupees from the debtors. That's how this arrangement works. This is win-win for everybody. Like A Limited wanted the money right now, so they got this 39 lakh rupees right now. Factor check, how much did factor pay? He paid A Limited 39 lakh, but how much money did he collect from debtors? 40 lakh. That means how much extra did he collect? He collected 40, he gave only 39. That means 1 lakh is his income, maybe his commission, because they don't do all this activity at free of cost. So that 1 lakh rupees is his commission income. Okay. And debtors, the advantage is he's able to pay the money only after 60 days. So that means he's neutral there. Okay. It's neither beneficial for him or anything of that sort. Okay. But for these two guys, it's definitely a win-win scenario. This is how factoring arrangement works. Okay. Now, how this can get tested in your examination is, they will give you certain data, okay, and they'll say there is one company, they are thinking whether should they go for factoring arrangement or not. Okay, that's all they'll say. So you need to evaluate that factoring proposal. Okay, and maybe one step back, I'll also go for this factoring arrangement. Could be of two types. With recourse factoring, the factoring could be with recourse factoring, and other arrangement is without recourse wala factoring. Factoring arrangement could be two types, with recourse, without recourse. What does with recourse means? Suppose after 60 days, debtors did not pay factor. let's say some debtors defaulted. Some debtors did not pay the money to factor. If it is with recourse factoring, what will happen is factor will go back to A Limited and recover the money. With recourse means going back. Okay. So if debtors does not pay means factor will go back to A Limited and collect the money. Okay, that is with recourse factoring. Alright. There is another arrangement of factoring that is without recourse. Without recourse means if debtors does not pay the money to factor. If debtors does not pay the money to factor, then factor cannot go back to A Limited and collect the money. The factor cannot go back to A Limited and collect the money. Okay, that means under with recourse factoring, who has bad debt risk? Under with recourse factoring, A Limited has bad debt risk. Yes or no? Because if debtors does not pay, A Limited has to pay. So bad debt risk is with A Limited. If it is without recourse factoring, then bad debt risk is with a factor. Okay, this factor will be having that bad debt risk. Normally, since factor is taking higher risk in without recourse factoring, the commission also he'll charge higher. So which one to take, with or without recourse? Normally in our study material, no, they don't discuss about with and without recourse while factoring. In all our problems, they've assumed without recourse factoring. That's how they've solved in a couple of questions. I say you also solve using this approach only. Assume that the factoring arrangement is without recourse and solve the question, because that's what our study material has done. So you can stick to the same assumption. Now, how will you evaluate this proposal? Simple, sir. Whether the thing is, they will ask is whether should the company go for this factoring arrangement or not. The company here refers to my example in case of A Limited. A Limited, should they go for factoring or not? Normally, in case of factoring, there will be some benefits also, there will be some cost also. One benefit is cost of administration. Now you tell me, in this example sake, should A Limited follow up with debtors and collect the money? They already, if they sell this debtors to factor means, if A Limited has sold these debtors to factor means, should A Limited now follow with the debtors? Should they call them up, mail them up, or have any resource? Should they incur any collecting expenditure to collect the money from debtors? No, they will save that. Yes or no? Because all that activity, who will do now? Factor. So that means there will be some collection cost for saving, administrative cost. Normally, to collect the money from debtors is a big headache. The companies will have some receivable team. Their only job is to follow up with the debtors and collect the money. So if you sell the goods debtors to your factor, those administrative costs, the collection expenditure and all, you can save. That is a benefit. And bad debt risk also, if it is without recourse factoring, who will have bad debt risk? Factor. That means bad debt risk also is one of the benefit you will get, because now factor will bear that bad debt risk. Company need not bother. So that will be one of the benefits. These two are benefits. Factoring does not come at free of cost. There will be some cost also. One will be factor's commission. They will give it to you in the problem. It could be 3%, 5%, 1%, whatever. Check. They will give it to you in the examination. Question. One cost is factor will charge some commission. Then it's possible that factor also could charge some interest. Here he has given, in my example, he has given 39 lakh rupees. No? On that, factor may not just charge a commission, he may also charge some interest. They will give you some data, you can just check. Not necessary it has to be there in every case, this interest component. Some case it may be there, some case it may not be there. These are your cost. So let's say the total benefits due to factoring is 1 lakh. I'm giving you, assume the numbers, that's all. Total benefits due to factoring arrangement is 1 lakh. Total cost is 80,000. Total benefit is 1 lakh, total cost is 80,000. That means what is the net benefit? 1 lakh minus 80,000. How much is that? 20,000. So if this net benefit is positive, okay, meaning greater than 0, then you can give a decision saying, or you can give a conclusion saying, company can go ahead with a factoring arrangement. Otherwise, factoring arrangement need not be gone through. That's the conclusion you can give. Okay. All right. These are some of the problems, and there is one more type of problem which can get asked in the examination, that is budget. More importantly, cash budget. Okay, they will ask you to prepare something known as cash budget, cash forecasting. That's all. Let's learn that with the help of one problem itself, so that we'll know how this estimates work. This question I picked from study material only. This is a study material question. Let's read it and quickly do it off. From the following information and assumption, the cash balance in hand on 1st January 2017 is 72,500. So I think this is opening balance. You need to prepare a cash budget. Okay. Assume that the 50% of total sales are on cash basis. So that means what? Out of the total sales, if 50% is on cash sales, means other 50% will be your credit sales. Okay. Assets are to be acquired in the month of February, or 1 minute, I'll tell from which period to which period are they asking the budget. First we will see, so that we can tick off. They have given the data from Jan to June. That means you need to prepare the budget from January to June. Jan, Feb, March, April, May, June. For 6 months you need to prepare the budget. This is your solution. Quickly we can tick it off. It's okay. Alright. So only for 6 months you need to forecast. You need to forecast how much will be your cash balance. How much is going to be the receipts. How much is going to be the payment. That is what you need to mean. Cash budget simply means you have to find out how much is going to be your expense. How much is going to be your income. And after settling income and expenditure, how much is the cash balance remaining? Cash ka closing balance basically. That is what we mean by budget. Forecasting the numbers. Income and expenditures we need to plug in and get it. That's it. Okay. Alright. Assets are to be acquired in the month of February and April. So in 2 months you have to buy some assets. Therefore provision should be made for payment of 8,000 and 25,000 for the same. So one payment of 8,000 will come in February. One payment of 25,000 will come in April. Check. This is a payment. First they have given receipts, then they have given payment. 2 payments we already identified. One in February, some capital expenditure will come for 8,000 and another one will come for 25,000 in April. That's what I've ticked off there. As and when you see, we'll tick it off. This is a very easy question. Okay. Those are the payments that comes only in those months. Other months it is not there. Okay. An application has been made to the bank for grant of loan of 30,000. Okay. We have applied for bank loan and it is hoped that the loan amount will be received in the month of May. So when we say cash budget, don't be misled with the term. Here cash means cash as well as bank, both put together. Okay. So you have applied for loan of 30,000. If loan gets sanctioned means your bank balance will increase because bank, obviously bank is giving you some money, right? So it is expected that you will receive this money in May. So means this is a receipt or payment. Initially it's a receipt. Yes or no? When you get the loan, it's a receipt. When you repay the loan, it becomes a payment. If they say about repayment, we will see. For now, you will get the loan in May. So that means it should be a receipt. Have they shown receipt in the month of May? Check. Bank loan 30,000 under receipts category. That's all. Take that receipt or payment for the respective months and plug it in. That's all as the cash budget ka preparation. Quite straightforward. It is anticipated that the dividend of 35,000 will be paid in June. So dividend paid is a payment. June, May, there should be 35,000 payment. June. And dividend payment, where is it there? June, May, 35,000 dividend payment. Other months not there, only in June month dividend payment is there. Okay. Debtors are allowed 1 month credit and creditors for material purchased and overheads grant 1 month credit. So if you sell the goods to debtors, today you will recover the money only after 1 month. Same thing, if we buy the goods from our creditors, we will not make the payment now only, we will make the payment only after 1 month. And even overheads, meaning other expense also, we delay the payment by 1 month, they are same. Sales commission is 3% on sale paid to the salesman each month. So how much ever sales he achieves that month, on that 3% will be paid to him that month itself. Then they have given you sales wala data, material purchase data, wages, production overheads and office overheads they have given. Okay, first we will take with sales. So total sales made in January is 72,000. They told in the problem, of the sales 50% is on cash basis, 50% is on credit. So 72,000 ka 50% if you calculate, that will be 36,000. This is your cash sales. Balance 36,000 will be credit sales. And they told in the problem, if you make credit sales, how much credit period you will give to debtors? To debtors you are giving 1 month credit. That means January month may if you have a credit sale of 36,000, because January month ka total sale is 72, no? If total sale is 72 means cash sale is 36, balance 36 is credit sale. This 36,000 credit sale amount you will recover in January only? No, you will recover after 1 month because 1 month credit. So this 36,000 you will recover in February, like that. February month may total sale is 97,000. 1 or 2 I will show you. 97,000 ka 50% you calculate because that is a cash sale amount. 97,000 divided by 2 or 50% if you do, that is 48,500 is credit sales or rather cash sales made in February. Balance 48,500 is a credit sale made in February, but the money will be recovered in March, like that. Okay. One more maybe I'll show you. March is 86,000 total sales. Out of 86,000 sale made in March, 50% will be on cash. So calculate 86,000 ka 50%, which will be 43,000. Other 43,000 will be March month ka credit sale, which will be recovered in April. Like that, they have put up the collection. Cash sale and cash collection from debtors, they put it up. That's your receipt. Okay. Similarly, material purchased. These are the material purchased in those months. Okay. Material also, if you purchase in the month of January, will we make the payment in January only? No. January month may if you purchase means you will make the payment in February. Why? They only told creditors give a credit period of 1 month. So if in January, if you purchase, you will make the payment in February. February ka purchase, the payment will be made in March, like that. They have not given previous year December ka data, how much we have purchased. So that means because previous year December, if you have purchased, means the payment for that will be made in January. They have not given that. Hence, January May, we have not taken any payment. January month ka purchase will be made in February. February month ka purchase payment will be made in March. Like that, the data has been carried forward. Same data you have to apply for overhead also. They told overhead also gives 1 month credit. Same data for these two also you need to pay. So January month overhead will be paid in February, like that. How much paid in January? We don't know because they have not given previous month's ka data. So January month ka overhead of 6,000 will be paid in February. February month ka overhead of 6,300 will be paid in March. Check have they taken March month payment 6,300, like that, going forward. Same data for office selling and overheads. This January ka overhead, office and selling overheads is 5,500. That will be paid in February. February ka overhead will be paid in March. Check in February, have they showed 5,500 overheads? Yes. March May 6,700 overheads? Yes. January May, they have not given previous year data. So we are leaving it out like this. Okay. Salary and wages, they did not comment anything. So that means that is paid that month only. That month ka salary you pay in that month only. So that is what they have taken as it is. Whatever data they have given, this is given in the problem. Just take the data as it is. No delay. If they don't give any delay, assume that that month ka salary is paid that month itself. So all this data did we consider? Yes, everything we considered. There is also one more. Salesman's commission at 3%. 3% of what? On sales. In January, how much sales did you make? 72,000. Into 3% you calculate. 72,000 into 3%, which will be 2160. They told how much ever sales he makes, of that 3% commission will be paid to salesman that month only. So 72,000 ka 3% is 2160. Check have they shown? Salesman's commission January is 2160. That month ka sale, how much ever he achieves, of that 3% he gets right away. February month ka sale is 97,000. Of that, if you calculate 3%, 97,000 into 3%, my calculator is showing 2910. This is February month ka sale. So 2910 is February month ka commission paid in February only, which is 2910. Like that, sales ka 33% they have calculated and updated. This is your total receipts. This is your total payment. From receipts, if you deduct the payment, you're going to get the net cash flow. How much cash is remaining? This is for January, Jan, Feb, March, April, May and June. If you just check the problem, January ka opening balance also they gave in the question, first line only. On 1st January, company had a cash balance of 72,500. On 1st January, they had this much of cash opening balance. Instead of all this, you can simply write cash ka opening balance. In January month, totally net cash flow means receipt. If it is a receipt, you will show it as positive number. If it is if it is overdraft means, if the payment is more than the receipt, then you can show it as negative number, like that. Okay. In January month, totally the company has received 23,000. 1 minute. Okay. It is abstracting view. Okay. All right. So this is cash ka opening balance. Okay. In January, total company has received a receipt, or they have a receipt pending of, or they have this much receipt of 23,840. This much cash they still have. Oh, at the beginning of the year, they already had 72,500. That means how much is a cash ka closing balance? These two ka addition. 23,840 is the extra cash that they got. They already had 72,500 cash with them as opening balance. So closing balance is 96,340. Closing balance of January will become opening balance of February, like that. Closing balance of February will become opening balance of March. Closing balance of March will become opening balance of February or April. Like that, you can go on updating it. This is your simple way of preparing cash budget. So these are the types of questions that can get asked in working capital management. Okay. With this, all the chapter ka last day revision or marathon as we call it, we have completed. We have done it a little quickly. Hope the pace was okay for everyone, because it is intentional that on the last day you have to be a little quicker. You can't take your own sweet time because there will be a lot to revise. All right. So if you feel our class has helped you, you can refer this video to your friends as well. So wish you all the very best for your exams, guys. Hope you clear the examination. Hope you come out with flying colors. All the very best. Take care. Stay safe. Bye-bye.